to complete adjustment of focus.
Mic check, 1, 2. All right, good morning out there. Got a couple things I got to do here. A few things for you to be watching, though, this morning on the open here. Of course, take a look at that red bar on book map here in the center of your screen. And then another key level to be looking at below here is the gamma flip on SPX. You can see this down here where my cursor is. Just right here where this yellow arrow is down here. This is the gamma flip. We did SPX open below the gamma flip this morning. So we are in negative gamma territory. We've got S3 down below at 469.68. The daily trigger on
at the top of the hour. We get the
SPY is at 464.33.
November. The forecast is 0.5% on the prior.
That would be your STX buy or RTX buy signal down below on SPY. And get all that for you here. I can get all this up on the screen for you here. Your hourly trigger is up high there. You can see that. Also down below in your screen here, you see the Qs. You'll see your daily trigger down below on the Qs is 398.41. You do know a couple notes here you may or may not know would be we stay on trend as long as price remains above the daily trigger on Qs and SPY, right? So this down that we have today, if we stay on trend, you should see price stay above the daily trigger. You should see, even if we break through a bounce and recovery on the daily trigger, if we begin to reject underneath the daily trigger, we would be breaking trend. So that's important for you to an awareness for you to have this morning. Now, the expectation for the start to this year would be sideways and slightly up for Qs and SPY, SPX, but not major trend to the upside, and then an eventual roll down into mid-March. IWM and small caps should get bought and outperform from now into March. Now, I think I heard, I was watching CNBC yesterday or something, and they were talking about, the doom and gloom for small caps. But the reality is, with that outperformance from small caps, you should see big, huge squeezes up and then giant pullbacks as that happens. So if you're a small cap person, or if you're wondering how will small caps continue to outperform even though it was down into the end of the year. It should. So keep an eye on that. The last note for you this morning would be about the expectations for this year. I did write an extensive report. It's almost done. I had a few more things. I got some small technical things I want to clean up just so it's a nice, clean report for you. That report will be released today on in the Discord today. So you'll get it'll be on the website with a link back from the Discord, so that you can have access to that report. I go in depth into what to expect this year. I know that a lot of you out there are investors and want to know when to invest, when to look to invest, if you can invest this year or not. I know that some of you are not just day traders, and you're looking for those key moments in the market so that you can come out on top for the year. So that will be available at some point. I believe this afternoon or this morning it should be out and available for you this morning. I just got a few more things. I want to make sure it's absolutely right. And I have like a bunch of dates and stuff that I had to look at. And I did post a preliminary year chart on Twitter over the weekend. That should have been a nice tease for you and what to expect for this upcoming year. Happy New Year to all of you out there, by the way. I'm still on some form of vacation until Friday. My children are off from school until the 6th or something. Whatever this Friday is they're done with their schooling, so you'll see me back in action again the moment they're back into their schooling. And I got a bunch of other crap I'm doing for this end of year, like dogs' end of year shots, kids with dentist appointments, kids with medical appointments, you name it, it's all just rolling in. So you'll get the report later today. The streams will be up all week long, at least, for you to be here and talk amongst each other. What else is going on you guys need to know?
Construction spending month over month for the month of November.
We had our final meeting with our general counsel. We have offers being sent out currently to anyone that's been involved in this project so that we can launch the website. I heard some talk about the membership levels on the website, some complaints. They shouldn't have been public. I don't know why they were listed public, but that is not the final form of what we're doing. Whatever you're seeing on public on our website is not the final form of what we're doing. It's just a heads up to you out there if you're wondering or questioning that kind of stuff. You have any what's going on, what the hell's going on in the background kind of stuff. I would just be patient here, and we will be launching. We were successful in doing an embed for the website, so it's just a matter of getting the finer details done on that stuff. Those guys seem to be coming across as saying, yes, we are going to get it done. We had a meeting where we looked at that stuff over the week or last week. Well, I was not streaming last week. I was in meetings all day long. I was down in offices with teleconferences all day long, that kind of stuff, just trying to prove that everything that we're doing is correct. So we're making good progress there. What else? I might have some. I've got some other cool stuff. We got some cool stuff coming for the new year. So just stick with us. Be patient, and again, keep your eyes down below here. This is the Qs. 398.41 is the expected target on Qs. If you're wondering if we're rolling over, the truth here is you should see a slow, gentle roll and an acceleration down into mid-March of the market, okay? You should also see we should have some good days, right? Trade sideways and up, that kind of stuff. Big rotation going on. And you're going to be looking for a dip buy in that mid-March area. But I wouldn't get all doom and gloom at this point. You're still on trend right now. Remember, SPY Qs are still on trend. So as long as price stays above, you're going to be chasing that price. If you catch a bounce down here at 398.41 on Qs, nothing has changed for the bulls. The bears must get the hourly trigger and price with a rejection underneath the daily trigger on both SPUs and on Qs for all that doom and gloom. Now, if you're going to ask me what I think about that kind of stuff, like how high we can go, all that kind of stuff, Bull's still in charge here. There's no reason not to think that the market's not going to continue to trade sideways and up, and that you don't get that roll down until we get closer to that mid-March time period. Today is January 2nd. It's not March 15th, anything like that. So be cool and I want you to remember one other thing. Most people are still off on vacation. I realize that some of you that are new retail traders think that this is, January 2nd. Let's get it on. The year has started, but the truth is that most of Wall Street, most market participants are still on vacation until after the 6th, until after this upcoming Friday. This holiday is stretched out. Most holidays, too, you'll see, depending on when the dates of the year are. This year, the way this year worked itself out with holiday dates and then the calendar dates, the stock market itself is not in normal operating until next Monday. So just be aware of that. All right, now I'll be back with you here shortly. Hey, welcome back, everybody. Happy New Year, everybody. How y'all doing? Y'all have a good year? Hope y'all did. And the other thing, too, here would be we're starting Q1. Remember something else, right? So we're in Q1. You're gonna get positioning for this quarter that normally takes about a week. Okay, so normally the first week of the quarter is a quarter that you sit on your hands, you don't do shit, and you wait and see where the market's gonna head. We'll talk about all that stuff as the week progresses.
Ten seconds. Zero spot 4%, 0.4%, lower than forecast, 0.5%.
Gorgeous little bounce down there, right on that. Hold on a second, I'm losing my microphone. Nice little bounce down there. Gorgeous on that little gorgeous orange bar there. Keep your eyes on that gamma flip down here. So this red line right here, this is the gamma flip for SPX, right? On this bounce here, you don't want to see a rejection to head back down. You want to see the recovery on the gamma line. That gamma line is 4750. So on SPX at home, keep your eyes on that 475 or
The prior revised up to
4750 on SPX.
6% as well. For the
Keep your eyes on that one right there. You want to see that recovery right there for trend to continue for the
We have
bull.
posted out the construction spending report on the feed for anybody interested.
Up 0.4%, but in the rearview mirror, a significant revision from up 0.6 to up 1.2. We see that interest rates are up for the first session, and we want to pay particularly close attention to the notion.
Let's also talk about one more thing, okay? We're going to have a little chat here. If you are a bull, you do not want to see rate cuts. I assure you. That's number one. You do not want to see them. Number two, so we are in a soft landing. In my estimation, we are in a soft landing. You've been in this report you're going to get from me on this report you're going to get from me. I want you to know a few things. We are in a soft landing. It began on July 26th. We're about 5 months into that. I think it's 5 months, something like that, right? Into that soft landing. Those soft landings last anywhere from 1 year to 5 years. There's some other key points here that I have not seen discussed publicly. And that is that, one, you're in the soft landing for 1 to 5 years. Two, inside of that between the soft landing and the next period, there's always a recessionary period that follows historically any soft landing. So we have 3 on record, right? 3 soft landings. They're always followed by a recessionary period. This morning I saw CNBC talking about, are we going to get a recession this year, that kind of stuff. There is something else that no one is addressing, and that's in this report. So inside of that, so if we have a soft landing, okay, and actually the actual soft landing lasts about a year. Now there's a window between soft landings and that forced recessionary period. That's the actual time frame where that can last 1 to 5 years, and it is all predicated upon whether the Fed cuts rates or not. And the true soft landing should last about a year anyway, or about a year, and it's in and of itself. So you should expect that this soft landing should last for at least the rest of the first 6 months of 2024. What happens here is that the Fed becomes even more in control of where the market goes in that in-between period. I call it the window, and I'm going to show you exact from date to date that window where the Fed is in super control. It's like a super control of the market period, unless we have an unknown event. Outside of an unknown event, if the Fed holds rates and could even possibly continue to raise rates, they could create a super bull run that lasts 5, 6, 7 years. They could last 1 year. Does not matter. It matters when they cut rates. The unemployment rate will matter as well, of course. The inflation will tie into that, jobs, unemployment, that kind of stuff. But they can fudge those numbers as well while they're holding rates higher. So I'm going to show you guys all the interplay in that and how that works out and how long this period should last. But you likely have no less than a year period, sometime into the end of 2024, or at least historically. Based on historical examples, it should last at least until end of year, if not March of next year. You're going to want to pay very close attention to 3 specific things, or 3 or 4 specific things. The first one would be, of course, rates, unemployment rate, the rate of inflation, and some jobs numbers and stuff like that. The yield curve, we're going to talk about that inside of that report as well. It is one of the least reliable indicators for, hey, we're going to start a recession like this spring, this summer. The Fed can invert and uninvert that yield curve inversion as many times as they want. They can manipulate that yield curve. They can pause that yield curve, believe it or not, through not cutting rates and then fudging numbers. And matter of fact, last week I was listening to a famous hedge fund person that said that she is a very close friend of hers, that their job at the Fed was to fudge those numbers. You saw the fudging of those numbers last quarter, and that can continue. And then I was asked over the weekend about all the bets on rates being cut next year. There's another key point here for you, that it does not matter if banks are lowering their mortgage rates. They can do what they want regardless of what the Fed is doing. Okay, so that's not an indicator of the Fed cutting rates. Number 2, market participants like the bond market betting that we're going to have 4 rate cuts in 2024. It's garbage science. All it is gambling. That's all it is. That's all it ever was, and all it'll ever be. So be wary of that as well when you're making your predictions as to what's going to come or happen in 2024 with rate cuts. As a matter of fact, this morning you saw that rates higher is the mantra for CNBC this morning. So you should put all that stuff on or put your blinders on when it comes to all of that. I don't know, dick swinging that goes on in the bond market or in CNBC or in public or even what mortgage companies are saying is going to happen. So, and trust in seasonality, trust in prior examples, that kind of stuff to guide you in what to expect. And traditionally what happens, right? If we have a presidential election year, that kind of stuff, those things really do repeat and play themselves out repetitively over time. Even if we have large outside swings one way or another, we tend to come back to the norm at some point. So those things have really worked well for most investors and traders out there over time. As time smooths out those things, you'll see that market still operates in a pretty predictive way. So I'll be back with you, and I've got some other stuff I got to do here, and I will talk to you guys soon. Happy New Year to all of you guys out there.
We could come into every year for the past, I don't know how many, 10, and say, it's going to be value stocks this year. And then as the year ends, we're all like, oh, we should own the growth.
Well, I mean, 2022 was fantastic for value, and then it just totally got reversed in 2023, and everything was was zero. So we're in that alternating fashion, but I think the ratios here.
I saw you, career low. I know, man.
Nothing crazy. I don't think a lot long term, certainly not to the levels that we had, pre-pandemic, that so boosted those stocks during that period.
Yeah, of course, a recession, as well as what happens with monetary policy, a big indicator here. Raymond James writing in a note this morning, the equity market seems as convinced about a soft landing today as it was convinced of a recession in 2022. Where are you on that camp? And do you think that conviction is more accurate this year than perhaps it was a year ago?
Yeah, I mean, it's certainly looking more likely. I mean, I give it I give a soft landing, probably 2-to-1 probability. But look at it.
I want to make a comment here. You see these people on CNBC right now. They're still talking about soft landings. These people are out of their fucking minds. Out of their fucking minds. Your soft landing already began. Your soft landing began way back in late July of 2023. And it was confirmed on our last rate decision. So these people are out of their what these people do, right, is they tell you stuff, right? This is a very important point here, okay? You'll see like a mantra be said to you, like, if this happens, if that happens, if this happens, if that happens. And what actually is going on is it's already happened or is already happening. And then by the time that they declare something as happening, it's all been priced in, and you're like behind the gun already. So you already got your soft landing. It should last for another 5 or 6 months.
Couple of months ago from Lebanon, and that really is the crossroads there. That is where we're seeing Hezbollah, which, like Hamas, is backed by Iran. Remember, the Houthis, which have been seizing ships and attacking commercial vessels in the Red Sea, they are also a militant group, a rebel group in Yemen that are backed by Iran. So what we're starting to see now is an expansion of the war to include the entire, what the Iranians and their supporters would call the axis of resistance. Those nations and militant groups that are very opposed, not just to Israel, but also to the United States and Sunni-backed moneyed monarchies in the Gulf. And so we're starting to see them all acting in concert. And that's why this is becoming so much more threatening. The United States has now been pushed almost to the point of a direct confrontation with Iran. And now that Iran has deployed what looks like a warship into the Red Sea, it looks as though we're now closer than ever to a region-wide war involving possibly not just Israel and militant groups like Hamas.
I mean, listen to this clown right now. This fucking clown out there is talking about a larger scale war, right, in the Middle East due to Iran deploying a warship. Do any of you remember the last time that Iran deployed a warship? We literally sunk their entire navy in about 55 minutes. There's no expansion of war here. Iran would be, I would be wary if I was Iran deploying any warships to any sea right now. If you guys don't know that story, there's a famous story of Iran fucking around once years ago, and the U.S. basically begged these guys to stop firing missiles, stop shooting, stop sending their gunboats out, and the U.S. literally had I think the war with Iran and the naval war we had with Iran lasted, I think, 55 minutes. It was absolutely brutal. Let me see if I can find that war for you.
Security and political that it's ever seen since its founding, guys.
Matt, thank you for that rundown of all of those concerning issues. Appreciate it. Matt Bradley in Tel Aviv. Let's take a quick break here and give you a roadmap as well for the rest of the hour. Tesla is out with its latest delivery numbers.
It was called Operation Praying Mantis. On your own, look it up. It's hilarious. Yeah, I know. I know, Beartown. I'm like, really? Expanding war with Iran? Like, look up a thing called Operation Praying Mantis. Those guys couldn't brew a pot of coffee before that war was over.
Insiders are predicting we got a lot more squawk in the street straight ahead. Welcome back. Shares of Tesla on the move after fresh delivery numbers there. Let's get to Phil LeBeau with the latest. Hey, Phil.
Good morning, Leslie. And when you look at the fourth quarter results for Tesla, these are better than expected. In the fourth quarter, in terms of production and deliveries, here's what Tesla reported just within the last couple of hours. Production of coming in at 495,000 vehicles, essentially, and deliveries, this is the one that's getting the most attention, 484,507 vehicles. The street was expecting 473,000. That was the latest FactSet consensus. Most were saying, look, as long as they hit 475,000, that's the key number here, because if they hit 475,000, which they did, take a look at this. Full-year deliveries would exceed the company's guidance of 1.8 million vehicles. So for the year, they come in at just basically just a little shy of 1.81 million vehicles. Deliveries increasing 30%, 38%, I should say, in 2023 compared to 2022. The question now is, at what cost in terms of margins? How much did margins have to suffer as they dealt with pricing issues both in China and in the U.S. for the fourth quarter, as well as all of 2023? We will get the financial results from Tesla after the bell 3 weeks from now, January 24th, Wednesday the 24th. And that's also when we will hear the company's guidance. We expect to hear the company's guidance for full-year deliveries in 2024. The estimate among analysts right now, 2.1 million, though if you talk with bulls, they'll say, look, we think they can get up to 2.2, 2.3 million. We'll hear from Elon Musk after the bell on the 24th about that. Guys, back to you.
All right, Phil, thank you. Yeah, we've got one of those bulls right here, in fact. Let's talk tech stocks for a second. Of course, as our viewers know, just wrapping up what was one of the best years we've seen over the last 2 decades. And our next guest, he was right about the big rally. Dan Ives, Wedbush Securities Analyst. You're going to, I would guess by the end of this year, you'll be atop the leaderboard of CNBC appearances, Dan. Although I'm willing to take an over-under on that. And you know what? I'm going to love every one of them. So happy New Year.
And it's great to be
good
here.
Good to see you. You had a good call on tech overall. You continue to be quite bullish. Let's start with Tesla, though. Just give me your take on those numbers. You know, Phil just mentioned 2.3 million. Are you going to be towards the high end in terms of what you expect them to deliver this year?
Yeah, I think whisper expectations could be higher. Look, this was a strong result. You look what's happening in China. There were fears there, and it was actually a source of strength. We think a record quarter in China. So I do think this is an important, sign that demand's actually strengthening for Tesla. It continues to be maybe EV demand soften, but not Tesla demand, and that's the important thing going into 24.
Yeah, where is that line? Why is that the case then? And in particular in China, where BYD is such a strong competitor, are they going to be able to maintain their market share?
Yeah, BYD has done a phenomenal job, but I do think if you look in the driver's seat, it's Tesla and BYD. Gained some net share from NIO and others. And in China, especially if you look at the last few quarters, there were fears that this price war was going to continue. It actually hasn't. See, now, to Phil's point, you're seeing price stabilization. That's very important, because now the Goldilocks scenario, margins upticking, demand upticking, that's where, in our opinion, you see $1 trillion market cap for Tesla over the next year, despite many of the haters continuing to hate.
Dan, I have to get your take on Apple this morning, with Barclays revealing its downgrade over cooling iPhone demand. Do you agree with the assessment there? Your channel checks showing the same thing about the demand picture for iPhones?
I mean, the last 48 hours, it hasn't changed from what we've seen over the last month. I mean, look, and I get some of these calls from a valuation perspective, and many that have been naysayers over the last year. But if I look at iPhone 15, we have not seen number cuts from our checks in Asia, and that's important because I think it shows that this upgrade opportunity is actually manifesting for Apple. I actually think the mix is much more Pro, specifically Pro Max in China. I think what that ultimately means is that this is going to be an iPhone number that comes in above expectations. But the most important thing, and David's talked about a lot, services. I still think this is going to be teenager type of growth, not single digits. If that's true, and we believe it is based on our checks, I think this is ultimately a stock that could go 30, 40% higher this year.
Wow, right. Well, you get potentially even a higher multiple again as services becomes an even larger part of overall profit. Let's talk broader tech here. Again, our viewers see you often, so we know where you stood towards the end of last year. This is going to be a big AI moment, and it's going to create a bull market overall for how many companies in technology this year, Dan?
Well, yeah, and talk about it here is that our new AI checks, and me and you've talked on the program a lot about use cases. Mm-hmm. Use cases are exploding. I mean, the average enterprise right now that we're talking to is seeing 15 to 20 potential use cases within their companies. That's why right now we think it's going to be 8-10% of budgets. And I think that's the important thing. You look, it's not just the godfather of AI and NVIDIA and Jensen. It's not just what's happened in Redmond. I think you're going to see this spread across the board in software and chips. which is why we believe tech stocks will be up 25% this year. And we could have some ebbs and flows, but I believe it's get out the popcorn moment. The new tech bull market has begun.
It has. And so we shouldn't be scared off by what may be very high multiples as a result of enthusiasm around generative AI and what it's going to add in terms of enterprise.
Yeah, because to that, I think maybe the multiple expansion was 23. 24, it's going to be monetization. I think we first see that in late January from the Dell and Microsoft. I think we also see it from Google. Then you look, you got MongoDB, you got Palantir and others. Monetization is key. When you talk about expensive, I look at, as we go into 24, 25, this is, in my opinion, it's a 1995 moment. It's the biggest tech transformation we've seen in 30 years. And I think this is really just the start of a revolution that's happened in AI monetization.
NASDAQ 20,000? Really?
Well, I think our bull case for this year is that tech stocks could be up 30, 35%. And I think we could be sitting here as the ball drops on 24 with a 20K NASDAQ. And we could have some sell-offs.
I mean, if by the way, if you're, wrong on this, I'm going to be able to hold you accountable because you always come in. And if you're right on this, you're going to cement the Oz reputation for years to come. You don't even have to, you can retire, Dan.
Look,
20K NASDAQ. If we sit here next year this time with a 20K NASDAQ, really?
And I'll be here. And ultimately, David, in my opinion, it's really about the monetization that we're seeing here. It went from a narrow perspective of tech to much broader. And that's why I think this is really going to start M&A, and you're going to see software and chips participate. I think a year from now, 20K NASDAQ is our bull case, and I think it's led by big tech software and chips.
All right. Dan,
no,
way to start the year. Good job.
No, thanks.
Good job.
Yeah.
That's one appearance, so I'm going to keep track. Okay. We'll have an over-under. Maybe FanDuel's going to want to get in on this.
Yeah.
Yeah, whatever.
Sure.
Okay.
Betting markets. Exactly. Dan, thank you. As we head to break, check out the biggest gainers on the S&P to start 2024, led by Moderna, Wynn Resorts, Bristol Myers in there, Pfizer. We'll be right back.
Peacock.
Welcome back to Squawk on the Street. I'm Dominic Chu. The new year is kicking off with some different leadership in this year than in 2023. The early action on the first day of trading has leadership from healthcare, energy, and utilities, while leaders from last year like tech and comm services are the laggards so far today. Many of the top 10 performers in the S&P 500 are in that healthcare sector, powered by a surge in shares of Moderna by over 11% after losing 45% of its value last year. This morning, analysts at Oppenheimer have upgraded the biotech company, most well known for its COVID vaccines, to an outperform rating with a $142 price target, pointing to things like more visibility around COVID vaccine sales and new products in the pipeline for the next few years. Other larger cap biotech names, pharma names like Pfizer, Amgen, Bristol Myers, also Gilead Sciences are following suit. Also keep an eye on some of the outperformance in casino stocks within consumer discretionary. Wynn Resorts and Las Vegas Sands, two of the best sector performers so far today. We did late last week get some positive gaming revenue news out of Las Vegas. So, David, those casino stocks, ones to watch. I'll send things back downtown to you folks at the New York Stock Exchange.
Thank you, Dom. Dom Chu. Bitcoin climbing above 45,000. That'll be the first time it's seen that level since April of 22. It is up more than 170% over the last year. More on what is ahead for crypto in the new year. That's next on Squawk on the Street.
$85.55.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News update. Japan's prime minister says rescuers are in a battle against time as they search for survivors from a powerful New Year's Day earthquake. The death toll is already at 48 from Monday's 7.6 magnitude quake, which damaged buildings and roads and prompted tsunami warnings. Those warnings were lifted early this morning. Also in Japan, a fiery plane crash at Tokyo's airport. According to Japan's transport minister, a commercial plane collided with a Japanese Coast Guard aircraft. He also said, though, that all 379 passengers and crew aboard that jet made it off the larger plane safely. 5 crew members on the Coast Guard plane were killed. That aircraft was going to fly earthquake relief to the country's west coast. And Russia bombarded Ukraine's 2 largest cities today following President Vladimir Putin's New Year's vow to intensify strikes on the country. Kyiv's mayor says 2 civilians were killed from the attacks on the capital city and dozens more were injured. Leslie, hard to believe that's going into
The UK
its
DMO
second
says
year.
it announces
Yeah, it is hard
rescheduling
to
of some
believe.
gilt
Bertha, thank
auctions
you.
due to the date
Watching
of the March
shares of
budget.
Apple
There's no
down more than
changes planned to
3%
gilt
this hour.
syndications
Barclays
in January to
downgrading the
March
stock
2024.
due to iPhone demand concerns, saying, quote, iPhone 15 has been lackluster, and we believe iPhone 16 should be the same. Other hardware categories should remain weak, and we don't see services growing more than 10%. Not the most optimistic way to start out for the Magnificent Seven, but that is certainly affecting Apple nonetheless.
Yeah, they have a price target of 160. It really isn't different from their price target previously. It's about 25 times fiscal year 24 numbers, but of course well below the current price, although it's getting closer to it. 2023 was a year to remember for the stock market. It marked the 22nd best year in history for the S&P 500. It was the 4th best year in history for the NASDAQ 100, both indices trading close to their all-time highs. Papasani has been here for all of those years.
Since 1928. All of those years. Thank you for bringing that up.
And we get his incredible perspective as a result of that.
You know, up 24% sounds amazing, but it's actually not that unusual. I want to show that to you in a minute. But for the moment, I just want to point out that this is what a mean reversion trade looks like, exactly what's happening today. And we don't have to have an Apple downgrade to have this happen. Let's show you the sectors that are moving today. What were the biggest sectors that underperformed last year in the S&P 500? They were healthcare, energy, utilities, and consumer staples. What was the biggest outperformers? Included technology. What today is outperforming? Healthcare, energy, utilities, and consumer staples. Exactly what underperformed. This is what mean reversion trades look like. Technology, of course, big outperformer. It's underperforming today. What underperformed? What big names underperformed? Don was talking about healthcare just a minute ago. Last year, well, Moderna, Pfizer, Bristol Myers, Johnson & Johnson, big underperformers. What are the top performers today? Moderna, Pfizer, Bristol Myers, and Johnson & Johnson. This is what mean reversion looks like. Let's go on. What was another big underperformer last year? How about energy? Exxon, Chevron, big underperformers. How about Conoco? How about some consumer staple names like Kroger and Altria? What are the top leaders today? Again, Exxon, Chevron, Conoco, Kroger, and Altria. This is mean reversion the classic way here. And what was, finally on this theme, what was big movers, the big winners of last year? What gained the most? Advanced Micro, NVIDIA, Apple, and we even had some strange names like Sherwin-Williams and Norwegian Cruise Line, which was up 50% last year, Norwegian Cruise Line. What are the big laggards today? Okay, you're following along, paying attention? Very good. Advanced Micro, NVIDIA, Apple, Sherwin-Williams, and Norwegian Cruise Lines are the laggards. So, folks, this is the mean reversion trade. For this to keep working, a lot of things have to go right. Obviously, we're rotating into small cap and value. For all of this to work, other than today and play around with this stuff, interest rates have to keep coming down. You got to keep having the soft landing. So we'll see. We'll see. But as of today, this is textbook. Let's talk about what happens after 20% up gains in the year. First off, believe it or not, it's not that unusual. The S&P is up 20% or more about 1/3 of the time since 1928. I know that sounds crazy, but look at this. 36% of the time it's up 20% or more, 21% up 10 to 20%, and 15%. Add these numbers up. The S&P is up 3 out of 4 years in the last 95 years. That's why indexing works. You just stay with the market over time, and it tends to go up. Declines of 10% or more, look at that, only happened 12% of the time. And like 2022, we were down 19%.
So some commentary from Maersk,
rare
who said that in cases
here.
where it
January
makes most sense for our customers, vessels will be reported and continue their journey around the Cape of Good Hope.
So don't expect
and
too much
we'll
on a
continue
historical
to
basis
pause
from
all
what's going
cargo
on
movement
here.
through the
A
Red
lot of
Sea
people ask me
while we
at the
further
end of last
access
week, well, could we
the
get back-to-back
constantly
gains? How
evolving
about could we get
situations.
20%
Again,
gains? You're really
Maersk
getting greedy here,
continuing to
folks.
pause all
It
cargo
doesn't happen
movement through the Red
very
Sea.
often. It happens 65% of the time in the S&P 500 has 20% back-to-back gains. No, excuse me, 65% of the time it's up in 2024 in the following year here. It's down 35% of the time. The dispersion's very large, though. So I wouldn't put too much into the idea that there's a clear pattern here that the S&P, once it's up 20%, is inevitably up the following year, 20% or more. Now, let me just go on to the 20%. People were asking me about, can you get 2 back-to-back 20% gains? That is extremely rare. It's only happened 9 times since 1928. So 9 times out of 95, do the math, it's like 9% of the time here. And here's what's interesting. Here's all the years it's ever happened. We've had back-to-back gains where 2 years in a row you're up 20% or more. The last time it happened was 1998 to 1999. And David, remember that epic run? We were here from 1995 to 2000.
96, 97, 98,
right.
99.
20% back-to-back. You're not going to see that again. And the last time it happened, up 20%, 1999. Two back-to-back 20% years. So for whatever reason, this is now a fairly rare event in market history, and nobody really has much memory other than you and me about this actually happening then. So we'll see. But again, a lot has to go right for that to happen.
Yes.
Obviously, it's the interest rate scenario and the soft landing.
It was a seismic change in so much, given the advent of the internet.
Yep.
Maybe generative AI will be similar to that. Dan Ives certainly was sitting in that seat a few minutes ago.
Look,
think so.
Hats off to Dan Ives. He was directionally right, much ridiculed on the year for his endless bullishness and those incredible outfits he wears. But he was right on both counts. The outfits he's iconic in the outfits, and he was right directionally. So we'll see. But I agree. There is an interesting question about whether the internet is the same, whether generative AI is the same paradigm shift as the internet proved to be. That's a very interesting question. I think it's out, and I think it's worth debating.
Yeah. So you're saying there's a chance, in other words.
Yeah.
Well, we will be asking this question to our next guest then, because the NASDAQ just hitting session lows. Joining us now with his outlook for 2024 is Barry Bannister, Stifel Chief Equity Strategist. Barry, thanks for being here. So your prediction for the S&P this year is 4650 into mid-2024. That actually indicates a 3% decline from today's level. So what Bob was just laying out in terms of, the historical chances of, repeating that 20% gain again this year, you actually think it will be declining, at least into mid-2024.
Yeah, we're using 4650 as fair value in the first half. I really don't have the vanity to try to look out to the end of the year. That's just too far out. But we think that the first half will feature a 4650 S&P. The market is simply expensive versus the financial conditions index and the 10-year yield. And we don't really see, outside of a recession, much chance of the 10-year remaining below 4%.
And in terms of that 10-year, you say there's little downside catalyst other than a recession for the 10-year yield to fall further. Do you think the equity markets agree with that? Because there's been so much interplay this year in terms of where the 10-year yield goes and where the equity market goes.
Well, I heard you earlier reminiscing a little bit about back in the 90s, but if you think back to the early 80s, the first half of the 80s, we had just come off of the 70s inflation. We had in the first 5 years of the 80s a above 10% 10-year yield and a 5% real yield on the 10. There was muscle memory. There was a collective belief that we were going to go back to inflation, which we were not. It peaked in April of 1980. The same thing is happening now in reverse. Too many investors remembering the 2010s, which was borderline deflationary. A more normal environment, the 10 years should be closer to nominal GDP potential of the United States, and that's 4 and above.
How important, as you look ahead to Friday this week with the jobs number, how important is that in just kind of helping everybody level set for how the market is set up?
If you look at what constitutes the definition of a recession, it's income, production, employment, fixed investment, and sales. The only thing that was not negative last year was employment. In other words, everything else went negative. From the first quarter of 22 to the first quarter of 23, we had a pseudo or de facto recession. The only thing that held on, as I say, is employment, because the job market's just been incredibly strong due to post-COVID effects and other things. If employment starts to weaken, that'll be the last leg. I think that would take down everything. So many of the leading indicators of what is normally a late cycle indicator, employment, are the things that we're watching to know if there is going to be economic trouble in 2024. And until employment shows signs of weakening, I just don't see a recession.
All right. Well, we will certainly be keeping an eye on that, and then earnings starting shortly thereafter. So lots of catalysts to look for. Barry, thank you.
Thank you.
Bitcoin topping $45,000 a coin. That's the first time it's seen that level since April of 2022. As that rally, well, it seems to be continuing into the new year. Let's get to Kate Rooney. She has more on perhaps where this thing could go from here. Kate.
Hey, David. Good morning. So Bitcoin's new bull run is being driven by two upcoming events. First, there's this hope for an ETF approval, and then something called the halving that's coming up in April. It's up 65% or so in the past 3 months. ETF, that is the big driver, guys, of this price action. The SEC has a January 10th deadline to approve or reject the ARC 21 shares ETF. That's Kathy Wood's proposal there. Reuters reporting that the SEC could notify issuers as soon as this week if they've been cleared to launch those ETFs. If approved, guys, this would be a publicly traded fund tracking the price of Bitcoin. So investors theoretically wouldn't need to go to a crypto exchange or hold Bitcoin directly themselves. So it may lower the barrier to entry here. Because of that, some are arguing it's going to bring in a wider range of investors and then potentially more institutional interest. Then you've got something called the Bitcoin halving. That's coming up in April. The key thing to know about that, Bitcoin's new issuance gets cut in half. So it's a way to keep a cap on supply there. The code is written so there's only ever 21 million coins in circulation. This dynamic makes it less profitable, though, to earn new Bitcoin and more competitive for what are known as the miners. So these are the companies using those massive, high-powered computers to create new Bitcoin. Those mining stocks, you think of Marathon Digital, Riot Blockchain, those guys up about double digits today or so. MicroStrategy and Coinbase also higher this morning. Actually, Coinbase turning lower, down 6% or so. The other driver for Bitcoin, though, same thing, driving tech, small cap tech especially, some of the lower interest rates heading into this year, potentially, and return of risk appetite among retail investors. Guys, back to you.
That was going to be my question, Kate. How much of this is kind of a risk on sentiment versus just what we're seeing with overall approval expectations and, basically how much of it is sentiment versus the risk of a potential selling on the news once we ultimately get that news?
That is a big dynamic here, Leslie, the idea that this is a buy the rumor, sell the news event. So much of the price action has already been priced in at this point. And an ETF, yes, it's an incremental positive, but it may not be as big of a deal. So it's one of those things, especially in crypto, it tends to be a very frothy, FOMO-driven market. So that's one thing of buyer beware at this point. Although Bitcoin, in terms of these idiosyncratic events, I mentioned the halving and things like that, it really has historically traded more on tech fundamentals. It's seen as sort of this high beta tech play, and it has traded like that historically. Too soon to tell if it's going to break out of that and sort of trade on its own fundamentals. Right now, it's really tech, FOMO-driven rally, and we see that time and time again, although that's a good thing right now for Bitcoin investors as tech and the NASDAQ have had a pretty good year. Seems to be continuing so far in 2024.
Definitely trading more like tech than it is currency. Kate, thank you. Still to come, Morgan Stanley, one of the biggest laggards among the big banks in 2023. And now they've got a new CEO. We'll discuss the road ahead after the break. Don't go away.
member.
Welcome back. Turning the calendar onto 2024 means a new leadership change in the C-suite at Morgan Stanley. Taking over as CEO is Ted Pick. He is taking over from James Gorman, who had that role for about 14 years. Gorman moving up to become executive chairman, at least for about a year or so. But take a look at the performance of the big six banks. You can see there Morgan Stanley, the second biggest laggard among the group, up about 10% for the year. Bank of America, the biggest laggard, up about 1.7% in 2023. So Pick has his hands full. We spoke with him back in October when his position was announced that he would be filling that role as CEO. And I asked him kind of what the change in strategy might be, what he wants to put his stamp on. Take a listen.
The business strategy is sound. There will be no change in strategy. We know what we are after 15 years of transformation under James' extraordinary guidance. We've got a strategy where we have a world-class wealth and asset management business. We've got a world-class integrated investment bank, and there are so many opportunities to grow both of them globally. It's a strategy that's in place, and we're going to keep with it.
So change in leadership at the top, but no change in strategy. Now, that doesn't mean he doesn't have his hands full as he takes on this role. Of course, you've got a slump in deal making, which I know, David, you follow very, very closely. They've also had slower inflows into wealth management. Part of that has to do with rates and customers seeking out money market funds. We got about $6 trillion in those, given just the rate environment this year. So overall, strategy remains the same.
Right.
But, you know,
not transformation as was the case for the 14 years under Gorman, where you took what was a investment bank and really made it as much, if not more, an asset manager or a wealth manager with a series of acquisitions, Solomon Smith Barney, Vance, E-Trade, on from there, I guess. So is that, you know, but events can change your strategy.
And some might wonder, is it easier to be almost in a Gorman position where you are, as he described it in the interview with you a couple weeks ago, you're taking a firm that's on the brink. I mean, he said it was basically a near-death experience for Morgan Stanley coming out of the crisis. You basically, I mean, yes, you get to kind of rewrite history, you know, taking care of the baby that is being handed to you and, you know, preserving it, making sure it stays.
Yeah, I think you're right. I think Pick has a tougher time in a way.
It can be harder.
Because Gorman can always say, hey, listen, I came in, we were on the brink, which of course they were. It was right after the financial crisis. And he made his approach clear, and he can claim real success. It makes it more difficult for Pick because you just got to keep it going.
Exactly. But the world changes around you. You've got AI, you've got regulation, you've got all these different things that are happening, even in the near term, to contend with. So it'll be interesting to follow his trajectory as CEO.
And we will do that with your help.
The fourth largest firm by market cap.
There you go. All right, still ahead, a good 2023 for the markets, of course, and the world's top tech billionaires. We're going to break down their numbers. That'll be next.
50% off.
All right, NASDAQ, you can see that near session lows. It is being dragged down by the mega cap tech names. We call them the Mag 7 stocks. Apple, for example, is down more than 3.5%. And any number of the other names are also down rather significantly. You heard earlier in the program, of course, Jim Cramer did say time to trim. As for 2023, it was a different story. It proved a great year as well for some of the world's top tech billionaires. We always get out a tiny violin for them when Robert Frank joins us with those impressive numbers.
Well, David, it was kind of a wild ride for these folks. You'd call it the great round trip of the rich. The world's richest 500 billionaires adding $1.5 trillion to their wealth last year after losing $1.4 trillion in 2022. Tech billionaires led the charge, with the top 10 adding nearly $500 billion to their wealth. Elon Musk added the most in dollar terms with a gain of $96 billion. He's back on top as the world's richest with $232 billion today. He lost $200 billion in 2022, so he's still about $100 billion shy of his peak. Mark Zuckerberg close behind with a gain of $84 billion on Meta's stock increase. He's now worth $130 billion. And that Microsoft stock run, well, that added $31 billion to Bill Gates, $45 billion to Steve Ballmer. And the Google guys, they and Larry Ellison, all of them gaining over $30 billion. The biggest percentage gainer, no surprise here, Jensen Huang at NVIDIA, his fortune more than tripled to $44 billion. He's now in the top 30, ranked 28. Warren Buffett, he had a good year, adding $13 billion, but he could not keep up with all that tech stocks. He fell from 5th place to 10th place. Meanwhile, luxury king Bernard Arnault is still in 2nd place after losing the top spot back in July. LVMH stock down 20% from its highs, but he's still up $17 billion for the year. He and Buffett are now the only two non-tech names in the top 10. You could see a future where pretty soon it's all tech in the top 10.
Yeah. The wealth is just extraordinary. You obviously cover it very closely and so well for us, but I mean, the numbers are truly extraordinary. By the way, on Musk, does that include what we estimate his ownership of SpaceX is worth?
Yes, it includes all of it. John Oliver said that his gain this year was like winning a marathon after running 200 miles in the wrong direction because he lost $200 billion in 2022, and now he's ahead $100 billion.
And has it accounted for that huge loss of overall value in Twitter as well?
You know, that loss of Twitter, let's say it's down 71% according to that Fidelity markdown today. You know, it's like a rounding error on his 232.
He's lost more than we'll ever have, and he's still up there.
100%.
By a multiple of a million.
Every day he probably loses more than we'll ever have. So
that's all right. He's not that happy. Okay. He's just not. There's a storm going on.
He is.
Robert, thank you.
Thank you, guys.
Our live market coverage continues right after this.
The US to sell $80 billion in 4-week bills on January 4th to settle on January 9th.
Good Tuesday morning. Welcome to Money Movers. I'm David Faber with Leslie Picker. We're live from Post 9 of the New York Stock Exchange. Today, Citi's global economist Rob Sockin on a slowdown in global growth and why he still sees a U.S. recession.
Then conflict grows in the Red Sea with the arrival of an Iranian warship. We'll look at the impact for the energy markets.
And finally, Wells Fargo's Mike Mayo on why Citi's stock, that's Citigroup, can double over the next 3 years.
But first, a look at the markets. You've got the Dow turning positive, barely hanging in there. The NASDAQ down 1.8% currently, just a little bit off of session lows. Topping the tape for us today, flows in 2023. Global equities saw $172 billion worth of inflows. While that sounds like a huge number, it's actually the least amount in the past 4 years, despite the massive rally. Even in a down tape, 2022 saw larger inflows. Let's bring in CNBC senior markets commentator Mike Santoli, who can help explain this dynamic and why flows may not necessarily indicate performance in these broader markets.
Yeah, to some degree, Leslie, flows do chase performance rather than leading it. And these numbers from Goldman Sachs do show on an annual basis, really, investors are not overexcited about stocks. Now, I will say, because the indexes were up a lot, therefore the value of people's equity portfolios were higher, the market kind of did its work for you in terms of getting you further exposed to equities. On a shorter term basis, too, I mean, in the latest performance week, net inflows were the highest that they've been in 6 months. And then on about a 3-month rolling basis, I saw some data this morning suggesting we are at some extremes in terms of the volume of money rushing in to things like S&P 500 ETFs. So it all fits in with this idea of short term, the market seems like it's a little bit stretched and running kind of hot. Maybe should cool off. Maybe we get a little bit of a sentiment reset. But longer term, it doesn't seem as if people are fully all in or fully in greed mode. And the final point on that is, if you look at the Wall Street strategists array of targets for the S&P 500 for the end of 2024, the upper end of it is 5,200. Now, that would be nice, of course, for a lot of investors, but that's only a 9% gain from where we finished last year. And in general, in aggregate, the strategists see very little net progress happening in stock prices this year. You have some forecasting downside, to 4,200 or something like that at JP Morgan. So I do think that it's a little bit of people are getting more interested, but not yet over their skis.
Yeah, quite the dispersion in those forecasts. I know in your column over the weekend, you mentioned the $6 trillion in money market assets and this kind of notion that they could be fuel for the next leg of a bull market. But you say that that's actually ill-considered. Why is that?
For a couple of reasons, Leslie. First of all, retail money market assets are more like $2.5 trillion of that, as opposed to the $6 trillion that you hear mentioned all the time. A lot of the $2.5 trillion, as you know, is really just replacing bank deposits. It's sort of a cash substitute as opposed to money that's poised to enter the equity market. And in general, it's just in aggregate, not a huge number relative to the size of U.S. equities. Back in 2009 at the bottom, money market assets were half of equity market cap, S&P 500 market cap. Now, equity market cap is like 45 trillion or something like that, and you have 6 trillion in aggregate in money market. So to me, it's just not the place to look if you want to build a bullish case. Sure, people can put more money in the market. People can let their equity allocations go higher if the stocks do well. But I don't think that you want to necessarily hinge a positive view on the fact that people are going to be running out of money market.
Yeah, it sounds a little bit like what Kate Rooney was just telling us about people's bull case for Bitcoin this year. Just kind of a whole risk-on mentality there. Yeah. Mike, thank you. Our next guest expects a global growth slowdown and U.S. recession this year, but notes the soft landing possibility has risen and is keeping a close eye on consumer spending, supply chains, and Fed commentary. Joining us now, Citi global economist Rob Sockin. So you are in the slowdown camp, but soft landing, you think, is becoming more likely. Do you think that those Fed lag effects from, the historic hiking of interest rates, that they supersede the Fed pivot that has largely been kind of working its way through the various markets?
That's a great question. I think we're still seeing signs that those interest rate hikes that we had earlier in the cycle are playing through the system. I would point to still tightening credit conditions that typically you only see around recessionary periods. We're seeing growing strains among lower income consumers in the U.S., and that is another sign that those interest rates are really starting to play through. On the other hand, as you said, the Fed has started to pivot already, and maybe that'll start to work in the other direction against some of those strains.
Saw Chase asked, Morning Trader Podcast, how are you, brother? Who asked? Where did I see? I thought I saw Chase ask, are we going up? So if you want to know if we're going up, I don't think so. I think we roll still, whether that's right now or we retest above here and come straight back down on this half-hour trigger. We do have some flattening here, which is productive for bulls. This is good to see here for bulls, right? This is all good sideways, a little bit more sideways action. But we are still underneath the half-hour and hour trigger. So I'm going to expect any kind of move up to be rejected, even though this is constructive. You also have a cross that just happened down below over here on SPX. So draw your attention to this cross right here. You got the half-hour trigger crossing the hourly trigger just now. That can lead at times to a recheck above for that move down. And we are also still trading below the gamma flip on gamma. So still on, or I should say bears still kind of in control here to an extent, trying to trade and test and retest the daily trigger. We can recover here. If you want to get bullish and buy a dip, you are going to be looking for one of two things. Either a test of the daily trigger. That's across the board. That's on IWM, Qs, SPY, SPX, whatever. Or if you're trying to get long here as a bull for continued upside movement over the rest of the week, you are going to wait, right? You're going to wait for price action to get above the hourly trigger. Remember that we don't care how high that goes. If it's screaming high or if it just breaks above, doesn't really matter. What we're really looking for is that back test on the hourly trigger to go higher and be in safety once again. So if you're a bull, you are looking for something to play out like this, right? Here's your hourly trigger, right? You'd be looking for price to come higher here, squeeze up. Some form of back test. I always talk to you guys about a 3-hour look back with that back test as well. So if you see improved conditions, looking 3 hours in the past, that would probably be most of this morning. And then some kind of a pullback retest of the hourly trigger here, and then a resumption to the upside, right? Price goes higher. The moment you break that previous high after regaining the hourly trigger, you should see another pullback right here, and I would be jumping on long there. So bulls have some work to do, right? Is the point here is that bulls would want to see, so there's the 5-minute trigger right there. Here's the 1-minute trigger would be coming back up again, right? And you've got everything on your side at that point, right? You've got you got price above the hourly trigger. You've got the back check of the 1 and 5-minute trigger, 3 trigger bull cluster over here. And this is where you would actually make an entry for a long position on SPY in relative safety. You know, trying to time these bottoms and dips down here. I'm going to tell you right now that there's an easy open door currently for any kind of a rejection or just the test of that half-hour trigger to trade this daily trigger right down here, believe it or not. So you're like, hey, everything's awesome sauce up here. You get the rejection. Before you know it, on just that rejection, you are straight up just blasting down. And your real V-shaped recovery or buy was down below here. Now, if we do roll down to this daily trigger, you're then going to expect a one of two things to happen. Either some a ranged consolidation in here, V-shaped recovery, ranged consolidation. You could day trade, intraday trade this stuff, and then again wait until we get above the hourly trigger. Or this consolidation will turn into some distribution, and the hourly trigger will come on down here. The half-hour trigger come on down here, and we'll start selling and breaking the bull trend. So right now, if you're a bull, always better. Let me give you a better example of this too. So I can switch over to is that the trigger map for, so here's SPY right here, right? This is a full map on SPY, right? Let's look back here. This is November 2nd, okay? Price gets above the hourly trigger or the daily trigger, right? Has a successful back test of the hourly, loses the hourly, comes back above again and successfully retests. You make that money there. And to further that point, you're still above trend in this daily trigger, right? So everything is bullish still. Price is currently still above that daily trigger right now. So we are in a bullish context right now. But truth be told, you're kind of right now at this moment, if you're trying to buy a dip, you're trying to be this guy right here. Right? And here's like a failure. I was like, kind of. And the reality is you want to see the squeeze up and then the successful to actually take that long, okay? So this is where you start making real money in here. You can see it right there, right? The successful back test, not the failure back test. The other thing to be looking at here too would be if we are going to maintain trend to the upside, to be checking the hourly velocity. Always like to see this at minimum hourly velocity in the negative. Be trying to buy dips on that negative downside, and we're getting there, right? You see it right here. We're almost there, but still no higher lows on that hourly velo. So if we're looking for more continuation of the upside and the daily velocity, that's possible still. But we're just waiting for that last little bit, just a little tiny bit. Right now we're at minus 37. Because we're below minus 25, I would like to see the minus 50 on daily velocity at this point. No guarantees we get it, but there's a high probability we do. So for where we are right now in the market, my expectation here is going to be that we trade this up and test this S1 and this 30-minute trigger, and we're going to roll down here and likely get underneath this S3 and possibly even open on Tuesday down here at this 464.33. Okay, so this is the expectation at this point. If that expectation will change if at any point price comes above the hourly trigger, successfully retests, and begins to make its way higher from this previous high right here. And in all honesty, this one right here, I'd really like to see that one as well. Otherwise, we can become range bound, do some consolidating, or even some distribution. So if you're a bull, no real trade here for you right now. Nothing with a high probability of success is the key takeaway here.
Rebels in Yemen, just like they do Hezbollah and Hamas in the Gaza Strip. So this really is a ratcheting up of tensions, and one that could drag the United States into a broader regional war against the Iranians. Now, that could really be bad for just about everybody, and we've been seeing a lot of continued fighting, not just in the Red Sea, but also over the border between Lebanon and Israel, north of where I'm standing now, between the Israeli Defense Forces, the Israeli military, and Palestinian or Arab militant groups, namely Hezbollah, which is the most powerful anti-Israel militant group in southern Lebanon. So we're seeing this expanding, but there's also some domestic news here in Israel. Benjamin Netanyahu took a major blow just today when the Supreme Court decided to reject his legislation that would have essentially kneecapped the judiciary and kept them from making decisions based on a reasonableness doctrine. This was something that allowed the judiciary, judges, to essentially say that if a law that was passed by Parliament or some sort of measure that was put in place by the cabinet, that they called it unreasonable, they would be allowed to block it. Now, Benjamin Netanyahu and his unprecedentedly right-wing cabinet have bucked against that for the past several years. They had legislation that would have basically kept the judiciary from doing that. The judiciary, again, today, blocked it. So now Benjamin Netanyahu and his right-wing partners are going to either have to drop this legislation or come up with some new method to get past the Supreme Court, some new way of writing this law. But the fact is that this is dividing Israel more than it already has been at a time when it really doesn't need to be divided. Guys?
Yeah, Matt, and of course may have also distracted the IDF to a large extent as well. Thank you. Let's talk a bit more about where all this goes from here and what it's going to mean for energy. Joining us now is RBC's head of global commodity strategy, Halima Croft. It's good to see you.
Thank you for having me on.
There's a lot to keep track of. I'm curious, Halima, given your long experience, both in geopolitics as well, what are you focused on sort of as key moments here or key events?
I mean, there are really three fronts to pay close attention to. Obviously, what's happening in the Red Sea with the Iranian warship entering the Red Sea, the sinking of the 3 Houthi ships over the weekend. But the situation in Lebanon is also a really important pathway to potential escalation in the region. And we just had reports that there have been, some type of explosion that happened, in southern Beirut. The question is, are the Israelis now backing words with action in terms of taking more decisive action against Hezbollah? They have said that Hezbollah needs to leave the border area, comply with UN Resolution 1701, and if they do not leave the border area, they will confront Hezbollah directly. That would be something the United States would be very concerned about, but obviously that is a situation worth close watching.
Yeah, and what does it all mean in terms of the price of oil? We've seen some volatility this morning. Right. Obviously, we know the Red Sea. Iran is a huge provider as well. Where, and what are you focused on in terms of trying to determine what it means near term for oil?
Oil market participants are essentially saying, I will believe a disruption when I see it. So yes, you've had some run up in prices, but given the importance of this region in terms of shipping of crude, production of crude, it's not really reflecting the ratcheting up of tensions. I think so many traders got burned on Russia. So many people, when that war began, said, we're going to see significant Russian supply disruptions that did not materialize. And so now they're saying, look, we've had problems in the Middle East before. Tell me why this is different. I think it's materially different, but right now we've had no major disruption of oil supplies.
Yeah. Well, we're doing a pretty good job of keeping things supplied, aren't we? At 13.2 million, going up from there.
Exactly. I mean, this is the backdrop in terms of a well-supplied oil market. The U.S. production story was gangbusters last year. That has weighed on prices. But again, if we were to see something material involving Iran, I mean, the really important waterway to pay attention to is the Straits of Hormuz. And the Iranians have targeted tankers in the Straits before. They did it in 2019. If you saw any action in the Straits, that would be material for oil prices.
Why do you think this is so much different than what we saw in Russia and Ukraine 2 years ago? What is it that the market isn't really discounting at this point in time?
Well, I think the market is basically saying, tell me how this gets worse. And we look at the situation and say, we have 3 active theaters right now, which could basically lead to a broader conflict. We've talked about the Red Sea, we've talked about Lebanon, but we also have the situation in Iraq with Iranian-backed militias firing on bases housing U.S. troops in Iraq. You had these same militias firing into the Golan Heights over the weekend. And so again, Iraq is a major oil producer as well. And so I think the market is basically saying, we will wait and see till something happens, but it's really getting much more serious every day.
What do you think is the red line for the U.S. to have more of a direct involvement? Because so far it feels like there's a lot of, theaters, as you mentioned, and a lot of activity, but what is that line where they will be forced to act more directly?
The million-dollar question. I mean, certainly with President Trump, he drew that lead line as the loss of American life. Remember, that's why we killed Qasem Soleimani, the head of the Quds Force, the Revolutionary Guard. We don't know yet really what is the red line for President Biden. Now, if you had one of these attacks lead to a significant loss of U.S. servicemen in Iraq, would that be a significant red line? But the question is the U.S. even really in control of events? Like, that's why we say watch the situation in Lebanon, because the Israelis have said that they are not going to stand for Hezbollah staying on that border. They want to encourage their own internally displaced people to move back to northern Israel. So that is a flashpoint that I think bears very close watching.
Yeah, they've had hundreds of thousands of people who've moved out of that northern border area. Of course, Iran, it backs Hezbollah, which is far more sophisticated in terms of its
150,000 rockets.
Right, and its soldiers as well.
They are at the center of all three of these stories. And at a minimum, I think the question the Biden administration is going to face as we bring it back to oil is, are we going to continue to allow so much Iranian oil on the market? You talked about U.S. production gangbusters in 2023. We also saw rising Iranian exports as well.
How's the Iranian economy doing, though?
And the U.S. sells $68 billion
inflation,
in
a lot of
They've suffered with inflation, they've suffered with protests, but again, it's the same story with Russia. If you retain access to your most vital source of revenue, you can keep your activities going when it comes to funding your war machine and funding your proxies.
Halima, thank you.
Thank you for having me.
Halima Croft. Later on this hour, New York and California consider wealth taxes as revenues are drying up. We're going to look at what those proposals include.
Plus, we're keeping an eye on the cybersecurity names underperforming the broader market. The cyber ETF is down for the fourth straight day and on pace for its worst day since August. And don't forget, you can listen to any of our money-moving interviews on demand by subscribing to our podcast. We're back in a moment.
Also going to stop in real quick and give you one other thing. Let me see if I can take a look at this here. One quick second here. Oh, no. We're going to do JPM color. I can switch over here. Here's an updated JPM collar for SPX for Q1 of 2024. We did wind up popping the collar on Q3. This is a very rare thing to do. Last time we did this, I think, was in spring of 2020. Even so, whether we pop a collar or blast through the bottom of a collar, it's rare. It's like 99, 95% of the time you don't see the collar get popped. This one did get popped, but keep an eye on this in Q1. The expectation here would be that we'd come back down here into some form of support, fail to hit the magnet at 5015. This is the current magnet, by the way, whether you know that or not. But I think we fail this. This should line up somewhat with getting that all-time high that we failed to get on SPX into the end of Q4 of 2023.
At 11:30 a.m. Eastern Time, the U.S. sells $75 billion in 3-month bills, prior high yield of 5.26% and a prior bid cover of 3.07. The U.S. sells $68 billion in 6-month bills, prior high yield of 5.08% and a prior bid cover of 3.23.
So if you are someone that's looking for, you'll get that report today at some point today. That I think I released that report today for what to expect on the year that you'd be looking for. Matter of fact, this would come back up there and then up here into the first quarter and then come back up, and you follow that whole entire trend all the way up. But just keep an eye out on this SPX collar for JHEQ for Q1 of 2024. You can take a snapshot of that if you like right now, so you have it for your records into this quarter.
ServiceNow is up 75%, huge, hitting new highs all the time. There you see, down 3% today. Other sort of subsectors of tech did a little bit better. Even Shopify rallied rather nicely, and that was up notably. That's down about 5% today here.
Congrats on that Trader podcast. I just saw you post, man. Congratulations,
software, man. Names like Snowflake. Also had a great November and December, was up about 35, 36% on the year. There you see, down 4%. I mean, it's not a coincidence. They're all down 3 or 4%. And then you could switch this around a little bit and look at other things. Let me show you. Here's Norwegian Cruise Line. All the cruise lines and the travel stocks had a great November and December. They were up. Norwegian Cruise up 50% last year, getting down 7%. Carnival also down today. Big gainers last year tend to be down today. Then I want to just show you some other names that are out there. Consumer staples names. Tough times last year. We talked about Campbell's hitting new lows almost every day in the final quarter of the year here. And there's Campbell Soup up about 2%. Kraft is up. Altria is up. You get the idea here. These are mean reversion trades. Play the opposite side of what happened. A biggest example is just looking at the pharmaceutical names. Tom's got a pivot right here, but if you take a look at Pfizer, all of these names, Pfizer was down 40% last year. Rallying modestly today, same thing. Bristol Myers down 25%. It's rallying. Merck down big. It's rallying. You get the idea? Now, the problem, you guys know this, David, you know this, these mean reversion trades don't really work for any long periods of time unless conditions are perfect. You got to keep the interest rates low. You got to keep the soft landing going, and we'll see. Other than that, this is a fairly typical start
oil futures
to the
down
year.
by
Guys, back to you.
$1 to a session
Yeah, I
low of
guess if they lasted forever, they would just come back at neutral.
Exactly.
So we are thankful for that. Bob, appreciate it. Time now for a news update. Bertha Coombs has that for us. Bertha.
Hi, Leslie. Israeli officials say the country will defend itself against absurd genocide accusations at the United Nations highest court. South Africa launched a case against Israel at the International Court of Justice in The Hague. The filing alleges Israel's actions in Gaza were, quote, genocidal in character. It also asked for a court order to halt its military campaign. A former gang leader charged in the 1996 killing of Tupac Shakur plans to ask a judge to release him on house arrest. Court-appointed lawyers for Dwayne Davis say he is in bad health, does not pose a danger to the community, and will not try to make a run for it before trial. Davis had pleaded not guilty to the murder charge. He's been in jail without bail since his September 29th arrest. And a set of twins in South Jersey were born minutes apart, but in different years. older brother Ezra entered the world at 11:48 p.m. on New Year's Eve, while Ezekiel made his grand entrance at 12:28 on New Year's morning. Their parents say they're both thrilled. Boys are healthy, that both of them are healthy, and they now have a great birthday story to tell. And of course, that means, Leslie, that they can only take the child deduction for one this year and then take it for the new one next year.
Most importantly, for our financial audiences. And they also get their own birthdays, which is good, too. As a holiday baby myself, I can appreciate that. Bertha, thank you. Up next, Mike Mayo says Citi's stock can double over the next 3 years. He joins us right here at Post 9 to break down the bull case, plus his outlook for Morgan Stanley as the new CEO takes over. We're back in 2.
Bid cover ratio 2.71, 2.71. High yield 5.245%, 5.245%. The US sells $80 billion in 3-month bills and awards 89.75% of bids at high. US 6-month bill bid to cover ratio 3.06, 3.06. High yield 5.045%, 5.045%. The US sells $72 billion in 6-month bills and awards 59.47% of bids at high.
Welcome back. We're keeping an eye on the chip stocks, ASML amongst the biggest decliners. This after it was barred by the Dutch government from exporting some of its products to China. That move comes after the U.S. government tightened export controls on some semiconductor and chip-making tools to China. The move taking the rest of the complex down as well. You can see Marvel, Intel,
there was an ultimatum
and
from
Wolfspeed.
Hamas on
Actually, Wolfspeed's not lower, but the rest are, Leslie.
Yeah. Absolutely. A bull case from the desk of Wells Fargo's desk grabbing our attention this morning. The firm hikes their 12-month price target on Citigroup to 70 and expects the stock to double to over $100 per share. In the next 3 years, they expect EPS to jump due to efficiencies, buybacks, revenue gains. The analyst behind that call joins us now, Wells Fargo's head of U.S. large cap bank research, Mike Mayo. Mike, kicking off the year with a bang here. So the market, for the most part, has really discounted Citi's stock due to execution risks surrounding turnaround, some of the divestitures that they're working on. You think that execution risk that the market's concerned about is misplaced at this point?
Absolutely. To the investors that say that Citigroup is unmanageable, unquantifiable, and uninvestable, I say you're absolutely wrong. And we have a new 50-page.
Just a note here, we've got a nice gap to close above on HYG. Have a bear cross coming up on VIX on the 1-minute chart. Apple coming back to test a bull cross in the 1-minute trigger for an upside move. Dixie looking weak here with a bear cross on it. And NASDAQ trying to, or NDX at least, trying to form a bull cross to the upside. TNX looking like it's forming a bear cross as well. So the secondary sector indicators are all lining up for a bullish move to the upside. We'll see if it'll play out.
So they are becoming a much more simple and profitable firm, and I think that their earnings will double over the next 3 years. And as investors catch wind of that, I think the stock will catch a better bid.
So you're a Jane Fraser fan. Why?
I think fan is in context.
Okay. But I've heard you be pretty critical, unlike many other analysts through the years, of many CEOs, outspoken sometimes. And in this case, you seem to be supportive. Why?
Well, I'd say Jane Fraser is finally addressing the decades-old issues that have plagued Citigroup. It goes back to Sandy Weil and the acquisitions that he made. It did great for a while, but they weren't fully integrated. So now they're getting integrated 2 decades later. They pursued a global strategy of consumer banking. That was flawed. That goes back 2, 3, 4, 5 decades. So they're retreating from that. They're finally attacking their technical debt or their legacy infrastructure. And the matrix management structure that they've had for decades is finally going away to those 5 lines of business. So we can now talk about Citigroup like a normal company. So am I a Jane Fraser fan? I think she's moving in the right direction. It still waits to be seen whether she'll execute, but she can get a lot wrong and the stock can still go a lot higher.
But also the macro can go wrong as well, because they're doing this turnaround against a backdrop that's been, at least in the last few months, pretty favorable for the banking environment. But if there is some sort of recession, not a soft landing, but a real recession, I mean, they have a lot of exposure to cards, a lot of exposure to consumer, and they're becoming more focused on the U.S., which limits the diversification of other markets as well.
Well, I agree. So we have several scenarios in our 50-page report. The bear scenario or recession scenario, and this stock goes lower. There's no ifs or buts about that. But what kind of percentage probability are you putting on that? So we say 1/4 of the time, the stock, it could go down significantly. But the other 3/4 of the time, we think the stock does very well, a double in 3 years. And in fact, in our bull case scenario, 20-25% chance, the stock could triple over the next 3 to 4 years. So the upside when you're trading at 60% of tangible book value and you're moving in the right direction with better efficiency and returns could be phenomenal. So we're looking at it from a reward to risk ratio. That looks very attractive.
What is their core competency? I mean, you talked about all these businesses they're getting out of and things that they've been doing through the years. What are they good at?
So many investors ask us, why does Citigroup exist? And by the way, I was there during the global financial crisis saying, break up, not all the banks, break up Citigroup. And in a way, they've broken up themselves. But look, take 3 lines of business, services, banking, and markets. That's 60% of core Citigroup. 95 countries around the world. 5,000 multinational customers where they're looking to deepen payments, banking, and markets market share. That's very easy to understand. So the glass is at least 60% full. The other 40% would be that U.S. personal banking, credit cards. They're top 3. I'm not going to the mat defending that or not, but if we don't go in recession, that should be okay. And then global wealth is about 10%. That waits to be seen. I think Asia is stronger than the rest of the world, But I'll take the glass 60% full for a company that's trading at 60% of tangible book value any day of the week.
Huh. Notable from you especially. Before you go, I want to ask about Morgan Stanley, a different C-suite, because Ted Pick took the helm there, technically, I guess, as of yesterday, but today, first day, everybody's kind of back in the office. What are your expectations for his tenure at the top? What do you think his first priorities should be now that he's in that job?
Well, I loved reading John Mack's book, you know, when he's all in, and he talked about the first days of James Gorman taking over. And James Gorman, coming from the wealth management side, really had to convince the investment bankers that he had their back. Ted Pick, coming from the investment banking side, really has to convince the global wealth advisors that he has their back.
Interesting. Mike, thank you so much. Really appreciate it. Mike Mayo, Wells Fargo.
Thanks for having me.
All right, we're going to have a look at Barclays' downgrade of Apple. That'll be next. iPhone demand, of course, as you might expect, a key focus in that report. We will break it down. The stock, as you see, is down over, what is it down? Yeah, almost 3%. Plus, New York and California considering wealth taxes. This, as they've had a hard time with revenues in those states. We're back after.
Brent crude oil futures down by $1 to a session low of $75.88 a barrel.
Now. Barclays downgrading Apple. It's now an underweight at that firm. It is the focus of today's Tech Check with Steve Kovacs. Steve.
Hey there, David. Yeah, Apple starting the new year with that downgrade from Barclays. Not a good start. Shares falling about 3% or so. And Barclays really laying out the headwinds it's going to expect that's going to result in a tough March quarter. So here's the case they lay out in the note today, calling the iPhone 15 sales, quote, lackluster, especially in China. We know all the problems going on there, and says that weakness will continue with the launch of the next iPhone, likely this fall. And a UBS note also backing that up with November iPhone sales data, basically showing the same thing, a lot of weakness in the U.S. and China. Also saying no rebound in Mac and iPad demand post-pandemic. It needs to fall back to those pre-COVID levels before there's a recovery. And then on services, we've seen growth accelerate in the last quarter or so, likely going to be up 10% year on year for the December quarter. But that's because comps are a lot easier from a year ago, and Barclays expecting deceleration in growth in services throughout 2024 and even into 2025. Now, some reasons behind that: regulatory risks. DOJ is going to have a verdict pretty soon here against Google, and that puts the payments it makes to Apple at risk. We all know, of course, Apple pays billions, maybe as much as $19 billion a year, to be the default search engine on Apple devices. Plus, there's the Digital Markets Act going into full effect over in Europe, and that is a threat to App Store revenue. That said, Barclays expecting December quarter to be in line with expectations. Still, though, Apple's guidance for that quarter said sales going to be flat year over year after 4 quarters in a row of declining sales. And as for that March quarter, the quarter and now, Barclays now estimating below the consensus, hence the new price target, $160, or about 14% or so downside from where shares are now, guys.
Yeah, Steve, they lead the note sort of talking about iPhone demand and saying their checks in particular are picking up weakness of iPhone volumes and mix. I'm curious, given you cover it, this company closely, what you're hearing in terms of demand.
Yeah, this is the really tough one. It's all about China and the U.S. I mean, I asked Tim Cook about this directly, I believe last earnings, so about a quarter ago. And he basically said, smartphone demand is really tough right now in these most profitable markets, and we're not going to see enough of makeup in those emerging markets. We've been hearing Apple talk more and more about Indonesia, India, and so forth. It's just not enough to make up for the weakness, especially in China as things are opening up there. I also forgot to mention Huawei. There's a lot more competition coming online over in China because this new homegrown brand is making phones again after being out of the game for a couple years there, David. And we're seeing evidence that people are in fact switching, who had switched from Huawei to iPhone, going from iPhone back to Huawei, and that could continue throughout the years, David.
Yeah, you've got more competition, inflation creeping into the savings of Americans. Steve Kovac, thank you.
Thanks, guys.
The Downturns.
Hong Kong's Hang Seng Index finishing lower for the 4th straight year. The outlook for Chinese stocks is next. We're back in 2. Welcome back. Keeping an eye on Tesla this morning. The company reporting 2023 delivery numbers that came in above estimates, rising 38% year over year, bringing the total to 1.8 million. Wall Street saying the attention now turns to margins. Oppenheimer predicting we'll see moderate margin improvement considering supply chain rationalization, lower lithium costs, and improved efficiency. UBS saying that pricing action helped drive volume, which was margin negative, and going forward, they'll expect the Cybertruck will likely be a headwind. Bernstein's Tony Sacconaghi adds they believe Tesla will see lower margins and disappoint on volumes going forward.
China obviously very important for them as well.
China very important.
And BYD, the largest manufacturer now in the world.
Yep.
Dan Ives earlier with us talking about 2.3 million because Phil LeBeau had thrown it out there as a possible number for Tesla for deliveries for 2024. We'll see.
You got the, but to your point, you got the BYD competition. Also, the loss of that tax credit for some of their vehicles goes into effect Gen 1 yesterday. So we'll see what kind of an impact that has. $7,500 per car. So
it's not insignificant.
Not insignificant.
Not insignificant at all. All right. Speaking of China, by the way, let's talk a bit more about it. It's after a down year for Chinese markets in 2023. President Xi Jinping warned that, quote, on the path ahead, winds and rains are the norm, pledging measures to boost growth moving forward. That's after new factory activity data showed a third straight month of contraction. That was for December, and the latest sign of weakness in the Chinese economy. So what can we expect in the new year? Joining us now from Beijing is MSA Capital and Core Values Alpha founder Ben Harburg. Ben is also the portfolio manager of the Greater China Growth ETF. Ben, always good to get your take on things on the ground in Beijing. And so first off, what did you make of Xi's comments over the weekend?
They always try to manage expectations, so they're going to always under-promise and try to hit it or over-deliver. And so I think that they will manage expectations going into the year because they were perhaps over-exuberant last time around. But I think that they'll probably end up with about a 5% growth target, and they'll hit it. Overall, though, they want to make sure everyone knows this is not going to be easy.
Yeah, I mean, you would know far better than I, but it doesn't appear that many U.S. investors want much to do with China. And there I'm not talking about companies, I'm talking about individuals and the like who might invest with you. I mean, Alibaba is below its IPO price. We looked at that earlier. What is going on here?
It's a simple example of where fundamentals are being overwhelmed by narrative, right? And we really believe there's a re-rating of historic blue chip tech companies going on right now, the likes of Baidu, Alibaba, Tencent. These were historically proxies for the Chinese economy. And so a negative China narrative will weigh them down, all fundamentals aside. For instance, someone like Baidu has done more hours of autonomous driving than any global competitor. And yet, that part of their business isn't even valued in. So it's going to be par for the course for those big China blue chip names.
It's interesting, Ben, because a lot of the companies that are, rumored to be looking to go public, that are based in China, have kind of a global bend to them. You've got Shein, Ant, ByteDance, just to name a few possible contenders. When we look back to some of the previous Chinese companies that went public, like a JD.com or an Alibaba, those were more kind of China domestic names. What do you think the likelihood is that, there's broad investor interest and that these names can be successful in going public, given just the overall backdrop of what's going on in China?
Well, ironically, the Chinese have tried to mask the fact that many of these companies are Chinese, right? So many Americans today are buying products from an application called Temu. They don't realize that that's owned by Pinduoduo. Many global consumers didn't know that Shein was a Chinese business. Even TikTok kind of cloaked itself in Musical.ly when it first launched in the U.S. And so a lot of these are kind of seeping their way into the value chain, seeping their way into the hearts and wallets of consumers. And it's become a major narrative. It's something we've invested in for a long time. We believe Chinese, not just consumer-facing electronic companies, but now that hardware realm, the likes of BYD, even Huawei, Techno in emerging markets, from the hardware space, Xiaomi, all of these are now huge global players battling against their American incumbents. And they've been doing very well. And they're taking on, in the case of Temu and Shein, the likes of Dollar General and Amazon and Uniqlo and Zara. And so I think this is a major theme for 2024.
Yeah, Ben, I'm just curious always about your business. I mean, you're making the case here that perhaps things are not nearly as bad as they would appear. What are you seeing in terms of flows? How many investors do you have at this point? How do you approach that?
we all saw the data in terms of the outflows from China over the course of last year. For us, we think that's an opportunity. We think that everyone is run from the market from what I think are non-fundamental reasons. The actual financials in these businesses are sound. We've seen really kind of banded numbers. Our fund only launched at the tail end of last year. We're up 3% since that point. And we expect that 2024 should be a more robust growth year, given, again, how seriously the Chinese government, Xi, even in his statements kind of around the APEC and later, know that they must improve the economy.
And finally, Ben, I appreciate the fact that you are there in Beijing, unlike a number of managers of Chinese funds who, frankly, are over here more often than not. But what is it like in terms of your day-to-day there? Do you feel like you can ask tough questions? Do you have assets that you need to do the fundamental research you need to do?
It's freezing cold here to start. Beyond that, we feel like we do get that level of access. Obviously, we have a team of a large Chinese national team of boots on the ground. We're able to talk directly to managers, to the other kind of senior executives within businesses. We find that they're bad at communication, but if you dig properly, they're very happy to divulge information. So we feel like we get a very clear picture, both from the companies themselves as well as regulators, and we've been able to navigate that effectively. But as you said, it has to be done from the ground here in Beijing.
Ben, always appreciate it. Thank you.
Back here at home, New York and California are considering wealth taxes as revenues dry up in those states. Robert Frank is back with us here on the floor. What are they discussing, and why are tax revenues drying up?
So the markets were strong last year. Equity markets were strong. We talked about that, but the IPO market, deals, buyouts, private equity, all that stuff just cratered, and so capital gains income, where California and New York derive a lot of their revenue, just crashed. And so California is now looking at a budget deficit of $68 billion. That is by far the largest deficit they've ever had. New York looking at $4 billion for this coming fiscal year, with the migrant crisis probably adding another $12 billion over the next 3 years. So the question that they have, which they didn't think they would have so quickly after the pandemic, is, do we cut spending or do we raise revenue? They've tried to cut spending, but these are both progressive states with progressive legislatures. So the legislatures of both states are saying we want to raise taxes on the wealthy. California and New York both starting this time, which is unusual, with wealth taxes. So not taxing income, but taxing, in New York's case, unrealized gains. So that's if you had a stock run up last year, but you didn't sell any stock, and you have income of, let's say, more than $450,000, New York will look to maybe tax that. California looking at a billionaire's tax, taxing about 1% or 1.5% of total wealth.
Who's looking at this? I mean, is Kathy Hochul looking at this? She seems to be a little more pro-business, the governor of New York, perhaps, than others, or is the legislature? I'm just trying to understand how likely this is to actually happen.
Not likely. Both governors, Governor Hochul in New York and Governor Newsom in California, have said we can't lose more wealthy taxpayers to Texas and Florida, which we have been doing. And the fact that there is even debate about whether the wealthy are leaving just shows these legislatures are gung-ho on doing this. Now, remember, Andrew Cuomo said we will never tax the wealthy. The legislature kept pushing, and finally he conceded in 2021 to raise that top rate in New York State to 10.9%, which means the combined for New York City is over 14%. So again, the governors can push back, but they may be in a position, again, with deficits that large, to eventually cave on some kind of tax increase.
Yeah, the unrealized gains, that seems like a slippery slope in terms of getting pushed back. And
absolutely, I mean, it almost seems illegal, right? Wasn't there potentially court challenges?
There is a Supreme Court case, Moore versus United States, which will determine in some respects whether the 16th Amendment allows for a wealth tax. If the Supreme Court shuts that down, it will be harder, not impossible, for the states to do it. The bigger issue for the states is, if you have a wealth tax in one state, it's very easy to move to another state. If you're going to do a wealth tax, it has to be federal. And so it's going to be hard when that Supreme Court ruling comes this year. That's going to be the most important tax case in a century when we get that ruling. And Elizabeth Warren and all the tax wealth people will be watching that closely.
All right, I'm going to watch it closely.
Yeah, me too.
$100 billion New York City budget, over $200 billion for New York State. Just New York City's bigger than Florida, or around the same size of the budget. Robert, thank you.
Thank you, guys.
That's it for us right here on Money Movers. Let's go over to the halftime report.
All right, David, thanks. Welcome to the halftime report. I'm Scott Wapner. Front and center this hour, the year ahead for stocks, whether the best trade of 2023 might be at risk. We will ask the investment committee, making some moves today, too, you need to hear about. Joining me for the hour, Josh Brown, Liz Young, Joe Terranova, And Steve Weiss, check the markets. We are mostly lower. Dow has turned green, though. VIX up, yields up, oil up. Some of last year's biggest winners are today's biggest losers. Guys, I'm talking about the likes of NVIDIA, up better than 200% last year, down today. Meta up huge. Royal Caribbean, Uber, Carnival, AMD, Pulte, Palo Alto, for example, all lower. I feel like Weiss, we come into this year, the big question is whether it's time to trim across the board. After this massive run that we had from November, Cramer this morning said trim across the board. I don't care how great it is. There has to be some discipline. On the mega caps, maybe it's time for them to cool off. They're up so much, multiples are out of whack. I look at you today and I see that you've trimmed both Meta and Microsoft.
I have. And look, my views on those particular equities have not changed at all. The positions got almost irresponsibly large. I mean, candidly, they were over 40% of the portfolio because of the growth we've seen them. And while I would never get that large in names that don't have the underlying fundamentals and don't have the core values, the intrinsic value of these companies, I just didn't believe we were going to have the same experience. I still think they'll outperform this year, but to the degree that they did, you know, I don't think they'll do it this year. Now, I actually sold them on Friday and a couple others which we'll go through because I think everybody had the same idea as me. Joe and I were talking about it last week, and I said, you know what, in January I'm going to pare back. But that's what everybody wanted to do. So I took a look at basically you're putting off taxes for investors for a year. Then you've got the value of money, and it's, you know, like what's that worth? What's the trade-off worth? So I just thought, look, let me trim. They're now positions that I'm comfortable holding, and I don't see myself selling anymore. I don't view them as overvalued, particularly with the fundamentals that they still have and what's in front of them. So I wouldn't sell for the sake of selling. I wouldn't sell them down from core positions, but I just thought it was prudent to take some off the table.
But Josh, do we agree with Cramer that in terms of, you know, the mega caps, they were up so much? And you can love all the names. I mean, it's not like you're throwing shade on any of the names or the fundamentals behind it. But when an Apple's up near 50% and Microsoft near 60, Alphabet same, Amazon 80, NVIDIA and Meta, as you know, up just astronomical gains of last year, are the multiples now, in his words, out of whack? Do you agree with that? And is it time to trim across the board?
You can't argue that Apple is cheap based on its own history. You can't. That's not I don't hear any Apple bull saying the stock's cheap here. That's not the argument for owning it. The argument for owning it is you've got a ton of stability. You've got just insane, in dollar terms, amounts of cash flow. You've got the ability to buy back stock. And you have this wild card where when they launch the wearable, if it turns out that that's the dawn of a new era of hardware, maybe a lot of people who have been out of the name have to take a second look at it. That's the bull case for Apple. The bear case is simple. It's a 30 trailing PE, a 27 forward PE. Look back over the last 10 years, it averages 18. So it is almost double its long-term average multiple. And it's really easy to make the case, to Weiss's point, hey, I don't owe the taxes anymore for last fiscal year. Calendar rolls over. Maybe I'll take some off today. And the downgrade, I think, was perfectly timed to coincide with that. And I would also argue, you know, welcome to the new world. And in the new world, the activity of retail buying and selling almost doesn't matter in terms of day-to-day moves in the market. What moves the market is basically three categories of things. Number one, RIAs, the wealth management channel. It's 15,000 firms now managing a record $114 trillion with a T dollars. And what do they do at the start of every year? The centralized CIOs who control that amount of money, they do a rebalance. And what do you think they're going to do? The NASDAQ went up twice as much as the S&P last year. That's an obvious trim of NASDAQ, maybe add of Dow. And I think you're seeing that play out. Look at life cycle funds, another $3 trillion bucket of assets. What do you think they're doing? They're doing these same kinds of year-end rebalancing going into the new year. The other category I think is worth pointing out, 401k assets. You'll see a lot of the large 401ks automatically do these types of rebalancing trades. So it's not a shock after one of the best years ever for NASDAQ. We see NASDAQ names leak on the first day of the year. People put off paying the taxes, and rebalancing happening system-wide.
Right, Liz? I mean, the CNBC's Mag 7 index was up 107%. The tech sector, 56%, best year since 2009. You did have the Apple downgrade, which we'll get to in a second, but the sort of broad view of trimming winners and maybe looking at laggards, which is how this day seems to be setting up as we start 24.
Well, some of it, I think there's a couple things going on today in particular, and maybe that will play out through the week. The narrative at the end of 2023, almost for the entire fourth quarter, was year-end rally has legs, will continue, and then in January and February, maybe it conks out. And that narrative drives people's behavior. Steve sort of made this point before. If everybody else is going to start selling in January, well, I might sell too, just so that I don't end up on the wrong side of that. And then think about all of these names, just to make it general. If a name is up 130%, let's say somewhere between 100 and 130%, is that stock, is that company 100% better than it was a year ago? Or was that driven largely by a rate move, by inflation falling, by the environment that we're in, by the macro forces, in which case the fundamentals might be okay, the company's still healthy, maybe has growth potential, but it's prudent as an investor to take some profits and just do, even if you're doing a manual rebalance, rotate into the stuff, if you're bullish, that you think hasn't kept up, and make sure that you're deploying into things that still could win for 2024.
In terms of multiple expansion, not all mega caps are created equal either. Joe, let's be clear. Yes, a year ago, Apple's forward PE was 20. Today it's 28. Microsoft's was 23. Today it's a little over 30. Alphabet's was 17, it's a little over 20, and Meta's was 15, it's a little over 19, because it came from the worst year ever in 22 to its best year ever in 23. However, Amazon, for example, a year ago was at 46 times. Today it's 41. NVIDIA, people look at and say, oh my gosh, look at what the stock did. Multiples actually come in. It was 34 times a year ago, and today it's 24 times. So what do you do with those?
I think what you do with those is you analyze how you own these names, and you say to yourself, can I expose myself from a risk standpoint to what happened this morning between 6 o'clock and 6:35? And that's the Apple note drops, the S&P futures from 6 o'clock to 6:35 declined 36 handles because Apple's 6.9 of the S&P 500.
Right. So since we mentioned the downgrade twice, hold your thought just for 2 seconds. Let's just make sure everybody knows what we're talking about. It's Barclays today, downgrades it to underweight. They say it's time for a breather. It's the crux of the kind of conversation that we're having right now. The target goes down $1 to 160 from 161. Yes, they've had these consecutive quarters of declining revenue growth. So people are questioning where the fundamentals are relative to where the multiple has grown to. To Josh's point, you're well above the 10-year historical average.
Absolutely.
So just to get that on the table, everybody knows what we're specifically talking about with this downgrade.
And it's absolutely fair to look at the valuation, which Josh and everyone on the show has already cited, and understand the valuation is certainly richer today than it was 1 year ago. And what do you have to your benefit? You have to your benefit that fundamental conditions at the end of 2023 lined up in a way where you could talk about broadening out and rotating away from the Magnificent Seven, not rotating away in terms of ownership, but rotating away in the degree in which you own these names. And I think what's very clear at the end of the year and coming into today is that it's a crowded trade. We know it's a crowded trade, the Magnificent Seven. You're not going to capture 107% again in 2024. So you study your portfolio and you say to yourself, okay, how do I want to continue to own these names, but to what degree do I want to own these names? And I think it's, without question, it's fair to say to yourself, they're richly valued and it's a right time to trim them.
So what are you saying, like trim just a couple of percent across the board?
I
think that's the point that Cramer was making today when I think David asked him, so what do you mean trim across the board? How much are we talking about? 10%? He's like, no, not 10%, maybe a few percent.
That's a great question. And the response I have to that, as someone that is managing a fund, is do not be afraid. Do not be afraid about what happened last year. See, because last year, if you did not have the 6.9% exposure to Apple, you underperformed in 2023. All right, 2024 is here. I don't care. I'm not increasing my exposure to 6.9% in Apple, and I'm not going to try and mirror the S&P 500. I'm going to try and deploy capital in a way that identifies where's my risk exposure first, and to me, the risk exists in the Magnificent Seven having an extreme valuation.
I know Canaccord today, Liz, comes out and says that select mega caps have room for multiple expansion. So, you know, they're not looking at the list that we said and saying, wow, these are well above 5 of the 7 or whatever, or well above their historical average. Maybe it's time to peel those back. They're saying, no, we think that Meta, Google, and Amazon can their multiples are reasonable and they could expand further.
Sure, and stock picking will probably continue to be the technique of choice in 2024. When you talk about it, though, as a broad group and think about just multiples, we know this. I've said this, I'm sure, on this program multiple times. PEs are a terrible timing mechanism. You don't use them to decide whether or not you're going to buy or sell today. What they are good at is looking out over a 10-year time horizon and saying that if the PE is really high relative to its own history, relative to its industry group, it suggests that returns in the next 5 to 10 years are going to be muted. Doesn't mean they're going to be negative, but they'll be muted. So if you're looking for something that's going to outperform the broader group, you do want to be careful about the ones that are very obviously stretched, very obviously crowded, or very obviously dominating a broader market move.
I mean, Dan Ives today says NASDAQ 20,000 is his bull case. He thinks the tech could be up 25% in 2024. Now, that sounds tremendous, if only compared to this past year where they were up 50%.
Yeah.
But what about that optimism? Is for a back-to-back outperform? I mean, I think 25% would end up being an outperforming year.
Look, let's put it in perspective. Right now, you know, yes, the stocks had a phenomenal year in 23, but they had a horrendous year in 22. So a lot of that move was a reversion to the mean, to the normal PEs. Now, if you look at the historical PEs of both Meta and Microsoft, they're slightly elevated, no question. It's not unprecedented territory, particularly for Microsoft. But I don't see the market being up 25%. And that's basically what you'd have to see for tech to be up 25%. I think it's going to be kind of a muted year. I don't think the debate, personally, is settled about whether we go into recession or not. I don't believe there are going to be 6 cuts. I still think inflation is going to be somewhat stubborn unless we have a recession. So bottom line is, I think we're in, maybe, an 8 to 12% return in the market, which means that given the weighting, and Josh looks at this all the time, so it'd be great to get his view, the weighting of those mega cap stocks is still going to dwarf what the rest of the market does.
That's why, look, the Dow's at the highs of the day. Russell's gone marginally positive. S&P weighted down because the NASDAQ's getting
absolutely.
Smoked.
Absolutely.
Right?
Which is my point. So I still think that group, and, we'll get to this, but I still think that group will outperform. I just don't see the big performance because I don't see the reversion to the mean.
I'm wondering.
I think it's important to point out why these stocks have gotten the premium that they've gotten. And Apple is a really great case in point. Apple was not always an expensive stock. In fact, if you look at the period from the great financial crisis up until COVID.
Almost, if you stripped out the cash, it was like, what, 11, 9?
I think
10,
Icon
11,
was buying at 12 times earnings.
Yeah, like that.
Okay.
It was low double digits, mid double digits.
So you have this period, you have post-GFC. Let's start that in like 2009, heading into the pandemic. It's about 11 years. Stock average 16 times earnings. There were people making the case that it was expensive, by the way, during that period of time. Obviously, in hindsight, we know it wasn't because they delivered far in excess of anything that we ever thought any quote-unquote hardware company could actually do, especially when they started to de-emphasize hardware sales in their quarterly reporting and tell you about services. Okay, that was then. Here's now. The post-COVID period, Apple is averaging 29 times earnings if you look at every quarter. It all of a sudden got re-rated after COVID and has never reverted back. In fact, there was one quarter traded at 41 times earnings, December of 2020. So all of a sudden, we've decided that Apple's average PE should be, I'm saying we, the market, should be double what it was in the previous period. Why is that? I think the answer is consistency of profits. Apple's profit margins have been remarkably consistent in this last 4-year period, almost no matter what you threw at the company. Problems with China, problems with supply chains, problems with competitive threat. It almost did not matter, and that's why we value those services at higher levels than we would just value ordinary mobile phone sales. Margins grew at a 5% CAGR over that period of time. 12 quarters, you only saw 2 of those with contraction. That means margins were rising almost every time they reported. If you think that that materially changes this year, then you could argue for Apple to be re-rated downward. If you don't think that changes this year, I think there will be stability in the stock. It's not going to do performance-wise what it did last year. I think that's the most reasonable take to have. But there's no reason to think all of a sudden it's gonna take a nosedive just because the calendar rolled over.
So, Joe, if we think that there's going to be a reversion and some of these lagging sectors are going to be where the money's going to go, at least initially, as we sort of put the wheels to the ground, you know, in the new year, 8 of 11 S&P sectors underperformed the market. Okay, 8 in 2023. The only ones that outperform tech, comm services, and discretionary. You have industrials, materials, financials, real estate. Now, they were all positive. They still underperformed. Real estate, healthcare was flat. Staples, energy, utilities down. Do we see big pickups in those lagging areas?
I see a catch-up more than anything else. Look, if we're talking about another year in which all I needed to do was own 7 stocks to outperform the S&P and to look like an MVP superstar, okay, I'm going to have to live with that environment because that's just not the way I believe that you address a portfolio and you assume the risk. I think owning 7 stocks and concentrating in that direction is something that Warren Buffett could do, and he could do it really well because he's got the financial firepower. But I think the most important thing did happen in the fourth quarter with what we heard from the Federal Reserve and the relief that's being indicated towards areas of the market that were reliant on the cost of capital, and that cost of capital continuing to be a moving target was restrictive to those companies. So I think you embrace the broadening out that we saw at the end of the fourth quarter. I don't think you have exuberance towards it and say to yourself, okay, to Josh's point and to Steve and Liz's point, you forget about Apple. I'm going to own Apple. I'm going to own Alphabet. I'm going to own Microsoft.
Yeah, this is not a conversation about sell out.
Right.
It's about trim top.
Correct. Right. And I've said I believe that you can and should be trimming here because I think from a technical perspective, more than anything else, okay, forget the valuation argument. And I agree with Liz. I don't think valuation is a good indication of where something might or might not be going. But technically, you're talking about stocks. Look at these semiconductor stocks. The semi stocks are 20 to 30% above their 200-day moving average. Historically, the sweet spot is 11 to 15%.
Right. And the space itself, the SMH had its best year in 20 years.
Correct.
In 2023. 20 years.
And I have no issue with someone looking at that and saying, okay, let's reduce the size of our holding. I did exactly that. I sold out of some of my Broadcom several weeks ago, along with Uber and JP Morgan. I'm comfortable that I did that.
A lot of people do that. And what's so funny and what's frustrating for the bears, once they do that, they might sit in cash for a couple of days, and then they say, all right, what else do I buy? And yeah, they could go buy a small cap value stock. They could go buy you know, an $800 million publicly traded thrift bank. How long are they going to sit in that stock when it doesn't do anything? So these names get revisited later on when people say, all right, I tried the broadening out trade. I bought some other stuff. I picked up some biotechs. They don't have a phase 3 thing for 9 months. What am I doing? They go right back into the same 50 names that we've been talking about for the last year.
But
I think that's what the first quarter is going to look like.
But there's a simple exercise to alleviate that concern, and it's simple. You say to yourself, I'm selling out of something. Okay, what am I doing with the cash? Where am I moving into? What exactly am I buying? I know what I bought when I sold out of those.
That's exactly what I wanted to discuss with Weiss, because if we mention lagging sectors like healthcare, which did nothing, you sold out of Humana.
Yeah.
Okay, sold it. So part of my question, I want to know why, but what are you going to do with the cash?
Yeah, I mean, look, I sold. I wanted to take some losses against the gains. Humana, I went into as a trade, as you recall. And
as part of your profitable healthcare trade, which you were trying to ride for much of last year.
So I sold Humana on Friday as well, so I missed the move today. So, you know, you can't catch them all. But I haven't sold any United Healthcare. And, my intention is to come back to Humana. But first, I want to see what happens we're in a very highly charged political environment. It typically is a discussion during presidential campaigns.
Healthcare typically underperforms in a general election year for that very reason. Both sides are just teeing off on the drug companies and about prices, this, that, and the other, and that's why those companies traditionally don't do well from a stock standpoint in GE years.
But I think some of that underperformance, frankly, was pulled forward. The markets move a lot quicker. They discount a lot sooner. And it's been no secret they underperform in the election years. But there are no positive catalysts either. And then you've got CMS, which who knows what to do with rates. So I thought it was prudent. Bottom line is that it was a loser in the portfolio. I had gains. So how am I going to manage that? So that's why I sold it. I also sold Deere. Deere was a profitable trade, but that was just a trade. I was very clear when I went in. It did very well. Deere has been trading between like 370 and 400. So I caught it. I've caught it each time, and I want to get out of it. I don't believe, and that's because I don't believe the economy is as strong as narrative in the market. And so I want to take that profit off. So I just thought and I missed that. It's up a little bit today. So I just wanted to rebalance the portfolio a little bit. I didn't want to wait till when everybody else is doing it. Okay, so that just gives me optionality. So I'm sitting with a lot of cash right now. I do intend to deploy it, but if you take a look where I put some money to work, I did buy Taiwan Semi. That underperformed the other semis. I'm sure I'm nervous about what China's going to do. I don't think they're going to do anything this year or next year. They keep the dialogue going. I also bought TransDigm. I bought Textron about a week and change ago. So, those to me, the fundamentals are strong, and they've been strong, and they don't depend on the economy really accelerating, and they don't depend on rates, right? Those are fundamental buys. Textron, private jet market, still going very strong. It's not going to weaken. TransDigm, as I mentioned the other day, it's 48 separate companies. It's a private equity firm that trades in the public markets.
You said, moments ago when we were talking about the market outlook for this year, you expected it to be muted. I think that's the word that you used.
Muted relative to last year, but still historically basically in line.
Well, I mean, Oppenheimer, Liz, goes 5,400. They think this is, now we're starting year 2 of this new bull market cycle, and they call that target, quote, probable and even conservative.
That's aggressive to me. I think, it probably assumes, I don't want to put words in their mouth, I would imagine it assumes that a lot of the strength that we see right now, both in economic fundamentals and a lot of the price strength that we see in these bigger sectors, can continue and will continue. And there are a lot of contradictions going on, not only in the market, but in a lot of the economic projections that are happening. If we're expecting 6 cuts starting in March, that is supposed to happen at a time when the Fed doesn't even expect inflation to be at target by the end of the year. It's hard to understand the math of that. And then the math of earnings growth being 11% when GDP growth is supposed to be below trend for a period of time.
Yeah, but the Fed's been surprised on both ends of the economic and inflation spectrum as it is now, right? They didn't expect it to be down to where it is, and they didn't expect the economy to be up where it is.
Right.
So what their own projections are, sort of, you could take a little bit with a grain of salt.
Yes.
Trend would suggest that inflation's coming down fast enough for them to cut multiple times this year, quibble whether it's 4, 5, 6, or what have you. And then you also, if you think we're going to get to 5,400, think that the soft landing trade is definitely happening.
But here's the thing. If inflation comes down, that's great. If we get inflation lower than the Fed even thinks, that's great. The idea of stocks getting up to 5,400 or even beyond would suggest that the economy is still pretty strong. If the economy is still pretty strong, labor market stays tight, GDP growth is stronger than expected, they're not going to cut 6 times. And right now the market is trading on the idea that cuts start in March and continue at a steady pace.
We'll see. I mean, if inflation comes down close to target, they will, because I think they've made it clear at this point that they care more about inflation than they do the strong economy. They stopped talking about the economy being too strong. It's more like, well, he left you with the idea, Chair Powell, at the last meeting, that solely focused on inflation now. They don't want to snatch defeat from the jaws of victory.
Right. And if it does come down to target, they have more room to start talking about cutting. I still don't think 6 is going to happen in that case, because in that case, GDP growth is stronger. And a point that he made in the last meeting was, all it does is if the economy stays stronger than we expect, it just lengthens this process out. It makes it more difficult for us to declare victory. It takes longer. It doesn't necessarily cause a problem, but it takes longer, in which case I think you see cuts get pushed back
real
again.
quick. Yeah, and if you take a look, the market conditions have eased, right? So it's easing from the Fed, number one. Number two, just to give you the...
In a good way, though,
in a
right?
good way.
There's no credit issues.
In a market supportive
credit
way.
spreads are really, really, really tight.
Right. But I just want to put my portfolio in perspective. I'm still going to participate given my holdings in Meta, Microsoft. I haven't shaved Amazon. I haven't shaved Alphabet because they're big positions. So they're not as big positions as the others. So I'm still going to participate, but I do have cash to deploy.
All right, so let's squeeze in a quick break. We got some new ideas for your portfolio as well. Got a number of calls today. Committee positions are at play, and we'll do those next.
Store or Android.
Bunch of calls today on committee stocks. So let's start with Uber. Price target raised at Wells Fargo. Top pick 2024. Josh, they go to 74 from 64. Stocks had a huge run, as you know, and talked about on numerous occasions.
Yeah, look, I think this is one of the last great TAM stories. If the viewers remember, three to 5 years ago, we were obsessed with TAMs. We would talk about these companies with huge valuations and huge growth, and we would wonder, well, how big could this get? Like, maybe this is in some way justified. And we found out for most companies, it was not justified, but for some, it really was. My bet, this is one of those companies where the TAM opportunity justifies this stock trading significantly higher in the next year or two. I genuinely think mobility, whether we're talking about freight or people or moving food, delivery, whatever whatever category within mobility, Uber is number one in most markets. In some markets, it's number two. It already dominates. It has no real competition. And you're talking about like the last $1 trillion TAM. You also happen to have one of the best chief executives of any tech firm anywhere in the world. Dara deserves a lot more credit than he's getting for the turnaround here. This is maybe one of the best turnarounds of the decade. I think we'll look back and say, wow, that thing maybe could have looked like Lyft if not for some of the incredible moves that management made. And it was not the founder. he came in and cleaned up a mess before turning it. So I think the stock goes higher. I'm not selling. I'm holding, and let's hope I'm right.
Weiss, I know you don't disagree with the total addressable market idea that Josh puts forth. If you just look at plus 138.5% gain in the stock last year, you trimmed it.
I did trim it, so it's still a position. It was never a core position. I just don't think it's compelling to cheap now. If you look out over a couple of years, it gets cheap, right? It's going to be trading on a forward multiple 2 years out in the 20s, which is not expensive. Dara is one of the best CEOs out there. I agree, and I've said that multiple times.
What do you make of the capital return story that the analyst is putting out there?
It makes sense. I mean, they're buying back stock. They'll buy back a lot more stock.
They could buy back 20% of this market cap by 2026.
Right. I mean, well, that's become the base case for analysts now.
Yeah.
So it's something Dara's whispered to him and told him that's what we're going to do, and that'll support it. But it's also a question of the beta in my portfolio. So again, this is a portfolio management decision. I'm going to perform just as well if I believe what goes on with Meta, with Microsoft. Maybe not today, but that's not doing so great either today. So I like it. It's also got more consumer exposure that I'm really interested in. I don't believe in the freight story. We've done a lot of work on freight, and freight, that has to be extremely reliable. And the Uber drivers are not the most reliable, number one. Number two, you want to know your partners on a day-to-day basis, not get a new partner. So I actually think they'll probably exit freight rather than build a business there.
I took a little bit of profit in this name, but I disagree with you. I think, first of all, as it relates to the consumer, this is almost essential to the consumer, both professionally and personally now. This is a company that has absolutely reversed an awful culture with the founder. Yep. This is a company that now has established itself in a position where you're talking about free cash flow generation. And I think the last thing that a lot of people sometimes forget is if you are a portfolio manager and you're dedicating capital to particular sectors, where else in the industrial sector can you find 3-year revenue growth at 40%? The industrial sector, over the last 3 years, the revenue growth is 8%. This is an industrial name. It's in the industrial sector, and it's giving you 40% revenue growth. That alone is a magnet for portfolio managers to look inside the industrial sector and say, I want to be there. That's a growth name.
DC, but I don't look at things like that. You look at things like that.
No, you might
but
not.
I don't look at what's a sector, what's my weighting in the sector going to be.
Steve, I understand.
I'm not criticizing. It's a legitimate way of doing it. It's just not how I run. I look bottoms up fundamental. I look at which I know you do.
But acknowledge there's a tremendous amount of capital that does identify those types of opportunities.
Without a doubt. I think it's misplaced. It's really a technology company. It's not an industrial company, in my view.
I think it's consumer discretionary. I mean, it's all those
part, right?
It is a transport. That's why it's in industrials. Obviously, it's transportation. It also obviously is a tech company. But I think, look at the actual usage. That is consumer discretionary writ large. That is a consumer saying, hey, you know what? I feel like having a few drinks. Let's Uber home.
Which is one of the reasons why I sold it, because I think travel comes down. I don't think we're going to be at peak travel like we've been. So the consumer, look, their prices have gone up, and I just think the consumer's going to be more cautious.
Well, speaking of travel, then, Booking and Expedia, Joe, you own both, upgraded at Wells. These are stocks, again, Booking is up 73% last year. Expedia 69%.
Technically overextended, I will acknowledge that. Benefited from a summer travel season that defied expectations. 2024 bookings growth of somewhere around 4 to 5%. If that is achievable, the fundamental story remains in place. Does the market work off some of those technically overbought conditions? Wouldn't be surprised in the least bit, as well as with Airbnb.
All right, let's get the headlines now with Bertha Coombs. Hey, Bertha.
Hi, Scott. South Korea's opposition leader was stabbed in the neck today by an unidentified attacker. He was touring the site of a proposed airport when a man lunged forward with a knife. The attacker was arrested at the scene, and the opposition leader is said to be recovering in the hospital with injuries to his jugular. Police are reporting no evidence of terrorism in the fatal New Year's Day crash in Rochester, New York. The driver sped toward pedestrians in an SUV full of gas canisters and collided with another car. 2 people were killed and several more injured. Officials said the suspect died Monday night from injuries sustained in the crash. And Wonka ended the year in the top spot at the box office. The musical starring Timothée Chalamet collected an estimated $24 million over the New Year's weekend, bringing its total domestic earnings to more than $142 million. Box office sales in 2023 reached $9 billion, which is a post-pandemic best, no doubt helped by Taylor Swift, as was everything in entertainment last year. Scott?
Yeah. All right, Bertha, thank you. Bertha Coombs. Up next, Bitcoin. Breaking out to start the new year. Will one of 2023's best performing, actually the best performing asset class, have an encore in 2024? We'll debate it next.
OPEC output rose 48,000 barrels per day last month to 26.53 million barrels per day.
Protect your trades from macro headline risk with financial
CNBC.
Now only $99 a year.
All right, we're back on the half. Bitcoin breaking out to start the new year. So will the best performing asset class of 2023 see even more gains in 2024? Let's get to Kate Rooney now for our report. Hey, Kate.
Hey, Scott. Yeah, that's a big question. So Bitcoin's new bull run, it's being driven by two potential catalysts. So hope for an ETF approval and then something called the halving coming up this spring. So for that long-awaited ETF, the SEC now has a January 10th deadline to approve or reject the Cathie Woods ARK and 21 shares application. Reuters, though, reporting that the SEC could notify issuers as soon as this week on that. Then there are dozens of applications out there, including from heavy hitters like Fidelity and BlackRock. If approved, an ETF could lower the barrier to entry to buy Bitcoin. So some are arguing that that would bring in a wider range of investors and then potentially more institutional interest. Others now say that the upside may have already been priced in at this point. Then you've got something called the Bitcoin halving in April. That's where the new issuance of coin gets cut in half, hence the name halving. It's a way to keep the cap on Bitcoin's supply. And the other driver for Bitcoin, Scott, is the same thing driving tech, falling interest rates, and then some of the return of risk appetite among retail investors. Back over to you.
Yeah, let's talk to some retail investors. Kate Rooney, thank you very much for that report. Weiss, you've been long Bitcoin?
Yep.
So what about now?
Well, this one I trimmed also on Friday, you know, a day too early. Look, I don't believe in Bitcoin. I still see no use case, no end market for it. It's just a speculative market, but that's fine. I'm just not a believer. If I were a believer in Bitcoin, I wouldn't have shaved it. So I basically cut it almost in half. And the reason I did was I think the news is priced in. So you get the approval for the ETF, and then maybe you sell in the news, because I'm not the only one that bought it in expectation of ETF approval. And that's been the move from 28,000, which is roughly where I bought. I bought almost all of it under 30 to where it is now. Now, the other issue that I had with it is that what if it doesn't get approved?
Well, I was thinking that. What if it doesn't?
What if it doesn't get approved?
Surprise,
and then it's toast for a while, so it'll recover because they're just true believers driving. And the third thing is, you don't need an ETF. An ETF is great for multiple positions, but you can buy this, Bitcoin. Now, there'll be a crypto ETF, but as far as Bitcoin goes, it's very easy to buy. You can buy it with no commissions on Fidelity. You can buy it in Robinhood. You can buy it everywhere. So I don't know what an ETF does for Bitcoin itself. Now,
well, doesn't it theoretically open it up?
It does.
To a larger
because people are so used to buying ETFs at this point. There'll be more demand for it, without a doubt. But my point is that I just thought it was prudent for a non-believer to take a lot off the table and book the game.
To your point, the last big approval, quote unquote, that everyone was waiting for was futures. Yeah. And that ended up being a negative catalyst. That actually was the top. In 2017, December of 2017, in Chicago, they started trading futures on Bitcoin. A lot of people in the lead up were saying, oh, this is so bullish. Actually, that enabled a new level of price discovery. They shorted it to hell, and it collapsed to 11,000. So just because we have this catalyst in front of us doesn't guarantee, all of a sudden there's going to be this buying bonanza and there won't be sellers. There'll be plenty of people utilizing the ETFs to express bearish bets. I think those will be overwhelmed in the opening weeks.
Yep.
But I agree, a lot of this is priced in. And by the way, this ain't even going to be that great of a business. No. BlackRock and Fidelity will carve it up. It'll probably be 25 basis point business inside of 18 months. This is not going to be 1% ETF internal expense ratios as far as the eye can see. And there aren't going to be 10 winners. And the only evidence I have of that is 30 years of publicly traded ETFs. There are not 10 SPYs. There are not 10 oil ETFs. There are not 50 different versions of the gold ETF.
There are not 10
it's
Joe
one or
T's.
two.
But just in terms of full disclosure, I may sell the rest of it before that January 10 deadline. I just don't know. I'm still thinking about
One of the reasons why the futures failed the way they did is because the extreme volatility didn't marry itself with what the clearinghouses were going to do on margin requirements. So the margin requirements on the Bitcoin futures were so extremely high. You had people that weren't able to utilize the futures market in a way in which they could leverage positions like they do with bonds or agriculture or oil. The clearinghouses really did a good job in managing the risk and the volatility and placing a strong barrier to entry using margin.
Let's squeeze another break in. We do have bank earnings to look ahead to. A lot of love for Citi today. We're going to talk about that as we look ahead to earnings and what the street is saying about the stocks they like the best. Back after this.
Citi.com.
All right, let's talk some banks because we are looking ahead to earnings. I said, Liz, a lot of love for Citi today, which we can do specifically separately. But what about this group, which we said was up 10% last year? It's green today. It's green today as well. So it's part of that. Is money going to go into other areas trade?
I think it is part of that. I like financials as a whole. And when you look at some of the things that obviously happened last year, they lagged the broader market. Positive year, but lagged the broader market. So the rotation trade is a bit of a tailwind. But then thinking through even the first half of 2024, if things go as we expect or as the market expects, front end of the yield curve comes down as rates start to fall and as the Fed cuts rates. But if the economy doesn't falter terribly, you've still got a cyclicals trade that's intact. You've got the front end of the curve coming down, maybe a re-steepening of the yield curve.
Okay, so net interest margin does
intact.
Better.
That's right.
For the banks, if that
Citi is kind of its own story, though.
Right.
Citi,
yeah, well, they've done a lot. Let me just read these two calls real quick. I'll let you riff on that. Mayo over at Wells, we expect Citi to double to 100 plus over 3 years. Raises the price target to $70 from 60, reiterates overweight. Bank of America names it top pick for Q1.
Yeah. If you know people that work at Citi, you know they have 5 bosses and they are the boss to 5 rungs below them. They just had this bloat. All banks do, but really a legendary amount of bloat. And they're cleaning it all up. And it took a few generations of new CEO. But now, finally, it looks like they're actually cutting into what they should have been cutting into all this time. And it's probably not popular internally. And if you're a shareholder, you're not necessarily like rooting for people to get laid off, of course. However, there was overhiring. They were in too many businesses where they were number 3 or number 4 in that business. You just can't afford to do that anymore. It's a very competitive world, very competitive sector. So they're doubling down on the things they're good at. They're getting out of the things they're not good at. They're reducing headcount. And I think ultimately they have a chance to distinguish themselves from the other big 5 or 6 banks for the first time in years because of how extreme this overhaul has become, and extreme in a good way. So I haven't really followed the stock closely, but now I'm starting to because I'm liking how the fundamental news is matching up with the technicals.
Unless, Weiss, you know, this ends up being the catch-up year, let's just say for a Goldman and a Citi, which were outperformed by, at least from a stock standpoint, things like JP Morgan, which was up 27.5%. You have Goldman, and there's optimism, certainly from you and others, about that stock going forward, and then Citi is in that group too.
Yeah. So Goldman, I mean, it's had a nice, last quarter. As the calendar opens up, and I do think it will, still most bankers I talk to believe it'll be the second half of the year.
Like capital markets, Cal, you're talking about.
So IPO, secondaries, and of course M&A will pick up as rates come down. In terms of Citi, think about what Jane Fraser did. The easiest thing for her to have done would have been to come in there, right, as soon as she started and saying, we're going to cut this. Efficiency stories are not just about Meta and big cap tech. It's also about every business. But what she did was she said, I'm going to take a very measured approach. I'm going to really learn about these businesses. Strategically, I'm going to decide which are important to us and which aren't important to us. We're too bloated. I'm going to cut back on that. So that's what she did. So she's to be commended for taking a very, very critical eye to the business over a long term rather than knee-jerk reaction. So he's CEOs.
Hey, that's why Farmer Jim loves that stock. That's why it's the one.
So I do too, and I buy it. And one of her key lieutenants is a guy I know very well, Tyler Dixon, who runs banking, all of investment banking, and he's phenomenal. He's one of the best on the street, and also is himself a very good strategic thinker. So I think it's a good story. I'm sorry it's moved up because my intention is to buy it, and I still will. I'd like to sell back a little.
All right. So up next, Mike Santoli. He joins us with his first midday word of the new year. We'll do it next.
to learn more.
Senior markets commentator Mike Santoli with his first midday word of the new year. Happy New Year to you. And today really tees up the question of this early part of the new year, whether you're going to see continued selling in mega caps and the big winners and some of the buying of the perceived losers.
Yeah, it seems almost a little bit too tidy that we see it so stark, continuing like it is today. It seems like a little bit of a first day of the tax year shakeout. So I'd like to see how it develops. My main working premise is I doubt this year is going to be quite as stark about either it's the 7 or it's the 493, either it's the mega caps or it's the small caps. But we'll see how that goes. The other thing is pretty encouraging. You've gotten some internal bid in the market over the course of the morning. So clearly people didn't take the weakness in the biggest stocks to say that somehow the tone has changed overall.
Yeah, I mean, just seeing the VIX, which was up, I don't know, 13, 14%. That's the fever's come off a tiny bit there. Russell had some buying there. It's up a 0.25% or so, and you have some money moving to the Dow. So about half the sectors in the S&P are up.
Yeah, so it was a little bit of mechanical open. I think I heard you say something about a percentage move in the VIX there, but that stuff sounds like static in my ears. But yes, you did have that kind of after a big long holiday weekend effect, a little bit of a bid. So it's wait and see. I'm just interested to also see if yields really do have any lift to them. So far, it's a modest move.
You were confused that you thought I said percentage move in interest rates.
Yeah. Exactly.
Your other pet peeve. I'll see you on closing bell. Mike Santoli. Finals are next.
Sit.com.
We're going to kick this market around on closing bell, 3 o'clock Eastern, and I hope you'll join me then. Dan Greenhouse, Lauren Goodwin, and then one of the biggest bulls of 2023, John Mowry, is back with his look ahead for stocks. I'll see you all then, a couple hours. All right, final trades. Mr. Weiss.
TransDigm, for the reasons that I said, is just a steady performer, should do well in this market.
Okay, Joey T.
Goldman Sachs looking very attractive to me.
Really? Interesting. All right.
Looks like the veal palm on Christmas Eve.
Liz Young.
Ooh, yum. Financials, for the same reasons I already mentioned, plus some M&A activity pickup.
All right, Josh.
Joe distracted me by saying veal parm at lunchtime. PayPal, look at it. It's green.
All right.
What's not to love?
All right, good stuff. The exchanges now.
IMF chief says the Fed is definitely achieving a soft landing.
Thank you, Scott, and welcome to the exchange. Happy New Year. I'm Kelly Evans, and here's what's ahead. Rising rates are pressuring stocks again and putting that historic win streak in jeopardy. The 10-year yield briefly back above 4% this morning, and our strategist says higher for longer is still very much in play. Will rates spoil the party in 2024? And if so, why is crypto shrugging it off today? We'll debate. Meanwhile, rising tensions in the Red Sea pushing oil prices higher overnight. Shipping giant Maersk says they'll continue to avoid the area. Are we on the brink of a multi-front war in the Middle East? Atlanta Council CEO Fred Kemp weighs in. Plus, Barclays downgrading Apple to sell. It's now the 4th firm with a bearish rating. We'll tell you why as the stock drags on the whole tech sector today. But first, let's start with the market action, and Dom Chu has the numbers. Hi, Dom.
Hi, Happy New Year, Kelly. Decidedly more negative for certain parts of the market than others, but the down parts of the market to the real downside are the leaders from 2023. So specifically the NASDAQ Composite, which was the outperformer among the major 3 indices. The composite index at 14,770, down 240 points, 1.6% to the downside there. So again, tech, comm services, really the laggard so far today. Meanwhile, the S&P 500 is down about 25 points, 0.5%. Those technology stocks weigh there as well, but it's generally a little bit less severe here for the S&P 500. And by the way, we're right in the middle of the trading range so far today, and the Dow Industrials outperforming up about 0.25%, 65 points to the upside, 37,755. The key mover in the S&P 500 today has been one of the biggest underperformers over the course of the past year. We're talking about biotechnology firm Moderna, most known for their COVID vaccines, mRNA technology. Well, it's up 14% today, making it by a factor of almost 3 the best performing stock in the S&P 500 after analysts at Oppenheimer upgraded that stock, put another price target upgrade on that thing, saying that basically COVID vaccine sales are showing more visibility down the line, and more products coming out in the next few years will help Moderna's bottom line. So Moderna shares up 14%. But remember, on a 1-year basis, still down about 37%. And then the interest rates that Kelly mentioned. It's important to kind of show you some context on where we've been, where we are right now. The 10-year note yield currently at 3.95%. As Kelly mentioned, we briefly ticked above 4% at some point. But remember, the cycle high is up here, 5%. We've been on a pretty decent downtrend ever since. So even with this move, though, it's still a rates-driven story for 2024, just like it was in 2023. We'll see if the Fed, and when it cuts, becomes a huger issue down the line. Kel, I'll send things back over to you.
All right, Dom, thank you very much. Dominic Chu. Stocks are sitting on huge gains on expectations of deep rate cuts this year. But my next guests say the Fed may not be as aggressive as investors think. Joining me now, Greg Dacco is chief economist at EY, and Jordi Visser is president and chief investment officer at Weiss Multi-Strategy Advisors. Welcome to both of you. Jordi, welcome to the program.
Thanks, Kelly.
I don't want to jump too far ahead here, but I know that you're a big fan of Bitcoin and crypto and some of those asset classes, and this is definitely the day to talk about it. Before that, though, maybe just explain why you don't think the fact that the 10-year went back above 4% today why is that happening at the same time that crypto's taking off, or are these just kind of January 1 positioning quirks?
Yeah, I'd like to see it go down there, too. I really want to see it go down there, mostly to clear the boards. I'm not really completely bearish here. I am into March, but I'd really like to see just a reset here. Now, if you look over here, if it happens, if it does happen, here's 4 o'clock right here. So you got some kind of a get underneath this previous low. Hold on here. You can see this little bottoming action right here, right? Now you might get your V shape, but it'd be nice to get underneath here. You get underneath here for the close. slam it down into 4 p.m. at that S3. And then, like maybe on the open on Tuesday, turnaround. Don't forget that turnaround Tuesday, right? You get that bloodbath down to the daily trigger. You wake up Tuesday morning, and it's a fresh start for the week. And you can buy the dip for this week. I'm not really like ultimately bearish, like doom and gloom. It's gonna take the quarter. If you are doom and gloom, it's likely gonna take some time to get down there. You're talking, 3 months here. Got another, 2.5 months to get down to where you really want to be for a quarterly low. Yeah, I know. Stocks only go up. I do want stocks to go up. I want us to go up there. I really want to see the truth is here, I really want to see SPX nail that all-time high. We got it on ES, we got it on SPY. So it's there. A little bit of the idea here too is if you're a bull, right? Think about this from the sense of logic. If we get the all-time high on SPX, we likely sell, right? So a little bit of cooling off, give some room to make it worth going up there to get that all-time high on SPX. So that if we do get a roll down, you guys know what I'm talking about here. You got some people out there that'll push it telling you we get the all-time high on SPX, and then we're going to 6,000 by March 1st, right? The reality is there'll be some kind of exiting at that point. So, or exiting the market at that point. So just be like, if you're a bull out there, just have some spatial awareness as to when does that sell come? Does it come today? Does it come in a few weeks or whatever? Yeah. Today's Tuesday technically, but it really is tomorrow. You have a shortened week of trading, so you've got turnaround Tuesday, what the fuck, Wednesday. It all gets compressed into a 4-day period. So that would be the idea behind waking up tomorrow and seeing more down in the morning. What's that you're saying there? I want to see all-time highs and proper fake out the daily to suck all the SPX 500. Yeah, I don't think you're getting the 3,500 this year. It's possible, but the mechanics are not on your side for that to happen. You're more than wait till you see this report, but history is not on your side to see that 3,500. And not only the 3,500, but a lot of the chance of that even coming is, if you are bearish, 38 is a very high probability. Or if you want like the law of probabilities, you lost 3,500 recently. So you're higher now. You're likely more around that 38 to 3,900 for if we even get that low. But even when you do, you need the mechanics of, you need the bounce off 2% inflation. You need the unemployment rate running up to 4 to 6%. You need cuts for even that action to take place. So you really do need that mechanic to kick in. It's possible, but you need some stuff on your side or something unknown to the marketplace. But as far as the bulls, like the bulls, the thing that makes me scratch my head here with the bulls is, they want up today on the first day of trading day of the year. And they want to tag that all-time high in SPX. But you're going to get an algorithmic auto sell the moment you do. So if you're a bull and you are looking for that all-time high in SPX, for where we are at this moment, it would not surprise me to see some kind of a pullback to get that all-time high, or a failure of a brief tick below the all-time high to get up there and do it. And usually you want, for that run, it's like 150-point pump, pullback, 150-point pump, pullback, something more like that. We didn't get it done, right? We didn't get it done in December, so I would expect another need for a pullback to get up there and get it done. Now, if you are feeling frisky, if you are feeling bearish out there, you do want to see that break of the daily trigger, and then you want to see the rejection. You want to see that blood and that doom and gloom. You want to see price break that daily trigger, right? You see that daily trigger break, and then if you see, 2 failures by bulls to recover, and that hour starts to cross below that daily trigger, we'll start a correction, and we'll really put some gas on there. Let's take a look at both really quick. So the idea here would be we need to get price down here, right? Blast down. Here's that daily trigger, right? You'd want the rejection, 1, 2 rejections, get that hourly coming down, pick up the cluster, and then you can really start talking about some significant downside to 445 would be your next target. Next target after that is 418. That's 418.53. The market doesn't technically become very bearish until we get underneath that 418, 419. Just a heads up, that's where you are and that kind of stuff. And you might actually see one other note here too would be in this time of year, you see that, look at this right now, watch book map, we're got a little bit of a break going on. But I want you to also be aware of something else here, which is, and this is very usual, very common for the time of year we were in. See how much room there is for SPY to fall and how little room there is for Qs to fall. So this is a 30-minute chart on SPOOs, but SPOOs doesn't have too much room left to go down here. If you look at this bottom chart down here, you would actually, it's very common around this time of year to see Qs nail that daily trigger and immediately move, and SPY will be left behind kind of consolidating and maybe even going a little bit lower, right? So if you do see that happen, let's say you see at any point this capitulation take place, you'd probably, if you were a bull, want to long Qs, and would not shock me to see SPY, SPX kind of spend some more time lower rather than bouncing higher. You'd see the risk on come back into effect quicker on Qs than SPX. Yeah, there's some open interest down there, Chase. Is that OI already on bot puts, or is it on calls?
I think overall they think that's the only way that one returns to a path that both counters Iran, supports Israel, and builds upon normalization in the region.
Do you think that these sanctions on Iran previously were effective in?
I saw that, Bork. I gotta get back to work. Good job, Bork, on the half hour. Yeah, this is a thing too. If you guys, so the reason I don't,
that
So the reason
Iran
I keep
has
the 30-minute trigger
its near
on here is
weapons-grade,
because
uranium.
if we like
within
start,
days of being
what
able
I've
to create a
noticed
bomb.
is
So
that
not
if we
only
start
are
a
they creating all
roll
this
on the
havoc
hourly
in the Middle
trigger,
East through this war,
fucking
at the
bears
same time, in the
love
global
selling
sense,
on
they've
that
become more
30-minute
dangerous,
trigger,
and
man.
they're
That first
growing
roll
closer
down
to
for like
China,
the
they're
first
growing closer
downside.
to Russia, supporting
Hold
Russia.
on here. So I leave that 30-minute trigger up there because whenever we sell, let's say we're riding trend on the upside on the hourly trigger, right? Yeah, we're going up, we're going up, we're going up. Every time we break down below that hourly trigger, fucking bears, man, they will hit that half-hour trigger sell like 3, 4, 5 times in a row, real hard and heavy over the course of 2 or 3 days. So, Bork, if you took those calls off on that half-hour trigger touch, congratulations, brother. If you are a seller, matter of fact, I got to write that down because we're doing trading videos. But if you're on sell side, whenever we do start selling, that half-hour love bar, that we call it the half-hour love, I think we call it the love bar or something like that. If you're a seller, man, the sellers fucking love that trigger on the down on the first leg of the down. Whenever we have a downside trend change, they fucking love hitting it. Like it's like repetitive, like 2, 3, 4 times. All right, I gotta go. That's what it is, the gray bar of love. The gray love bar.
And as we head to break, here's a glance at the markets, which are hanging on to green territory for the Dow by 47 points. The S&P is down 0.5%, though, and the Nasdaq's down 1.6%. We'll explain what's going on with some of those tech names shortly. 10-year yield back down to 3.94, still up considerably from last week. The exchange is back after this.
This is The Exchange on CNBC.
$78 counterparties take $704.864 billion at the Fed's reverse repo operation.
Welcome back to the exchange. 2023 was the first positive year in 3 for gold. Prices are still sitting near their record highs set in early December. And my next guest says the streak can continue, but he really likes the miners here as well. Joining us to check the charts is Carter Worth. He's the CEO of Worth Charting. Carter, it's good. I would expect someone like you to be poo-pooing the miners trade. I'm surprised you're into it.
Well, sometimes there's something that's so out of favor, so under-owned, you can use any sort of expression one wants, that it's right to, I think, take the road less traveled. Miners are perennial underperformers. In fact, just a statistic that's interesting, since the launch of the Philadelphia Stock Exchange Gold and Silver Index in 1979, it was actually 45 years ago, January 19th, 1979, gold miners are basically unchanged. I mean, which is shocking. Obviously, a tough business.
But this is my point. It just sounds like it's a bad business that only fools would want to get involved with.
You dig the deep hole. You dig back. Guys get trapped in the hole. Sometimes a lot of bad stuff. But the point is, the spread right now with gold itself is pretty extreme. So we have gold making, and we think gold's going a lot higher, at least from our point of view. And so at some point, again, you're talking about a fairly small asset class. Now, if you think of this, all stocks in the Philadelphia Gold and Silver Mining Index add up to about $296 billion. That's the same as one Costco. And so they're largely a SMID-cap phenomenon. And if you see here on the screen, right, on a 10-year basis, gold miners and gold bullion are dead even. But that first chart that was up, that shows going back on a 40-year basis that gold miners are basically unchanged. So the situation, I think, is that not only the miners having lagged general equity market to a substantial, they've lagged, and shown here, they've lagged the underlying metal. So at some point, you do get these sort of pops or catch-up trades. And I think that's what we're looking at as an opportunity here in 2024.
And having laid it out that way, I can't imagine this is anything. So do you have a price target in mind for getting out of this trade? Because it sounds like this is one of those maybe 3, 6, 9-month opportunities and nothing that you'd be really interested for the long run.
Right, and hard to know, but any long run thing, you got to start with 3 months, 6 months, and then you kind of stick with it if it's working and so forth. But GDX is the vehicle to use. Of course, that's the most liquid of all sort of mining ETFs, and there are several. This is an interesting chart, not because I made it, but it's because it tells a story, right? This is a ratio chart. It's gold miners divided by the market, SPY, to ETFs. And so what we know is that the relative performance is poor, but we keep holding this level for about almost 10 years. And I think that the word developmental is appropriate. This is curative healing. The arrow speaks for itself. Of course, that's a judgment, mine, but that's what I'm thinking.
So quickly on gold itself, being bullish on the miners, does that predicate, does that take in as a fact that gold itself has to also do pretty well this year?
Yes, but also let's say gold just hangs where it is. Gold's at all-time highs. I mean, now, while it's not always a direct relationship or an inverse relationship, they do make their money, right, from gold bullion. And so the underlying commodity being as strong as it is, that flows through. And for those who, obviously, this is getting into the fundamentals, gold, but I mean, look, fuel costs are a big part of this, and fuel costs are down substantially.
For the miners.
For the miners.
Yes. So finally on Bitcoin, and you are full of surprises today, and maybe I should have been paying more close attention, but having known some of the bearish or cautious discussions we've had about stocks, you're bullish on Bitcoin. Has that been true for some time, or is this a new development?
Yeah, I don't spend a lot of time on Bitcoin, to be fair, but I mean, if asked, and we're talking about it now, the chart, it's okay. It's not so extended. Let me put maybe in context. People say, well, it's come so far. If you were to, and we can all agree that the low for the equity market on this intermediate period was October 27th. And we've had this huge rally into year end. And now here we are now. Home builders up 45% since the October 27th low. Regional banks are up 45. Bitcoin's up only 50%. So, for something that's high beta like this, yes, it's moved a lot, but since the October low on a 3-month basis, it's not that much.
And this is going to be real wonky, but I was just looking at it over the weekend, and it really feels like real rates reversed then in late October. I was looking at the 10-year TIPS yield, for instance. And I don't know, maybe the whole world hangs on what direction that goes next. And maybe it keeps going down. I don't know what happens if it rebounds a little bit.
Right. I mean, so much is tied, at least it's so much of the activity in the sort of back half of the year was related to rates. But again, relationships like this are not always inverse. For instance, with rates bumping up here, and the dollar bumping up, why is gold hanging in? Meaning, these relationships are intact until they're not.
Right, and same with Bitcoin. All of that's the case this morning, and then here it is, off to the races. We'll leave it to the chart master. Carter, thanks so much for joining us today. Appreciate it.
Happy New Year.
Carter Worth, you too. Coming up, a rare downgrade to underweight for the world's most valuable company. Why one analyst sees as much as 17% downside on Apple shares over the next year. That's ahead with the stock having its worst day since August. But first, Rivian shares plunging 10% to start the year after their 40% rally in December. We'll tell you what's behind the move and what led analysts to say that year-end surge happened in the first place. We're back after this. Welcome back to the exchange. 62-point gain for the Dow. At the lows, we were down almost 200, so that's quite a turnaround. Although the S&P is still negative by 0.5%, the Nasdaq's down 1.5% today. And big tech, as you might guess, is underperforming the broader market. The XLK Tech ETF having its worst day in over a year, down 2.5%. It's not just Apple, which is down 3.6%. We'll talk more about that in a bit. We have Meta and Microsoft in the red as well, and semiconductors having their worst day since October, with every component of the SMH trading in negative territory today. All of them, with AMD and Intel the worst performers. Intel's down 4%, AMD 5.5%, even NVIDIA giving up about 3% today. Meanwhile, Tesla's numbers for the year are in, and the company managed to beat expectations on deliveries. Even as fewer of its models will qualify for government incentives going forward, the shares are slightly lower. Shares of Rivian, though, are plunging 10% after fourth quarter deliveries fell from the prior period. Let's get out to Phil LeBeau to break it all down for us. Phil, some consequential developments here.
They are consequential, Kelly, but given the fact that you saw the run-up that we did, both with Rivian as well as the other EV makers in the last 6 weeks, I'm not surprised we see a little bit of a sell-off today. Let's start first off with Tesla. These were better than expected numbers for the fourth quarter, both in terms of production as well as delivery. The company producing 495,000 vehicles in the fourth quarter, delivering basically 484,000 vehicles, little over that. The full-year deliveries, by the way, coming in better than the company's guidance that they set at 1.8 million vehicles. For the year, they deliver 1.81 million. That's an increase of 38% compared to all of 2022. We will get more sense of what happened in terms of the all-important profit margin for these vehicle deliveries. That will come on January 24th, basically 3 weeks from today, after the bell. That's when we will get the fourth quarter results from Tesla. We'll hear from Elon Musk at that time. Now let's shift gears to Rivian. And for Rivian, the numbers in terms of production, much better than expected. The company's guidance was to produce at least 54,000 vehicles this year. They produced more than 57,000. Deliveries roughly in line with expectations, just under 14,000. The street was expecting 14,000. And as you take a look at the increase in deliveries year over year over year, you might be saying to yourself, look, this is steady. Why are people selling this stock the way they are today? Well, part of it is because you're going to see some lumpier results from Rivian in the second and third quarters as the company adjusts production, which they've already talked about. We'll get the full year results as well as their guidance for 2024 deliveries. That'll be coming up February 21st. And Kelly, also keep in mind that with the change in the EV tax incentives from the federal government, not all vehicles that did qualify in 23 now qualify in 24. Some do, but not all of them. And as a result, the concern on the street is how much of the demand was pulled forward and how many people might be sitting there saying, you know what, I'm going to hold off on buying an EV until I think that credit will be, put back on for a particular vehicle once they have the battery sourcing down. That's going to make it interesting to see what we get in terms of results in the first quarter.
Yeah, and I'm looking through it here. It looks like Rivian might qualify, the SUV and the truck for some incentives. Yep. A lot of Teslas still do. Although, why doesn't, am I correct that the Cybertruck does not qualify? Why is that?
Well, I think mainly it's the sourcing on the battery cells and a few other things, but that they expect those things to change over the course of the year. And that's how it's going to be, not just with Tesla, but with all of the EV companies. There's a little bit of uncertainty about how quickly they can make sure the sourcing is in place for all of their vehicles. And that's going to take some time.
And same thing for Tesla, if they're losing some qualifications for the long-range Model 3, things like that. Do you think that's a sourcing issue?
Yeah, the long-range Model 3.
Is that also sourcing?
That's a sourcing issue.
If they sell enough at some point.
Kelly, all of these are sourcing issues. All of these, in terms of battery components, the manufacturing, what percentage are manufactured in North America or in countries where we have friendly free trade agreements. What we're seeing is the federal government saying, we want you to break away from the supply chain being reliant on China. And while a lot of companies have made moves, Tesla's made moves to do that, you can't break the entire supply chain overnight, and it's taking some time, and that's what we're going to see here, especially in the first half of this year.
But they might requalify at some point this year or in the near future?
Yep.
Interesting.
Absolutely. And we will see that with all of the automakers where you'll see an announcement, we now qualify.
All right. I know it's $7,500. It's a biggie for all of them. Phil, thank you very much. We appreciate it. Our Phil LeBeau reporting.
You bet.
Let's get to Tyler Matheson now for the CNBC News Update. Tyler?
Kelly, thank you very much. A Hamas official told NBC News that a senior leader was killed today in a drone strike outside of Beirut, Lebanon. Lebanese state media reported that the Israeli military was responsible for the attack, targeting a Hamas office, killing 6 and injuring others. The IDF has not yet commented on the strike, as is often their practice. Police reported an armed man broke into the building housing the Colorado Supreme Court and opened fire before surrendering to authorities. Officials said the building suffered significant and extensive damage. Authorities say they don't believe the incident is linked to previous threats made to the state's Supreme Court justices. And the president of Harvard University is resigning. Claudine Gay's resignation comes 6 months and 2 days into her presidency, marking the shortest tenure in the university's history. The move follows allegations of plagiarism and her December testimony before Congress, which raised doubts about her ability to respond to anti-Semitism in the campus area of Harvard.
Wow.
Kelly, back to you.
Tyler,
wow.
thank you.
Yeah.
Tyler Matheson, I'll see you shortly. Coming up, don't hold your breath for any Fed rate cuts until after June, according to my next guest. We'll ask him why and talk about the challenges facing smaller banks that could force some of them into M&A. Former Wells Fargo CEO Dick Kovacevic after the break.
Can change your life.
Welcome back to the exchange. The yield on the 10-year briefly above 4% today. That's a big jump from being under 3.8% just last week. That said, the banks are a relative bright spot. The KBW Bank Index up about 1%. And the big banks start reporting next week with B of A, JP Morgan, Citi, and Wells Fargo all out with earnings on Friday. What should we expect? Let's ask Dick Kovacevic. He's the former chairman and CEO of Wells Fargo. It's good to have you here. Welcome.
Thank you, Kelly.
It seems as though the big guys, for the most part, are holding in there. But what about the smaller banks?
Well, there are some smaller banks that are having difficulties, and I think that will continue. The reason is that they used to have quite a few depositors that were over $250,000 uninsured, and they felt comfortable. The customers felt comfortable with that. That's not the case anymore. No one wants to put more than $250,000 in their small bank, particularly. They're also suffering from the fact that their securities portfolio is underwater because of the increase in interest rates. So they may have to raise more capital in order to offset these issues. Mm-hmm. And quite frankly, some of them may have to sell their bank as a result of this.
Well, and sell their bank, I mean, we've kind of been waiting for a lot more of this activity over the past year, and I've been struck at a number of discussions we've had here about commercial real estate with players who are on the front lines. They keep referencing the fact that the small banks have disappeared from the scene, and you just wonder what that means in terms of their earnings power.
Well, it's going to affect them. I think in the smaller banks area, you do have commercial real estate issues. But in general, these are their loans are to local companies who have not suffered as a result of stay-at-home working. So I think we may not see the same level of commercial real estate issues that larger banks have, where you are in larger areas where people are working more at home.
Yeah, I want to ask you about the big call. I don't know if you saw him this morning, but Mike Mayo was talking about how he thinks shares of Citigroup can triple in the next 3 years, if I'm not mistaken. Do you want to, listen, I don't know if you want to comment about Citi directly, but I'm going to ask you to. What do you make about a call like that?
That's a little more than I would expect, but I do think not only Citi, but all big banks are in a good position. And have very good dividend yields, and I think they have more to run. I think the biggest risk that the big banks have is that the Fed causes them to need much more capital than they need. I don't think the big banks need any more capital than they already have relative to their risk, and so we'll see how all this plays out. But that's, I think, the greatest risk is not the business risk as such. It's the regulatory risk. And I think it's very unfortunate, because I think what's happening is that the Fed is trying to hide the fact that they did not see the risk that almost everybody else saw in spring from the Silicon Valley Bank and Signature and so on. And they're trying to blame that issue on not having enough capital, when in fact it was a mistake by the regulators, a huge mistake that they didn't do their job right. So
I've heard other people make
that plays out.
That's echoes. I've heard exactly the same critique from a few others as well, who have been banking executives for a long time, and they are a little bit frustrated that that's what's going on. And I don't mean to misspeak, by the way. Mike Mayo said he thought the shares could double, not triple, but in any case, it's a huge increase in the kind of environment that we're talking about. And I guess, Dick, just to kind of step back for a second, is this the outcome that you think is good for the country? If I can ask it this way, and maybe it is, right? Maybe to have 5 or 6 or whatever the number is, mega banks that nobody has to question the security of their money, and that's the whole game. I mean, but here we are. Whatever people intended 15 years ago, here we are.
Well, you do need large banks. Large banks are international in their business, or many of them are, as their customers are. So you can't provide the loans that these companies need and the places they need them without being large. That's just the facts. Let's just take Canada, for example. Canada basically has 7 large banks that I don't know what percentage it is, but it's like 90% of the entire country. For similar reasons. So, I don't see any reason, I don't see any negatives to large banks other than if they don't behave appropriately.
Or I think it's ironic as well that even as they've gotten bigger, now some of them have been good performers, obviously good stewards of capital. JP Morgan comes to mind, but others like Citi have not. And so it's ironic that they have, I guess, almost become utility-like, capped upsides, capped downsides. I don't know if we call them value traps, because some are not, but many others are.
Well, I think a lot of people thought they were value traps. I was not one of them. I've been thinking that they've been undervalued for a long period of time. Their PE ratios are 40% lower than the industry or the market. And yet their yields, dividend yields, are 200%, 300% higher than the market. So I think they've been undervalued. I don't think it's a trap. Some of them had work to do to be better, and it took them perhaps longer than someone expected. But several of them, and we can talk about JP Morgan and others, have done very, very well. And they're still, in my opinion, undervalued.
Interesting.
And I think there's still room to run. So
quick final comment in that regard then, for those at home who, they'd love to be in the right ones. What would your advice be on that front?
Well, I have my own favorites, but I don't think that's what's important. I really think that that all the large, even the large regional banks, are in a good shape. They have the capital. They're not. Excuse me. They're not at risk. You can have a particular bank that may need more capital, but the industry itself doesn't. And I think the market has been wrong until about the last 2 months that they were somehow not going to grow and not do well. And that happens. And you can understand some of the reasons for that, but it's been a mistake. And those of us who have been investing in it saw that opportunity, and you're seeing it now in the marketplace.
And as you say, still more opportunity given where things are. Absolutely. Dick, thanks so much for joining us. We appreciate your perspective today.
Okay, thanks, Kelly.
Dick Kovacevic, and we'll hear from banks starting next week. Coming up, it's not just iPhone sales slowing at Apple, according to Barclays. They downgraded the shares to underweight today and see as much as 20% downside ahead. Apple's 3% drop today alone, shaving 55 points or so off the NASDAQ 100. We'll dig into the headwinds next on The Exchange.
Peacock.
A rare downgrade of Apple today, with the shares down nearly 4% now. Barclays is concerned about iPhone demand, and that's not their only worry. Steve Kovac is here to dig into that report in today's edition of Tech Check. It's kind of ruined the whole market today.
Yeah, that's right. It's down nearly 4%. And even when this report first came out, it was only down like 1.8% or so. But look, it's the same themes that we've been talking about for the last several months now around Apple as they struggle to return to that top line growth. iPhone demand just not there, especially in those most important markets. They point to China, especially. New competition from Huawei, all those reports we get about government agencies potentially blocking the iPhone. And then also on the services side, which is supposed to be this kind of shining beacon that could help them return to growth, Barclays really pointing out some, negative headwinds ahead, including these regulatory concerns, the DOJ case against Google. You might be wondering, what does Google have to do with Apple? Well, Google pays Apple billions every year to be that default search engine. That's at risk. Regulations in Europe, another risk point. So they point to all of this as a downside.
To you, do they give the granularity around how much the iPhone's selling in China, or is this most of the things we've been talking about should already have been priced into the shares? Like we said, it's been going on for months. What do you think was the newest information here?
There was another thing they talked about the mix of iPhones. So it's not just about the unit sales, it's which iPhone models people are buying. There's the Pro versions, more expensive, better margins, and so forth. This report is also saying people are kind of trading down to the cheaper models, the regular iPhone 15 models. That's part of it as well. It's not just going out there and buying a phone. It's which phone are you buying? And the more expensive ones seem to don't have enough juice. And even worse than that, or even more troubling in this report, is the iPhone 16, which isn't even out yet. They're saying, kind of going against what our friend Dan Ives always says at Wedbush, that, we're due for a big upgrade cycle. Barclays saying the opposite, that this could be another lackluster year for the iPhone following the 15. And
I remember when we just had to get one last fall, the incentives were so much bigger than I expected. I didn't know if that pointed to a weakness in demand. And maybe it tells you all that. Remind me the name of the headset again?
Vision Pro.
I can never remember. Vision Pro, $3,500.
That's all you're going to be talking about in a few months.
Vision Pro. Maybe, again, this becomes kind of their saving grace.
Right. And to your point about the deals, those still exist, but those are more about the carriers trying to get you to switch over from, T-Mobile to Verizon or what have you. That's less about, phone demand versus,
But we weren't switching. That was the thing.
Yeah, that's how they want you to stay. They don't want you to switch to the other guy. That's, every commercial, get a free phone, trade in your old one. That's all part of the game.
You're right. Well, still interesting to see the market's reaction to this.
And it's taken everyone down with them.
Only the fourth analyst on the street, I believe, with the sell rating.
Right. And it's down to 160. So, I think it's trading at 185 or so now. That's pretty down.
And if it goes to that level, then we could see Microsoft surpass it in market cap, and that is one to watch.
They are very close. I think I just checked before we came on air. 2.75 trillion for Microsoft, 2.8 or so for Apple. We could see a flip-flop pretty soon.
That would be a big way to kick off the year. Steve, thank you.
Thank you.
Steve Kovac. Coming up, today's moves are threatening to wipe out gains made in the last 5 trading days of 2023. And Wolf's Chris Senek says don't believe the recent melt-up. The #1 Fed signal he's watching, and it's not the dots. He joins us next.
today.
Welcome back to the exchange. Stocks closed out 2023 on an 8-week win streak. That momentum not fully carrying into the first day of this year. Wolfe Research's Chris Senek doesn't believe in the melt-up. He's laid out numerous warning signs for equities in his latest note. Topping the watch list is what he calls a huge and underappreciated catalyst, Fed liquidity, which he expects to decline. Next up, performance chasing for 2023's top stocks, the likes of Coinbase, Nvidia, Meta, Royal Caribbean, Uber. He also flags that all major U.S. equity markets still look overbought in the near term. And finally, the lack of fear. The VIX well below its average, currently just over 13, and 9-month futures are also at multi-year lows. Joining me now to discuss is Wolfe's chief investment strategist, Chris Senek. Chris, it's good to see you. And, you know, we're all on one side of the boat here. And you're saying don't go over there. It's going to tip over there.
Yeah, hi, Kelly. Happy New Year, and thanks for having me on. So we obviously had a very epic melt-up into year-end, and we kind of told investors at that point in time to play the seasonal trade. But as we enter the new year, the market is overbought on many signals, whether you look at relative strength or MACD or some other technical indicators. Investors overown technology stocks as a sector, and some of the key variables that drove stocks higher in 23, namely Fed liquidity, to us don't seem to be present. In fact, maybe going in the other direction in 2024. So we're not believers in the sustainability of the rally. And actually today's performance in sectors and themes and styles, I think, is being much more indicative of at least what we're going to see in the first half of this year.
And you think the key, you know, your number one here is Fed liquidity. And some have pointed out, Dan Greenhouse and others, it's pretty ironic. They did all those rate hikes, you know, did all that QT, and the market did what it did last year.
Yeah, so the Fed balance sheet for quantitative tightening has been falling on the asset side. But what's happened is a lot of money market funds parked money at the Fed, and it gets a little wonky parking money at the Fed overnight. But they did that, and then they started to pull their money out of the Fed overnight facility to invest in T-bills and longer duration fixed income securities. And the effect of that actually adds liquidity to the system. So there's an old saying, you kind of follow the money. Well, following the money in 2023 led to higher stock prices because liquidity measured by bank reserves at the Fed increased $450 billion. That to us is unsustainable in 2024 because of some of those very forces that help liquidity are going to go in the other direction.
And would you say that's the most important thing to watch then, kind of those weekly levels for reverse repos, that kind of thing?
By far, because when reverse repo levels get to a level that no one knows what the magical number or thing will be, reach a more precarious level, it's lower than we are today. The running kind of normalizes about 830 billion today, but when they get below 500 billion or 400 billion, there could be some tightness in the system. And I guess in a worst case scenario, if you will, if that's a word for it, the Fed might have to end quantitative tightening in the second half of the year, which could actually be weirdly a bullish signal for the markets because the balance sheet won't be shrinking at that point in time.
Oh, 1,000%. But I appreciate how you laid out kind of this is at the heart of, and then many other things could follow, everything from the VIX and so forth if we see a reversal there. That's the top of the dashboard. Chris, well, leave it there. Thanks for your time today. Appreciate it.
Thanks for having me.
Chris Senek, as the market gives up its gains, by the way. That does it for the exchange on Power Lunch. New year, new leadership for lots of corporate America. The companies with regime changes and the big risks that could be ahead in an election year. Tyler is back. He's getting ready. I'll join him on the other side of this break.
Happy New Year and welcome to Power Lunch, everybody. Alongside Kelly Evans, I'm Tyler Matheson. Glad you could join us for 2024. Coming up, seeing red, we are watching oil prices after Iran dispatched a warship to the Red Sea. This is the latest sign that tension in the region will not be easing anytime soon.
We'll see what that means for oil prices this year. Plus, it's not only the first trading day of the year, it's also the first day on the job for a number of corporate CEOs, including the likes of Morgan Stanley, Kraft Heinz, Krispy Kreme, and others. They may have their work cut out for them. We'll break down the key risks facing the C-suite in 2024. But first, let's get a check on the markets. Off to a mixed start. The Dow had been higher by nearly triple digits, giving up those gains now, clinging on to an 11-point increase, while the S&P is now down 2/3%, and the Nasdaq is down 1.75%, back below 15,000.
The crypto market, on the other hand, starting the year quite strong. Bitcoin back above $45,000 for the first time since 2022. More on that ahead.
And lots of headlines in the EV market. Tesla beating delivery estimates. Rivian missing. Those shares down more than 10%. We'll trade it in 3-stock lunch.
And a big downgrade for Apple. Barclays lowering to underweight, saying it's time for a breather with Apple. Microsoft close to surpassing Apple's market cap. Interesting, given the Magnificent Seven's dominance last year, it begs the question, what names and themes will matter most to markets this year? Let's start right there with Mike Santoli at the NYSE. What do you say, Mike? Themes and names that will dominate the year?
Well, Tyler, in terms of themes, I mean, I think you have to acknowledge, given the progress made in the equity indexes coming into this year, that the market's pleasure threshold is higher. In other words, it's going to take more good news as opposed to just the absence of scary bad news to keep things moving in a positive direction for stocks. But I do still think we're in a moment where good news for the economy can be good news for the market. I think the October CPI report back in November really was encouraging along this front. It kind of gave leeway to the Fed to basically say good economic news is not something that they're going to have to fight outright as long as inflation moves in the right direction. To that point, I don't really believe the stock market, just because we're at, 4750 on the S&P and the Fed funds futures market sees 150 basis points of cuts maybe later this year, that we need those cuts to justify where the stock market is. 1 year ago, the market said the Fed was going to be cutting through the second half of 2023. It didn't happen. The market went higher. So I think that those are two separate things. And then finally, I wouldn't really focus too much on the supposed cash on the sidelines argument. Yeah, a lot of money went into money market and bond funds last year, but that doesn't necessarily mean it's a zero-sum game where you have to watch for those assets to kind of make their way into stocks. People have decent, healthy equity allocations already. I don't think the stock market's hated. Doesn't mean you can't make further progress, though.
All right, Michael, thank you very much. Stay there as we bring in our next guest, who held on to his growth tech stocks last year and had a net return of some 60%. Let's bring in Peter Anderson, Chief Investment Officer with Anderson Capital Management. Peter, Happy New Year. Welcome. Great to kick off the new year with you. You held on to tech. You said no recession last year. You were right. You were right on technology. What do you say for this year? Recession or not? Hold tech or not?
I don't think there's going to be a recession this year. I also don't think that the Fed is going to cut rates. I must be on a different planet, Tyler, because I just cannot rationalize the thoughts of why we would have a rate cut as opposed to actually even several rate cuts. And I do think tech, some of the themes that you were talking about earlier, let me just add on to that. I think one of the more alarming themes is when AI gets introduced to hackers, that will probably accelerate their capabilities of hacking and will cause far more necessary diligence on protecting data. So data security companies, I think, are going to do well again this year.
So that would be a Palo Alto Networks. It could be a CyberArk Software. It could be others in that neighborhood. Are you implying a little bit, Peter, that some of the bloom is going to come off of the AI rose, to use the cliche, because of the reasons you cite, the ability of bad actors to use it for bad purposes?
It's an interesting approach you're using, Tyler. I would agree with half of that, meaning that I do think some of the bloom will come off the AI rose, but not for the reasons you stated. Instead, I think what could happen is people will have to refine their expectations of what artificial intelligence can do. So far, we have been drunken sailors thinking that this is going to solve every problem in humanity. But when you do a deeper dive and you look at the actual academic research, they disagree with us. They think that we are far, far from emulating human thought. And until we emulate human thought, we are confusing artificial intelligence with just advanced data production. So to summarize that, I do think that the AI, we need to refine our expectations. AI is not anywhere where we think it is, ironically, and that there's a lot more work and research to be done before we actually have to be afraid that AI is going to take our jobs, for instance.
Well, you're sticking with NVIDIA, Peter. You're sticking with the market, and you stuck with it last year in spite of all the negativity out there. And you're sticking with it even though you're not even sure we're going to get a lot of Fed rate cuts this year.
That's right. And I don't think that we will be dependent, the performance of these stocks, I don't think will be dependent upon rate cuts. And Kelly, you know, if we look beyond, say, 20 years, which for some of us, I guess, is a lifetime, but when you look past that 20-year horizon, rates were much higher than the prevailing rates now. So the question comes, you know, how long is a cycle? What is a normal rate environment? And I guess I tend to disagree with the general narrative that rates are unnaturally high right now. If anything, I think they're approaching a vertex where we would think that rates are normalized and that the Fed will not have to cut rates this year and perhaps even into the next year.
So, Michael, let me turn back to you and get your sort of general reactions to what Peter is saying here. 2023 was clearly the year of AI. It was clearly the year of NVIDIA, and more broadly to those big cap tech stocks like Meta, which had a fantastic year.
Yeah.
What do you see on the horizon for 2024? Is AI going to be another a dominant theme again this year? Will big tech continue to dominate as it did last year or not?
I'm not sure that it's going to move monolithically as it was perceived to have done last year. First of all, NVIDIA in particular is responsible for a tremendous amount of what we think of as the Magnificent Seven dominance last year. If every other stock did what it actually did in 2023 and NVIDIA was flat, the S&P would have been up, I believe, 18% or 16% instead of 24%. And the equal-weighted S&P would have been up 12%. We wouldn't be talking about this crazy narrow market. So I do think NVIDIA in particular stole a tremendous amount of the auction. My guess is investors are going to kind of look to have that theme splinter out and look for other ways to play it. I'm more interested, though, Tyler, in the fact that cyclical stocks continue to outperform pure defensive stocks. And until that really changes, I'm not sure we have to think of it as a pure secular growth dominated type market. It seems like, you know, we can argue about whether the Fed should cut rates at all. I don't think it's going to be a lot of rate cuts unless the economy buckles, but they think neutral rates are 2.5% or 3%. They're not going to keep them at 5 3/8 if inflation's coming down continually from here. So that's why I think the idea of peacetime rate cuts has gotten a lot of adoption.
That's where I'd like to end with you, Peter, and pin you down a little bit. Are you saying that a year from today, when we're back together, and I hope you'll be with us on January 2nd next year, that a year from today, the Fed funds rate will still be at that 5.25 to 5.5 level, or will it come down at all?
I am hoping, against, I guess, general narrative out there, that it will stay about the same, because I think even at that level, you can have a normally operating economy, in fact, probably an even healthier economy, flying in the face of what some are calling unnecessarily high rates now. So yes, I do not think that the Fed is going to cut rates, and I look forward to seeing you this time next year.
I do too. Thank you, Peter. Appreciate it. Good to see you again, and may you have a happy and healthy. Michael, the same to you, Mike Santoli.
Now to oil, which is kicking off the year on a volatile note, rising after Iran dispatched a warship to the Red Sea before reversing course lower. It comes as naval clashes in the critical waterway escalated, with the U.S. Navy destroying 3 boats of Iran-backed rebels. And as tensions rise, how should we expect that to impact oil prices going forward? John Kilduff is founding partner of Again Capital and a CNBC contributor. I don't want to skip right to the good stuff right away, John, but I mean, I think your point about watch the Saudis here is really, really interesting. Can you tell us why that's your first thought?
Sure, Kelly. Good to see you. So I joked to your producer that while everybody's focused on the Fed put this year for the equity market, I'm actually focused as an oil guy on the Saudi pout, I'm calling it, because I'm waiting for them to run out of patience, basically, with their other participants in OPEC Plus. We've already seen OPEC Plus fray a bit on the edges with Angola pulling out of the cartel. And once the Saudis get tired of shouldering the burden of supporting prices, what happens is what has happened in the past is that prices will fall because the Saudis will unleash supply to the market that will overwhelm and then look to hurt the higher cost producers out there, some of which are right in our own shale backyard.
And they've done this in the past. Maybe you can refresh our memories a little bit as to those key and critical moments they did so and why. Can they afford to this time around?
They are constrained to a degree because of their aspirations about their building their economy, you've probably heard of NEOM and some of these other projects they have going. But look, I can take you all the way back to 1993 when they got into it with Venezuela. Similarly, in 1999, 2000, most other folks are referencing the 2018, 2019 time period.
Right.
I'll also point you to the pandemic, 2020, when they had the most mistimed throwdown ever, when they unleashed their supply in the market, just as we headed into the pandemic shutdown, which sent oil prices negative. So they've done it before. I don't think it's their preferred methodology, but if it comes time to take everyone out to the woodshed and teach them a lesson, the Saudis do have the power to do that.
Is the Saudi pout the reason you see oil potentially at $50 a share this time next year?
I do, Tyler, for a couple of other reasons besides, obviously, the Saudi pout, if it comes to pass, will push those prices considerably lower for a time until the wagons get circled again. But look, with the global central banks on the path to cut rates, they're not just doing that because they've beaten the inflation scare back. They're doing that because they see economic weakness, not only here, but in Europe, but also our big problem for the oil market continues to be China, where the economy there continues to be lackluster. They just haven't come back. They're not coming back. And the problems may indeed even be somewhat insurmountable to the extent they can't get that economy of theirs firing on at least 6 of the 8 cylinders.
So why this time, John? In past occasions where there has been tensions in the Red Sea and the Straits of Hormuz and the areas there, oil has generally responded by rising in price. Not this time, or not much this time. Why do you think that is true?
I think this isn't our first rodeo, Tyler. We've had so many scares in the past. Look, when Iraq first invaded Kuwait way back in the day again, the first time, oil prices spiked to $35, $40 a barrel, quickly fell back. And that's been the scenario every time since. The second Iraq War, the bombing of Abqaiq by the Houthis, that's the major Saudi oil export facility, the killing of Iran's General Soleimani, you would have thought would have been a trigger point for a broader regional conflict. The folks out there, just have a patience, or they bide their time, or take these affronts in an almost unimaginable extent. And so to the extent that we're not going to have actual lost barrels, like we didn't with the invasion of Ukraine, like we're not seeing now, and if you don't think for a minute that the U.S. Fifth Fleet isn't going to be able to keep the Red Sea and the Strait of Hormuz open, I'll take the other side of that bet in a minute. So that's why, Tyler, you got to have perspective here. The headlines and the possibilities, yes, are scary. Mm-hmm. But it's sort of like telling ghost stories around a campfire. The boogeyman comes out, then it turns out everybody's okay.
John Kilduff, we'll leave it on that note. Thank you. Appreciate it.
Thank you,
Have a good new year.
Thank you.
And speaking of energy, quick programming note, Brian Sullivan will be live in Miami from the Goldman Energy and Clean Tech Conference on Thursday. He'll have exclusive interviews with some key guests like the Sunrun CEO here on Power Lunch, and continuing with Chevron CEO, I should say, and Goldman's head of oil research on Last Call. Looking forward to that on Thursday, January 4th.
And coming up, is this the year of crypto? With an ETF on the way, probably, we are seeing some expectations for the Bitcoin price to hit anywhere from 60 to, am I reading this right? $500,000. We'll discuss that one next. But before we head to break, a quick power check. On the positive side, Moderna, Oppenheimer upgrading the biotech name, citing optimism in its drug pipeline. On the negative side, Norwegian Cruise Line. I root for my people, the Norwegians here, the cruise liners. Continuing to decline from last week, along with the other cruise stocks in the space. That's your power check. We'll be right back.
.com.
Welcome back to Power Lunch. Bitcoin soaring above $45,000 today for the first time since April 2022 and hanging on to its gains, by the way, as we move through the session as the rally in crypto rolls over into the new year. The entire space reaping the benefits of this bull run. Mining stocks, crypto mining stocks saw huge gains last year, as you can see. And it all comes as traders grow excited about both the possible approval of a Bitcoin ETF in the U.S., as well as the potential of Bitcoin halving this spring that people say could catalyze a price rally. Here to discuss CNBC.com crypto reporters Mackenzie Sigalos and Tanea McKeel. Welcome to both of you. Mackenzie, I'll just start with you. And is it just the first year? Why so many fund flows and all of a sudden we're off to the races today? What are you hearing?
Yeah, a lot of it has to do with the fact that there's optimism that we could actually hear as soon as this week whether or not some of these spot Bitcoin ETF applications will be approved. The SEC has a deadline of January 10th to give ARK and 21 shares decision on whether to approve or disapprove their spot application. And there's optimism that it will be a green light this time. You've got some of the biggest names throwing their hat in the ring. BlackRock, June 15th. Since June 15th, when BlackRock put an application in, we've seen an 80% spike in the price of Bitcoin.
Wow.
And a lot of that has to do with the fact that they think that institutional money will flood into the space once we see some approvals.
That's incredible. So they really do face near-term deadlines here for us to know one way or the other. Tanea, what would you add?
I would add the geopolitical tension in the Red Sea, I think. Remember, Bitcoin has been in kind of a downtrend for the last 3 weeks. Ended December on kind of a low note, but that uptrend is still kind of intact. And remember, so to Mac's point, a lot of this rally is about the potential Bitcoin ETF. But remember that before that ETF narrative came into play in June of last year, it was the U.S. Regional banking crisis here in the U.S. that was the big catalyst. From March 5th to April 30th, you know, we were really seeing Bitcoin rise from the ashes at the beginning of last year, and that was its first sort of 30% spike.
Two questions, Mackenzie. One is, are there Bitcoin ETFs in other countries around the world? What do they own? Do they actually own Bitcoin? Do they own some futures? What do they own? And how have they worked?
In Canada, we have a spot Bitcoin ETF. You know, one of the reasons why people think that this is going to be a sell the news event is because the flows with that ETF haven't been as anticipated. And I think that that's one of the biggest narratives, that we've seen this huge price run up going into this event. But think back to December 2017. There was a lot of optimism around a futures Bitcoin ETF, and that ended up being a negative catalyst for the space. Even Bernstein, that deems a spot Bitcoin ETF as being the greatest financial pipeline ever built between traditional financial markets and the crypto ecosystem, thinks that there will be, that the market will take a pause once these spot ETFs are approved, while people wait to see if the flows build momentum.
So when you say spot ETF, you mean they are actually going to own Bitcoin,
exactly,
not futures.
And that's what's so different about this, because it would mean that people don't have to go to an exchange to custody Bitcoin. Instead, you know, BlackRock, Fidelity would work with Coinbase to custody the Bitcoin, and then you have a very, familiar product that you can buy into the space with, and that's what.
It's just keeping an eye out right here. You got this low right in here. You had a low and then a new low right here. You have a higher low right here, so no, just kind of indecision right now. Can't really tell anything from these previous lows here. Can't see anything back here. Kind of cleaned up this. Let me go to the trigger screen really quick. So what I'm looking for here is, you can see the time that we're spending back here. You got these two little ticks back here we can snap some lines on. You got this little one right there. Got a 1 dash, then yellow. There's a little bit of, let's take a look at this closer. That little gap right there is a little tiny gap right in here. You see it? There's a gap right here, too. A little bit of a gap right there, a little gap right there. And then I don't see any gaps down here, but we'll mark it. There's a little bit of gappage right here, too. A little bit of some prior marks back there. So these little yellow lines that I have here, this is your S3. Take a look at that. Right in here, all this stuff could be cleaned up. A little bit more down there to clean up. Yeah, those little yellow lines, they're just little tiny gaps, little teensy-weensy gaps back there. There's one more. I guess I put that. Maybe this should be a little bit lower, somewhere down in there. Clean those up a little bit. Just ping-ponging down there. The little algos, little gremlins doing their work. That white line should have been on the 4 o'clock hour. I just put it in the wrong place. My point was that you got to, well, it doesn't matter if it's a short week or not, but you've got turnaround Tuesday and then what the fuck Wednesday, right? So, yeah, today is Tuesday, but we have a short week, so it should last into the morning. The turnaround Tuesday would last into tomorrow morning at least. I just placed it at the wrong place, so we should be at the 1600 hour. It's right here. So just that 4 p.m. The only my points behind this was you'd hit the 3 o'clock hour, right? And this would be your 3 o'clock to 4 o'clock hour down here. So you'd get maybe a little bit of this fake out blast down here, and then wake up in the morning down, right? And that would be your actual dip buy for Friday. Not guaranteed or anything. It matters where we go. Also notice today too, right? There's some other things you can take away from this. So we're not in a trend day, right? We had a failed breakout here. No, that's kind of bearish. But the more time we spend down here, the slower we go. It's organized. You know what I mean? We're not seeing like any kind of trend to the upside, willingness from buyers here stepping in. So I would expect that weakness into. I'm going to expect that weakness into the close, and not necessarily extend past the close or much past the open. I would expect, like, let's say like 7 a.m., 6 a.m. the market gets bought tomorrow if we are weak into the close. So you can pick your poison here, right? You could get a call spread at 4 o'clock, or you could wait for the open if you want to be more secure in that trade. Like, if you're looking for a weekly call spread or something like that. Personally, I would wait, and I am waiting. I'm looking to buy the from here where we are. Just looking at this, I'm not necessarily bearish, but I am. I always like to see that. You get that weekly capitulation, weekly low expected move kind of stuff. And though, if you bought a weekly call spread on the money right now, you'd probably be fine by Friday close at 355 or something. But you know how this goes, right? You wash the manipulation that comes into the market here is this bottom, right? Or are we bearish on the week? It looks like we're going to be bullish in the week, but positioning matters. So if we do get that weakness into the bell, it would be a nice dip buy, right? Some call spreads for Friday, or even PJ traders come out, slam it down, and then that's the actual dip buy for a nice Friday run. So just patience. If you are a bull here, just as we said before, if you are looking for that dip buy, the best thing for you to be is above this hourly trigger with a successful back test of it to take that weekly trade to the upside. But otherwise, I'm going to err on the side of just having some patience, just hanging tight here. Let the bears get all worked up and all fired up, and look for that perfect buy here for the week. See what you guys are saying out there. Yeah, Chase. So Chase or I don't know if he just did it, but he said day trading random chop is too costly. If you're a bull here, if you're looking for a weekly buy, there's like a 65% chance that weekly buy is either at the close or at the open tomorrow. So if you're like, well, I think we're going up here, cap at the 3 o'clock hour in the next 20 minutes. I can get down with that. Make it a call spread if you're going to do that. Make it a little bit more closer in the money. If you are risk adverse, you're waiting until you're either above the hourly trigger for a weekly call spread, or you're looking for that nice capitulation on a weekly basis. Happy New Year to everybody. Happy New Year to all you guys out there. Absolutely. It's not too late to say Happy New Year. We're still in the new year. The market, I said this earlier this morning. I don't know if you guys know this, but the market is not back yet. The market won't restart until after this Friday. So the way that the holidays ran this year, we get it on the back end. So a lot of people a lot of Wall Street is still on vacation until next month or this upcoming Monday. So this is a nice short week. Just hang tight. You can actually see we're in low volume. So this is you're still trading end of the year to some extent right now. So yeah, Happy New Year to you, Sunday Never Ends. Yeah, just be patient. If you're a bull, just wait until you're above this hourly trigger and make sure you back test it. Stick with your tools. If not, the one fear for me here, is, they close it up here, right? So let's say they close it up here in the close, and you're seeing this as bullish, right? So what happens in a nice bull trap is this. You'll get all bulled up in here. This is 4 p.m., right? You'll get all bulled up in here. They'll take it up here, right? But not close above the hourly trigger. And they get up here like this, and you're all bulled up, and this is where the manipulation comes in, right? And you're all bulled up, and you're like, fuck yeah, this is awesome. But you never beat those prior highs back there. These sellers come in overnight, and they sell it right back down on you. So let's look at where the dealers are right now. So
$2.56. NYMEX gasoline February futures settle at $2.09 a gallon.
Here's Friday right here, right? So here's Friday, right? So just let me explain this in a better way here for you. So there's a bull trap in here. So
NYMEX WTI crude February futures settle at $70.38 a barrel. That's down $1.27 or 1.77%.
So you figure, right? We sold Friday. We wake up this morning, right? Whoop, got a failure right here. And let's say we get the race up. Let's say we do get the race up into the close up here, right? Boom, somewhere in here, the dealers are pretty neutral. And then what happens is after 4 p.m., you're thinking everything is great into Friday. And what really happens is these sellers come right back in on you for Tuesday, and you wake up Tuesday, and we're actually down where the actual buy is in the week. So just be cautious in here. This is if we squeeze up, bull trap's waiting for you. And what you really want as a bull, I'm telling you, what you really want as a bull right now is either today or tomorrow to be buying either this gap closure down here or something right off that daily trigger. It's your best trade. Now, whether that comes tomorrow or it comes on Monday or Friday or Monday, this is kind of like the no man's land down here. Don't be fucking around down here, okay? It's not the place to be fucking around if you're a bull. I'd rather be buying something I'd rather be buying this. Something like this I'd rather be buying, right? So it's like that. I'm a buyer right there. The 1 and the 5 are coming up. You're above the hourly trigger. You back tested, and we're off and running again, right? Situation normal. Looks great. If not, I'd really like to be a buyer that's like sell all this down right here, right? You catch a bounce. Your hourly trigger comes down, gets underneath. Right? You get the squeeze, you come back down, you get the 1 and 5 minute trigger down here. I'd rather be a buyer right there as well. So I'd rather be a buyer right there, or I'd rather be a buyer up here with all that stuff. This stuff in here, this is where you get, if you're a bull, right? This is where you lose. Like, whenever you guys, I'm always telling you guys, you want to win 9 trades, you want to win 7 trades. This right, buying this right here is your 3 out of 10 trade winner, 5 out of 10 trade winner. 2 out of 10 trade winner. Not the place for you. And if I was a bear, they're doing what they're supposed to do, right? Look at this from a seller's perspective, right? They sold the hourly trigger here. They sold the hourly trigger here, right? and they just sold the half-hour trigger right here. So if anyone's in control right now, who is it? It's the bears. Sellers are in control. They're teeing off right where they should. Sold this, sold this. This morning we talked about that half-hour trigger, right? We talked about it again in the middle of the day, but even McGork, I think, said that he sold that half-hour trigger. You know, if you're sell side, you're doing it. We're staircasing it down just like should be done. So just be patient. If you're a bull, be patient. If you're a bear, stay short. As a matter of fact, if you're a bear and you get short and they squeeze this close, you are still in control of this to sell down into the open on Wednesday, tomorrow. Just be patient here if you're a bull. I know you don't want to hear that. I know. I bet you're all like, I'm gonna guess here that a bunch of you were day traders are like, coming back from New Year's. We're gonna smack this. We're gonna get that SPX new high. Wrap it up for the week. Party in the weekend. Just let it cool off a little bit. Get some of that demand, fill some of that demand down here. Thanks, Legend. I appreciate it, brother. Do I put any weight on a 1 hour chart? No. Well, yes and no. So I got a good question there. I'll answer that question. So here's the deal. The stock market trades, in my view, on a 1 minute chart, a 30-minute chart, and a 1 day chart. Those three charts are what the market trades on, okay? The stock market day is on the half hour of every regular hour. So 9:30, 10:30, 10:30 to 11:30, 11:30 to 12:30, so on and so forth. Now, saying all of that, okay, I do, as a whole, in a mathematical equation, weight. I give weightings to a 5-minute chart, a 15-minute chart, a 1 hour chart, a 4 hour chart. I do weight, though. I do use a mathematical equation to weight those time frames for length of time of up or downside moves. So we'll look at that right now. Hang tight. Give me one quick second here. It's a good one to look at. So outside of that stuff, right? Here is a chart of SPX, okay? And on this chart, I have right now what? What do I got sitting on there? I got an EMA 27 and an EMA 50, but that should be different. So 50, this should be, let's call this 129, okay? Let's see, I got the 129, the 27, the 6. Here's a little New Year's gift for you, okay? So this is SPX, right? It's a 1 minute chart. As a matter of fact, we'll just get rid of that little red. This one right here is meant for me for the power and trend on an intra or on the time frame that I'm on. But this is really what you want. So you see how you've got the white lines below the red line and the prices below, right? This is on a 1 minute time frame right here. You can design your own mathematical equation for this, but if you wanted to trade, say, a 5 minute chart, you can do the same stuff here. And you can actually weight on a 1 minute basis, how bearish are we? On a 5 minute basis, how bearish are we? So let's look at this right now with trend, okay? So on a 1 minute basis, we are bearish, right? We've got a bear cross above. We have a confirmation here, and prices below the 27 EMA and the 129 EMA. So we are bearish on a 1 minute basis. On a 5 minute basis, we had the cross above here, confirmation. On a 5 minute basis, we're bearish. Double bottom here so far on SPX. Let's look at a 15-minute basis next, and we just got a 15-minute bear cross and a confirmation on a 15-minute basis, right? So on each basis, we can project, or you can project, how bearish we are. So right now, we're pretty bearish on a 15-minute basis. The expectation would be that we're going to go and test these prior lows back here where my cursor is, right down here. Okay? We're likely going to trade this on a 15-minute basis. Now, we know that, right? We know that right now. Let's now look at a 30-minute basis, and we are not bearish. We do not have a bear cross. We do not have a cross here, do we? We do not have, it's forming, but it hasn't confirmed yet, has it? Right? We haven't confirmed it. So we haven't had that cross. We haven't back-checked it for more downside to come, right? So remember, we just talked about a 15-minute basis here. We're likely going to trade that on a 15-minute basis, right? We have not confirmed this here, right? Trade that 15-minute bear, come back up here, and then you still need the confirmation on a 30-minute basis to trade what? That one right there. Makes sense? So we're not fully bearish here in a half hour yet, are we? And then let's look at a 1 hour time frame here. And what do we have here? Not bearish at all. We have no hourly bear cross. But if we did, let's say price action looks like this at some point, right? Let's say price action, we go down, we break below. Hold on here. Say price action shows us we break below here, right? And then we come back up over here, whoop, 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 right? And then we begin to consolidate, right? On an hourly basis, we're not able to get above. The bulls are weak in here. At this point right here, if the bulls have no will here, I would then come out to you and say, well, we're about to confirm a bear cross on a 1 hour basis. You're going to expect on an hourly basis, 1 to 3 days, possibly a week to the downside, and we're going to be then targeting 45, 55, and more than likely 44.50 down here. Make sense? So the hour chart does help with that, right? Now, you'll see guys out there say, I'm super fucking bearish. We're going to crash. You can't confirm that until we go to a 4 hour basis to look at these lows down here at 4,300, 4,400 to close that gap. And then again, on a 1 minute, on a 1 day basis,
$75.89 a barrel. That's down
now, saying that,
or 1.49%.
Let's say you're a swing trader, right? If you're, let me close this up here. If you're a swing trader and you like to trade these higher time frames, right? Let's say you're a bull and you want to swing a trade or a 1 to 3 month trade. What are you looking to buy? You're looking to buy down here. 46.57 is what you're trying to buy. You're actually trying to buy this right here, right? And you're looking back in time on the hourly and 4 hour basis to see if we break above that 1 hour trigger and that whatever to get or to show bullishness, right? So if you end up seeing this there. If you end up seeing this blood down here and you're looking to buy a 1 to 3 month call, you're not just going to automatically buy that white line, right? You want to make sure that we trade back above on a 1 hour, 4 hour basis showing proof, right? We can break above this here, come back down here, and then you're off and running with your 1 hour bull trade. So that's when I would use that time frame, that 1 minute, that 5 minute, that 15, that half hour, the 1 hour, the 4 hour, and the daily. If you know how to do this, right, and if you set an alarm on your phone, let's say once a week, and you are aware of higher time frames, and you know how bullish or bearish we are on every time frame, you can make informed and educated decisions on your bullishness or bearishness. So even where price is today, if someone today was going to tell you, hey, we're going to crash, right, I would say no. And as a matter of fact, I'll show you some examples here. So you know people call for crashes and shit like that. They're like, the stock market's going to crash, right? Crash. Not correct. Crash. So let's look at a weekly basis here, right? This is a weekly basis. This is corrective behavior back here, right? Did we get a cross of this white and red line? We did not. We had price cross, but not the white and red line, right? When was the last time we did get a weekly cross? Take a guess. January, March of 22. So you can actually see right in here, right? Bam, bam, down here. Whoop, come back up here. We confirm on a weekly basis we have a major downturn coming. So you could predict back here in May of 2022 that we're going to crash, and it's going to be sustained for a long period of time. And let's look at some other prior examples in past history here. You don't see us crossing here, right? No crosses here, no crosses here on a weekly basis, no crosses here on a weekly basis. So when you're looking for some like real major downside moves, last one was in here, right? 82. So major moves down, even down here. 88, we pulled back up, right? Pulled back up over here. So this is SPX, by the way. And right here we have one, right? This is 2001. You can actually see it, right? You could have called a crash here. And the same thing goes for 2007, right? You could have called a crash right there for sustained downside to come. One of the greatest gifts that Jerome gave you guys was Jerome Powell gave you guys was time, so that we did not cross and smash lower. So be careful when you're out there be careful when you're out there. We're not careful, just you can tell who knows what they're talking about, if we're going to have a crash or not. You can tell who is talking out of their ass without price action proving that we've confirmed sustained downward move for 2, 3, 4 months, or major lows, right? Either price or time, and like when that happens. Does that make sense? No, it's not a rejection of all-time highs. I'm looking. So these algorithms, from these algorithms, I am looking for that the ATH on SPX, and for me, it's more. Blissowitz is asking, was that a rejection of all-time highs? Fuck no, it's not. It's more of like how the market runs, right? Where you rip higher 100. Let's say we go up 100 points, right? Or 300 points, right? People get excited, right? They get excited. Like, let's load it in the market. Let's get up there, right? You feel that high, and you end up feeling that high, and you need some more skin in the game. And you're not going to get skin for another 5 or 10 points. So you pull back down, and then you get the demand that you need to get you over the edge. I also want you guys to remember something, okay? I want you guys to remember something. There are time frames for a lot of stuff out there. Like, there's like time. Time is a big thing no one likes to talk about. This stock market goes up. It's gone up since 1897. You know, it's always gone up. Even in a depression, COVID, doesn't matter. It goes up. If we trade up to that SPX prior high from early 2022, and we're already up here, the chances of us not tagging it are very low. If you look on a, let me see if I can bring this up again. Everyone wants like a trick, you know, like, fuck the bulls, fuck this, fuck that. You can be a great winner as a here's the top tick right now, right? SPX. Here's the top tick on SPX. You see how close we are to, this is the high right here, right? You can't see that. Hold on here. So here's the high right here, okay? From January 2022, okay? Look at how close we are to it right now. This is on a weekly basis right here, right? It's way, way back here. Now let's take a look back in history, right? And like you kind of go up there and tag it. This one you didn't, but a year or two later you did, right? So if you just look historically back in time, sometimes you do, sometimes you don't, right? But it's still rare. It's so rare that let's see if we can go to 1 year here, 12 month. Wait a minute, I think I was looking at a 6 month the other day. Hold on. See all before. I'm not going to delete all this stuff, but you see how there's a 6 month basis right here. You get this giant push up, right? And if you want to say, yeah, for this 6 months we're going lower, I can agree with you. But that next swing high, we tend to at least take it out. We may not, but you got a lot of buyers here, man. This is a 6 month basis right here, right? Look at these bars here. This is not weakness. You see that? You have an indecision candle on a 6 month basis, but then you got a buyers and buyers. Typically, we'll go up there and smash it and then do the roll at worst case scenario. We could even go higher, but like worst case scenario, we tend to go up there and smash it. So this weakness on a 1 day basis, look at this. Look at this one candle here. This is a 6 month candle. Weakness on January 2nd or not, a failure to attain it last month. I would be very wary of us not getting up there. And we have the magnet still, believe it or not, to go up there for that collar and tag it. So just be careful here. Careful drinking the Kool-Aid out there just yet. On the market on 1 day performance or even a week or two performance of the stock market here. So hold on here. When you're zooming out on when you zoom out a little bit, it right now it looks more like we're just looking for a good buy-in. Buyers are there. I want you guys to know that. I want you guys to know fully that no one's scared. No one doesn't want to buy. Everybody's either swimming in the pool or they want to be swimming in the pool. Though I think we do have a significant low in March, I would not blink. If we turned around in a week or two and we're trading the SPX all-time high, I wouldn't be shocked. Is my point. I wouldn't be shocked if that happened this week, next week, something like that. So if you're a bear and you think, we had a failure, doom and gloom, you just keep being tactful here, okay? You trade down to your daily trigger. You wait for the hourly to cross below the daily. You then trade the daily trigger down to the weekly trigger, and you are an efficient market operator, and only after we get underneath the monthly trigger do we begin to talk about big bear town shit, like we're going to 3,500, 3,800, all that kind of stuff. And I'll give it to you at that point. I'll be like, yeah, you're right. We are fucking in full bear mode and all that kind of stuff. Yeah, Jem can call for a crash. I don't think you technically can have. Let me show you guys some stuff here. Hold on a second here. So hang tight here. I'll show you guys something here. So if you want anything in my view here, okay, if you want, let me see if we can bring this up here. Let me show you guys something here that's in the report for this year, all right? So we're going to look at what matters here, okay? What matters? Truly what matters. We're going to talk about what truly matters to this market. for crash. If you want a crash, like an actual crash, okay, I'm going to show you guys two things here. So this is actually in my report, and I want to show you guys this, okay? This is so fucking important. So important. I'm just going to add this other one in here. Fed funds rate, unemployment rate. We got that one up there. Effective funds rate. This is really the big. These are the two biggest you need to know. If you wanted to dumb down your trading, you need to know two things: your Fed funds rate and your rate of unemployment, and your you want to know your rate of inflation. Okay. So this is your rate of inflation down here. All right, and these matter to you. Normally, how they matter is this. Normally, what happens is this. You want to, I want you to see this here. Okay? Gather around your computers right now, okay? So, historically, what you are looking for is Fed funds rate to flatten and to cuts to begin, okay? Right around there, like within a month of the first cuts, you will see the market begin to sell. This is even if we raise rates in the future, okay? So it could be just one rate cut, doesn't matter. Even if they raise rates in a month or 6 months or a year, doesn't matter. You're looking for a rate cut. The next thing that you're looking for is for the unemployment rate to begin to trade between 4 and 6%. You're also looking for a touch and go of inflation at that 2%. Touch 2% and go. Okay? This is like a trifecta right here for a market crash. Not a correction, not a pullback, not trading 4,100. Now, if Gems, I don't know what Gems calling for. Maybe his or I don't know if he means 4,100. I don't know if he means 3,800, 3,900. I don't know if he means 20%. I don't know what Gem is saying to you guys out there, but I can assure you of something. Fuck the inverted yield curve. What really matters to you is this kind of an action in here. You'll start to see the rate cuts come in. You can actually see the bloodbath down here. You can actually see the unemployment rate down here. And you can see the same action back in here. You can actually see this topping action here. This last crash right here. You see rates start to get cut. You see a ramp of unemployment, and you start to see the tag of 2% on inflation, and then inflation rising. Okay? Same thing happened back here. This is back in 2002 or 2007, 2008. Here's another one back here. Same situation back here. You got this topping here. Rates begin to get cut. You start to see the unemployment ramp, and you start to see inflation dropping down to that 2%. We actually went even lower than 2% in 2001, 2002. You can check this at home on your own, okay? And you're going to look up the Fed funds rate. You're going to set it up in a separate window. You set it up with the unemployment rates and the rate of inflation, and you can track this going back to the beginning of the stock market. Now, this is why you can't trust the inverted yield curve, because the inverted yield curve, the Fed can manipulate that whenever they like. What they can't fuck with this trifecta right here. The only other thing that would come your way as a bear, if it wasn't these three macro things, right? As a cash market trader or as an overnight trader, as a stock market trader, what matters to you is these three right here, generally speaking, okay? Now, you'll get weakness and stuff from the yield curve, but not the crash you're looking for. The crash you're looking for, okay? Or for that crash you're looking for would be something like an unknown event, i.e. COVID, right? I.e. fraud becomes public in the market, right? Like, I don't know, a big bank goes on CNBC and says, we need cash. Regional banks start to implode. or a war breaks out that we don't already price in. And I mean like a war we don't know about. Something that even if JPM had an office, could not predict. World Trade Center, stuff like that. Outside of that, you should not see that crash that you're talking about, the meaningful crash that you're talking about. So let's look at this here and see let's measure this out and see what. So you said Gem is calling for a crash, right? That's 14% to 4,100. That's not a crash. So no, I don't see it. Crash right here from where we are. Gem would have to be calling for 3,800. A trade to 3,800. I think you get 4,100, 4,200 by March 17th. I'm calling for that. So maybe he wants that extra 200 or 300 points. I do see the 4,200 by end of quarter for SPX, but that's still to me not a crash. It's only a corrective environment. For Gem to get that crash, in my view, he would need the Fed to start cutting rates, and you need to see a rampant unemployment, and you need to see a touch and go on the rate of inflation. So I'm not on that trade just yet. I can't be on that trade unless I see those other things happen. History is on my side that you'd need those things to take place. You need for those things to take place for to make that call. And I know the bond market's betting on that taking place, that we're going to get rate cuts and all that stuff. I don't see it. I don't see him doing it. So I think that I don't think they cut rates until after the election. And I think you're also going to see, we have another problem too. If because of the presidential election, we're screaming higher, let's say into the first or into March, the general public is going to be calling for more rate increases, which would be counter to what the market price would say. There's a guy in our group here. His name's Jimmy Berry. Jimmy Berry talks about this every few months. Him and I will have conversations about, are we actually going to get rate cuts? And there is a mechanic of the market right now. Like when you see people like Fundstrat call for 6,000, I see why they're calling for it. I see why Fundstrat's calling for that. It's because whatever this pullback is into March, if we're not cutting rates, it should only be corrective. So if it is only corrective and we begin to trade up into 5,200 into the election, and we have this exuberance into March because of the election, if we get that right, you get that exuberance and all that, it would be hard for the Fed to not raise rates in March, January, March in a significant way. Now, that would lead, of course, to downside to the market, but corrective, not the crash. I have, in this report, I'm going to show you examples of the Fed raising for multiple years and the market just fucking grinding higher. We had an episode of it that took place in the 90s that actually led to the .com crash, and this is going to come into the Fed's power here. We really are handing the market over to the Fed at some point, unless we have one of those unknown events to the market, in my view, or at least historically. The bears really need the Fed to cut rates. They really need something unknown and not priced in to hit the market in the tape. They really do. They need it. Yeah, Jimmy Berry's got a point. I was able to work out where Jimmy Berry would be right. I'm like, shit, he has a chance. And what's really fucking crazy here, too, is whenever they do make those rate cuts, it's going to get fucking ugly. it's gonna get really fucking ugly. We're gonna have likely a major crash like 07, 08, like 01. You're likely going to see it last. So there's some other shit at play here. You got an 18-year housing cycle that ends in 2026. The last one was in 07, 08. They have 18-year housing market cycles. They kind of line up with that. If you're a bull out there, you might only have one more dip buy this year. And if the Fed ever did cut rates in late 2024 or in 25 or 26 or anything at that time period, you could see a reset for kids. If you're a kid out there, too, by the way, if you're young listening to this program right now, however that plays out, the mechanics of this plays out, you are likely getting a great reset in the next 1 to, I don't think now you're getting it, but I think you're going to get a great reset whenever they cut those rates. Whenever I think those rate cuts come, you are getting a great reset, which is good for you. If you're a young person, the Fed is likely going to trigger one big wash where you're going to get that great buy-in. Now, in that report that I wrote, there are consequences for older people. You're going to have to decide when you downsize your homes, if you can live through another full cycle. That could be another 10 or 15-year period that you're going to have to keep working. So depending on how old you are, do you want out between now and then, or are you going to downsize before, or can you weather that 10 or 15-year period where you'll be back on the top again? So there's a lot of mechanics at play for young people and old people coming up in the next couple of years. Yeah, exactly. There's a grand. I don't know if I'd call it a grand super cycle that's going to be as bad as the 1930s or 1940s, that kind of stuff. But without a doubt, there is a big super cycle starting. Well, I don't know if that's a short or long-term debt cycle, but there is a short or long-term debt cycle setting up for the youth. And it's all going to matter on when those rates get cut. It really is. I think it's after the election, but that's when I think it is. And it would also line up with a Republican winning office to start that next greed cycle, that kind of stuff. So, yeah, I want you guys to know something here. So, I own property, I own vehicles, and I'm making decisions. The past 2 or 3 weeks, I've been conferencing with my attorneys, conferencing with my bank, conferencing with my wife on some major life decisions and when to trigger those major life decisions, and how that plays out. So, and we're doing the math. Do I just leave rentals on, or is it more profitable to exit the ownership of those rentals and look for cheaper rentals? But the one problem with this is I need the Fed right now. I need the Fed to cut so that I can exit. If the Fed doesn't cut and keeps pausing and slowly increasing rates over 5 years, I could be too early too. So just be patient. I think the key thing here would be patient, and watch the Fed closely. Not who's betting, not the bond market. Don't be watching all these other fucks out there. Well, this isn't Gem either, but I mean, be really careful with people telling you that have no skin. Be really careful. I want you guys to know, man, if you have wealth, it's different. A lot of what I read on FinTwit, a a lot of what I see in the chat sometimes, like it's either different. You guys know, sometimes I tell you that people have different motivations or different goals, right? In terms of a crash or a reset, people with money are waiting for specific things to take place in the background. Like, if I want to sell these fucking houses, dude, I'm scared. And I can't because I need that cut to come. I need to know that we're putting in motion the reset. And until we do, historically, the bond market can cry, whine, bet, do whatever they want to do. FinTwit can say do whatever they want to do, but we can try to. The bond market can attempt to front run it, right? They can like front run rate cuts for 2024. But if those rate cuts don't come, the market goes higher. It literally turns around and starts trading higher. So, it's like a game of cat and mouse. And right now, I'm unwilling to like stand back there and see the market just fucking grind for another 5 years if that's the fucking Fed decides they're gonna do. Try to find Jimmy Berry at some point if you guys are out there right now. Whenever you see Jimmy Berry in here in a chat, try to get him on the side somewhere and talk to him about it because he'll explain it to you as well. Oh, he's here. He's here right now. He just said if the Fed cuts rates, it'll be to save the banks, and that will be because the broke system when they took the rates to zero. Mind the Fed's not cutting until inflation is at its lows. I'm with you, Jimmy. You'll see, like, it'll be like a touch and go. So you'll see what you guys are going to see is like a bunch of scam. Okay, it's fraud. The Fed will touch 2% when they want to touch 2%. It'll be like a plane making a touchdown and then go higher. I'm with Jimmy on this. I think then you'll see the rate cuts. You'll see unemployment ramping up to 4-6% at the same time. And then what you're going to see is, I wrote this in the report. I know Joe Donut's seen it. Quinn's seen the report at this point. I said that it would be they will back blame that role on mid-sized and regional-sized banks that collapse over commercial real estate. In my view, my personal opinion is later down the road, you'll see that everybody out looking for money. These banks will be out there looking for money, and that's when they'll be like, that's why they were cutting rates, right? Something was broken, right? That's how we get back to that something was broken statement that you hear about the past. I'm telling you guys, man, the fucking Fed and the Treasury Department they can take the inverted yield curve, right, and just fucking manipulate it. They can take unemployment, manipulate it, jobs, manipulate it. They can scam this whole fucking thing, inflation, manipulate it. I'm gonna video I'm gonna post for you guys of a hedge fund, this woman from a hedge fund in New Mexico, and she point blank says, she goes, I am friends with a guy that is hired to fudge those numbers. So they will manipulate this fucking market as long as they can, unless something unknown to it happens. So if you're a bear, you are looking for one of two things for that reset that you're talking about, right? You're looking for one of two things at this point. We're looking for the mechanics of unemployment, inflation, and Fed rate cuts, right? That's your one. That's the one thing you're looking for. If you don't see that, you're basing everything on a hope and a prayer on non-priced in events to the market. Volmageddon, war, terrorism, you name it. And it can't be known about. Like, that's the other thing here is like banks know about a lot of shit out there. It has to be unknown to the market, truly unknown. Think of Goldman Sachs and JPM like the CIA. I don't know how many books you've read about these operators, these bankers, but these bankers have biographies and autobiographies that they write. And if you read enough of them, right, they're like the fucking CIA, man. They keep offices everywhere. They have friends in low places. They literally practice bribery in other countries. Okay, now it's legal. You can't get in trouble in the U.S. for shit you do in other countries. So a lot of stuff. We have people and banks that have offices in Russia, have offices, believe it or not, in places like Iraq or Iran, or at least contacts there that they pay off to know before something happens. So you need something unknown to the market, is my point. Yeah, I think the only one you're gonna, I think the one that, I think if you had like a, when they do begin to cut rates, what the reason will be, it'll likely be as Jimmy says, right? You're saving a bank, and a bank is tied into something that's fraudulent, and the only fraudulence that I could see would be the mid and regional banks. Now, the other way it happens is the Fed doesn't cut rates, and you have what took place in the dot-com crash, right? So the dot-com crash had more to do with raising rates and over in a bubble of the stock market, creating a bubble in the stock market. So if the Fed doesn't cut rates, they could create a bubble in the stock market, and that would be the other way, right? Then they begin to cut rates, then we get the crash of tech. Yeah, hedging real estate with puts. You know, so in this report, I'm going to show you guys the real estate cycles, and we just had our false breakdown. Normally in these cycles, at the end of the cycle, you get a false breakdown, and then you get an extreme upside move in price. We just had our false breakdown, just like before the dot-com bubble, and housing prices are still cranking right now. So I think I need to stay in right now. Yep. What about where they lend money to banks? Doesn't that stop in the next few months? No. They actually lend since 1978. It's been they lend the same amount regardless now. They actually use prime banks as a hushed up liquidity provider to the market, and companies and banks actually, they used to not do this before 1978, but they do now. They do liquidity cash infusions still into banks today, and corporations used to have cycles of taking loans. They stopped. If you look, it's like one straight fucking line, even through crashes. The money is the fucking money. The what do they call it? The dune. The spice still flows. Here, let me see if I can show you guys something cool. Hold on a second here. Hold on. I'll show you guys something here. Hold on. Give me one quick second. Well, hang tight here, guys. Yeah, this is a good one, I think. Here, the first return right here. Property Geek. Let me see if this guy shows it. Property Geek has something on it, but what I really want to show you is something different. Let me see if I can show you guys a chart. Give me one quick second here. There's usually a pullback and then this last exuberant phase. It's really weird how it plays itself out. Give me one quick second here. I don't know if these guys talk about it. Yeah, there's like a mid-cycle dip, and we just had one. I have a better chart for this, but let's see if I can bring this up here. There's a I have a better chart than this, but we just had a pullback in our market right here, our housing market. You guys remember? If I could show this on a Fed plot, but we had a pullback in here, and this is called a window right here, and what we'll have is this window phase is where our stock market likely rips until they cut rates, and then you'll get your crash. It's right. I got a report I'm going to show you guys. It's really cool, but we're likely right here, mid-cycle dip, and you're going to see one more rip higher. If you guys look at a Fed report on median housing prices, it actually shows this mid-cycle dip right now. And then this moment in here matters in terms of when they cut rates. Let me see if I can show you something here. Let me show you guys some cool here. Hold on. Hang tight here. Government shutdowns, all the macro you need. Algo face. Is it on this chart here? Unnamed. Hang tight here. Did I show it on this one? Maybe. Let me take a look. Take a quick second here. I don't think I ran it here, but did I show it on the weekly? One quick second here. I don't know if I did it on this one. Nope. Give me one quick second. Well, it's 3:20 in the afternoon. Let's look at a 1 week here. I don't think I did it here. I'm on the wrong chart here. One quick second. Where is this? One week. Here we go. You guys want to see some coolness? You guys want to see some coolness? Okay. Here you go. I got some fun times for you here. That's 1983. Hang tight here. Where's the 1950s? We have one more back here, don't we? Let's see if I can show you this. Nope, right here. Okay. Give me just one quick second here. So I want to talk to you guys about being careful out there of. So this is August of 1966 was the end of a soft landing, right? Big roll down, but then you have this window of recovery here. This is the window in here that I talk about, right? So you have that nice, beautiful pullback and the end of a soft landing. And then we have a window. This window here lasts from 1966 to 1967. That was a 4-year window where the market actually went higher, okay? This is a recessionary period thereafter. And you can actually see the real big low comes in that recessionary period. Soft landing, always followed by a recession. This is the big one that you're looking for right here, okay? And then your next one right here, you have your end of your soft landing on this one. Right? See that pullback, right? Pullback into March, February, March, April, or something like that. But your window here is from 84 to 87, about a 3-year window right here. Then you have your recessionary period that actually takes place later on. And you have a nice big crash right here. But we don't even go back and visit these lows down here, right? And here's your next one right here. You have a soft landing, pullback, but then a run. Look at this window in between the last soft landing and the last recession. And this is the bad boy right here. This is where the Fed just lets the market run hot all the way up. in this last window, and then you get your great recessionary period where you see some significant downside moves. So what we talk about this in the report, this window no one likes to talk about. No one likes to talk about the window but before the defined recession and defined soft landing. There's actually a window in there in what takes place in the market, and it has to do with rate cuts. And the Fed knows this. So I'll leave you with that. I go into more detail. Let me leave that here. I go into more detail of that in person. So my point to you here is that if you are a bear, I know what you're looking for. I know what a seller is looking for. Seller's looking for the reset, right? If you're looking for the reset, you need rate cuts. You fucking need them so bad. Whether they're in 3 weeks, 4 weeks, or if they're end of year, or in 2 years, 5 years, whatever, you need those rate cuts. They've just bought themselves a window where they can do whatever the fuck that they want. We have a soft landing that began in late July. The soft window dates, I've got those for you as well. They usually run no less than a year. Sometimes they run up to 3 to 4 years, and then they actually have a window after that defined soft window period or soft landing period, and that's where you get your actual crash. So, anyways. Sounding super bearish over the next year or two. Yes. I want you to know that someone said I'm sounding super bearish. I am. I am very bearish the moment they cut rates. I am. Now they have a choice. If Jerome can run this market up. For however long he wants, as long as he holds rates. If he does cut rates, or when he cuts rates, I am extremely fucking bearish. Extremely bearish. And I'm extremely bearish for multiple years. Not like down for multiple years, but a major roll down and stagnation for 3 to 5 years at least. So there is a technical definition of a soft landing. Okay? There is a technical definition of a soft landing. The start of the soft landing is the last rate increase. That was July 26th of 2023. Historically, we never raise rates, historically, we never raise rates again after 5 months of no rate increases. But if he holds rates or does increase, if he does, though, he can prolong the window before the official start of the recession, the next recessionary period. He can retard the beginning of the next recession by not cutting rates or increasing slowly over time. Or at least that's what the data says. So I'm basing this on data, not on known facts, prior facts, and known data as the market has acted. Well, we're going to go into this. We're going to go into we're going to do a big, long thing. This write-up, I think, is like 5 to 10 pages long. It cites every prior example, how the market acted, and what you really need for specific things to happen. You really do need certain things to happen. So if you're a bear, if you're a young person or a bear, you want rate cuts. Bad. You want them really, really bad. Okay, what do we got here? We got 20 minutes left. No, we got a half an hour left. 3:30 in the afternoon now. Coming into the next hour of trading. Priced in rate cuts seem way out of whack with reality. I don't think, and if you guys want my own personal take here, outside of a correction this year, I'm fascinated to see what the Fed does in March of 25. I think you're gonna see like the whole focus is going to shift towards the election, right? You're gonna see everybody get bearish, and everybody's gonna fucking hedge the goddamn election. All that hedging action is gonna drive the market higher. You're gonna see the vol roll off that election, and you're gonna see the market typically blast off into March of 2025. You're going to see a cry from Bob on Main Street for higher rates. If you see that cry from Main Street for higher rates, that does not translate to a market crash. You would want the Fed in the face of everything being fucking awesome to actually cut rates. And that would be the implication of structural defects in our economy under the surface. That would be with the banks and all that, and the failures and all that kind of stuff. So yeah, 6,000 is easily on board. I want you to please on your own, download yourself TradingView. I want you to then bring up on the chart rate cuts or the Fed unemployment rate, or excuse me, the Fed funds rate, the unemployment rate, the rate of inflation. And then I want, if you want, you can do the yield curve too. And you'll notice that the yield curve can stay fucked longer than you can make calls in the market. This is mechanically on a large, like how you and I act or how a small group of people act is completely different than the machining of our economy and the machining of our stock market. There are these big cogs in our market that need to move for significant price action to happen. It's never as simple as, this should happen or that should happen or whatever. It's like a big fat ass elephant. And because it's a big fat ass elephant, you can see when these things are going to take place. Yeah, go back. I want you to go back there and start to snap lines where the Fed starts to cut rates every instance in history. And if you see what you see is the most consistent. I have this in the report. I have it all blocked off for you so that you can actually see how many times we have a significant downside move in the market versus what's going on with the economy. And the ones that matter about 80 to 90% of the time are those three that I just told you. About 8 to 9 out of 10 times, unless there's something, some fundamental fraud would be the other trigger, and something like war or something like that. We can't trade to that stuff either, right? So and that's the worst part of this, is you can't trade or invest in the stock market saying to yourself, we're getting another COVID, right? If you were to do that, you'd never be in the market, right? You just go to work. You just exit the market and go to work every day for the next 30 years, right? So if you're predicting a crash based on, I don't know, World War III, you're out of your fucking mind, right? If you're going to divest yourself out of this market based on the hope that there's a terrorism event, you're out of your fucking mind. The market doesn't trade to that stuff, never will. So you can hedge yourself appropriately for those moments. You can even buy insurance for those markets. Do you guys know that you can buy insurance? Brokerages, hedge funds buy insurance for those type of events. Ever since 1987, I think those guys are all insured for those unknown events to the marketplace. But outside of that, the rest of the time, you need to trade based on what the Fed is fucking doing. Do not fight the Fed. I'm going to leave you with one last thing on this, okay? You know that I want the Fed to cut rates already. You guys have heard me say that. Being painted into a corner. Remember how angry I got 2 or 3 rate decisions ago when he broke out the fucking 20-year charts and the 10-year charts, and I was flipping out and I was all mad? You know, if Jerome is telling us, right, higher for longer, I'm going to hold into 2024 minimum. Forget the little Fed presidents out there. Jerome is telling you that. If he's telling you that, he is trying to not crash this market for 2024. Yeah, you guys remember that, right? We are in inflationary environments. We all know that we're in an inflationary environment. I wouldn't be shocked. I'll be honest with you. I wouldn't be shocked for us to keep going up in inflation and feel it, personally feel it, and see us touch that 2% year over year. I wouldn't even fucking blink. They fucking commit fraud. It's known that they commit fraud. It's known that they commit fraud. Here, let me set something up for you. Let me show you guys something. You guys want to see something? Hold on here. Or no, I'm just gonna cut it and paste it and show it later. It could take me 15 minutes to show you this. I got people on camera admitting to it, so they will do that. We're at their mercy, basically. The fucking fraud is real. You're going to see what you will normally see. Traditionally, what you will see is a touchdown of 2% inflation, which is probably bullshit. It's when they want that report to say we hit 2% year over year. Do you understand? And even unemployment right now is ramping, and they fudged the last quarter's numbers, right? They fudged them last quarter. We know that unemployment is ramping, but they will fucking fake them. I'm telling you. They fucking fake this shit. I promise you. They will fake it as long as they want to fake it. And then the rate cuts. Whenever they want to cut rates, whenever you see the Fed chair come out and cut rates and you see those 3 mechanics all lining up, I would get fearful at that point. That's when they want their crash or their meaningful downside crash movement that you've been looking for. That second leg down, that great reset, that short-term or long-term cycle reset. Willie Loam saying, I'm not sure if Cap would agree with me, but the interpretation is that we are in an inflationary environment. Fed starts cutting early. They're going to have their hands tied if when inflation ramps up again. So it's not that cutting rates lead to unemployment higher, but that higher employment may cause the Fed to blink and lower rates. I'm going to tell you guys something right now. Right now, our numbers for unemployment, inflation, are probably the most manipulated they have been. It's glaring right now how manipulated they are. It's glaring. And the inverted yield curve, I heard a guy say last week that he, for the first time in his career, is open to the Fed and the Treasury Department even manipulating the yield curve, an actual fraudulent manipulation of the yield curve to get to their ends. So, yeah, yes and no. I agree with you, Willie, but at the same time, it's I don't think they're reacting at this point. I think they're fucking fudging it, Broseph. And I don't think it matters if they cut or like if they, let's say they cut and then jump back on the rate increases. It ain't gonna matter. The moment they fucking cut, abandon ship, fucking run. There was one other thing in that too. If they do cut rates, you could see in a big squeeze for a couple weeks. You might see like a 2-week or a 3-day or just a time period of a squeeze if we are on a low to grab liquidity for that major roll down. So you might hear me saying this stuff to you right now, and you might like come back when it happens and say, well, fuck you, Cap, you're wrong. Look at the market squeezing, squeezing like crazy, Cap. I would be your most cautious at that moment. Extreme caution as a bull, even if it's cranking. You might be like, hey, some guy named Jim James told me we should roll, and look at this, we're going up. I'm going all in on this. I would warn you to sit on your hands for at least a month. My most cautious would be at that moment, regardless of price action in the marketplace. Very, very afraid of rate cuts right now. It is my fear. My only fear in this market right now is rate cuts as a bull. My only fear right now is rate cuts. And it does not shock me that the bond market is betting on those rate cuts either, if they want to see that crash as well. Like the OM, like who's got OM, whose OM we're talking about, what people want to see happen, does not shock me that there are people, bond vigilantes, betting on that rate cut. Like there's a group of people out there, very smart people that want to see those rate cuts, and they're not your friend if you're a bull. Oh boy, you know what? You can argue that against. I will show you the video, okay, of the people saying that absolutely 100% the numbers are being manipulated. 100%. These are from the heads. These are heads of what we do. These are professionals, known professionals. Yeah, you got to watch the video, man. It's as a matter of fact, you know what it was it was an interview. Here, I'm going to show it here. Hold on. You don't even need to watch. I don't even need to cut it for you. Hold on, let me find it here. I'll post the link for you right now. Hang tight here. Watch this entire video, and start to finish, watch this entire thing. And I watched this just the other night, and I was like, so I was talking to I wrote a report, I showed it to Joe, and these people said the same thing as my report was saying. So here, I want you to watch this entire report, because what was fascinating about this report was you have bears, right? Market sellers, short selling hedge funds, and they have a thesis on what should happen in 2024. And yet they are all in agreement with everything I just said to you today. And they go into detail on that scam bullshit. So I'm going to post this for you right now. Watch the entire video. It's from stockcharts.com. Definitely watch the entire video. At the end of today, when you guys are done, right? At the end of today, watch this video, start to finish. And it's these guys, was fascinating because I wrote my report, right? And I started to watch the video, and the first third of it, I was like, these guys are all wrong. They don't know what the fuck they're. Well, not that they don't know what they're talking about. I'm like, these guys are saying stuff and don't understand all the mechanics, or they're not looking at all the mechanics. And then like one or two people, or they all eventually came around together as a group and said, oh shit, what about this stuff? Or, you know what, this guy that's in this interview right now, I'm going to go with him on this. It was kind of like putting three or four really smart people together, and they all had their view in the market for the year, but getting those three people together in one room or one interview, they were all like, yeah, we do need some shit to happen, don't we, for our outlooks. And so they were kind of getting it. They were like, we get it now as a group. It was really cool. It was a fascinating interview to watch because you have some very well-respected people in the same room having a roundtable-ish discussion. And you know that these people might disagree on their outlooks, but they respect the intelligence and wisdom and prior experience of each other enough that they were hyper aware of what can happen against them this upcoming year. So watch that video if you could. Yeah, Willie, check it out, man. Definitely, brother. And I forget her name, but she's from New Mexico, I think. I forget her name right now off the top of my head, and she point blank states it. That right now, specific to time this year that we're coming into right now, is probably the most fraudulent the Fed and the Treasury departments can become. Oh no, I didn't know there was this timestamp. Just start it right at the beginning. If that's on a timestamp, just go right to the start of the video. Start it from the beginning. I don't know why. Maybe I might have clicked it on a timestamp or something, but I might have fucked that up. Here, hold on.
Here. For years and years.
Where is it on right now? The 39-minute mark. Just start it right at the beginning. I don't even think I finished the video. I just stopped. I was like, I already know. It's like I watched this video. And I'm like, I've already done my work. I already know what's going to happen this year. So I'm very confident. I'm very confident in what I think is going to happen this year. So I have a high degree of confidence here. So these guys that I was like, I don't agree with any of what these guys are saying. And then somewhere through the video, I go, they're figuring it out as they get interviewed. It's like as they were being interviewed, you could see they all were like, fuck. Like, not in a bad way, just, put three smart people in a room, and they start to come to, like, a higher level conclusion as to what could happen in the year and why that would happen. No, we do not have a confirmation of rate cuts. We do not. We do not. In the bond market, betting on dot plot, little Fed presidents talking doesn't mean anything. The bond market doesn't mean anything. Mortgage brokers or setting rates lower. All that is just speculation. It's all it is. All it is. Thanks for asking about the times. If you guys are opening that video to a timestamp, go back to the beginning. Watch that video from the beginning, please. So the report is done. I've been working on it to finalize it. I just have to. It's more how it looks, and then like how it's structured, the color of things. Just want to clean it up a little bit. So it should be done tonight, somewhere tonight or tomorrow. It'll be a link will be posted. It'll be on our website. So if you sign up for the free membership, you'll have access to it, or the link to the website will be inside of the Discord. So you'll know about it when it's there. When you guys get it, you'll know about it. And I just have to clean it up. It's pretty extensive. I had to back test everything. I had to read it over and over and over. And now I just have to plot out the year. I already plotted out the year. I just have to clean it up so that it's one cute-looking set of lines going up for the year and stuff like that. And I posted the rough draft of just this SPX chart, I think, on Twitter. Just an SPX chart for expectations on the year. And then we have to talk about a conclusion at the end about, what you're looking for. So, like, you want to be paying attention. Dude, you guys, there's some data, man, on presidential elections where we fucking moon 100% of the time. Like 100%. It's going to be fascinating seeing what the Fed does in December to March of 2025. December of 2024 to December of 2024 to March of 2025 if we ramp up. Because there's going to be fucking calls, man, for rate increases. And he knows, Jerome fucking knows, if he does rate increases that we will continue higher. Fund strat will be correct. He'll get his 6,000 if that happens. And you will see the 5,200 this year, and you'll likely see a mad dash to 6,000 into 2026. And then you would see a major roll down in the market, a major market crash. It should begin in now. If Jerome does the right thing, he'll cut rates in 2025 and start it early. If he does not do the right thing and he continues to pause and raise into 2026, it would all magically align with a housing crash, the end of an 18-year housing cycle. It'll all magically align together at the same time. I got you guys, man. I'll talk to you guys soon. And you know what? If you're a bull, even though I sound as bearish as I do, Jerome can definitely save your ass. He has the ability to save your ass. He has the ability with rates to extend this market for years. He can extend this market for 5 fucking years if he wanted to. If he continues to raise rates, see rates at like 15, 20, something like that. Yeah, you can see the market fucking just keep fucking ripping, dude. I just don't know if he's gonna do it or not. If he wants to do it. I don't know. The greed is there, so it'd be wild. Yeah, good sesh, right? Let's see what happens in this close. I want to know if you guys are bullish on this close. Thinking about buying some puts for tomorrow, but on the bell. Fucking Bears can't get it done again, baby. Can't get it done again, Bears. You guys have a great afternoon. I'll be back with you again tomorrow. Remember a few other things that we went over this morning. Even though the stock market is back operating, the stock market really doesn't start back up until after this Friday. People are still traveling. The way that the holidays worked out this year, kids are off until Friday or until Monday across the country. So the real market should reopen, and then you've got positioning and all that kind of shit. So we're still in a holiday trade until at least Monday. All right, I'm going to turn this off in the next 7 minutes or so. And I'll see all of you guys tomorrow, baby. Expect that report today or tomorrow. Should be tonight. I should be able to get it done. I want Joe to review it one more time and make sure. What else we got for you? I got some cool stuff. We got some cool stuff coming. Nice little pump coming into this close here. What's the imbalance right now? I'm not seeing the imbalance. Anybody know what the MOC imbalance is here? I'm not seeing anything public from Financial Juice. Thanks, Duke. 3 million MOC buy side 7.4 billion. Thank you, brother. The IMF chief is saying the Fed is definitely achieving a soft landing. I said that this morning to you. I'm telling you guys, dude, we started a soft landing, brothers and sisters, in July. When they finally announce the soft landing, it'll be the end of the soft landing, and then we're going to go into what I call and have coined, nobody else has coined this but me, a window. You're going to have an official soft landing period. Then you're going to have a window period. And then you're going to have the next recessionary period. And that is the window period is what nobody is talking about. So we're going to talk about that in that report. We're going to talk about the definition of a soft landing, how long they last, and then that window between the defined soft landing and the defined recession that historically we're guaranteed to follow after. And that is what, so that video I gave to you guys earlier, right? So this is the thing, okay? You got bears out there that are like, well, even if we have a soft landing, we guaranteed that we go into a recession. But what they don't, or what they're missing, the key point or key part of this is that there's a window period too, in between those two. And they're defined by specific dates. And we have not left the soft landing period yet, and we have not entered the window period yet, and we have not entered the recession period. So when you're listening to a bear out there telling you, when you hear people out there telling you, even if we're in a soft landing, a recession is going to follow, they're not addressing the middle, this middle pausing period, this window in between the two. And you guys are going to get access to that shit from me. So talk to you guys soon. Love you all. See you soon. Yeah, you want me to do that, Beartown Sheriff? Switch it to manipulation? I could do that, man. That's a good name too. Manipulation. I like that, brother. There's a manipulation window. It really is. Beartown, it's a manipulation window. Like, we're basically we're handing over control of the market at that point to a fraud period. It's like a fucking fraud period where as long as the Fed holds rates, market does not trigger the end of the short-term or long-term debt cycle. It's kind of fucked up. It's kind of fucked up. You guys don't really think that. So the last quarter, inflation came down and unemployment came down. You know that, right? You guys believe that? You guys really believe that inflation was coming down the last quarter? You guys are out of your fucking minds, right? Like, I'm getting my tax bills in right now. I know inflation. I know it doesn't count everything, but you got to be out of your fucking mind. Like, if you don't think that I'm paying more, like my end of year stuff is coming in right now, and I am getting fucking bent over right now, and I see none of it stopping. From taxes to cost of goods and services. And gas, fuck gas. I don't give a fuck about gas coming down. Gas ain't got shit. I just went through a period of three major increases on my utilities. I own three now I just bought another one at auction, right? So but the utilities, I pay utilities on three properties right now, right? And I went through a 3 rate increase cycle, and I just got my winter bill in for but we had a warm winter across the country, right? I just got my bills in for my real true winter bills for utilities. I got houses that have electric bills at $700 a month right now. A fucking building. Like, I'm not goddamn joking. I'm fucking raging here. I don't even know. Like, my taxes this year, and when I'm looking at my expenses for this year, they're fucking lying. They're fucking lying, man. I'm telling you, they're fucking lying. Oh yeah, oh yeah, oh yeah. And we've had meaningful increases, and the worst part of it was the last meaningful increase was at the ass end of last winter. So I didn't really see the impacts. It was like a slow raise over a few years. But then this winter is when it all cumulatively was like a kick to the, and then they did a bunch of other stupid shit too. Like they gave us 3 increases, and then they introduced this like window during the day where you get at a higher rate. That's new for us too. It's like between the hours of 4 p.m. and 7 p.m. you get another 30% increase, and so it's just this big fucking scam, and it's like. Yeah.
According to a U.S. Treasury daily statement, U.S. total public debt outstanding reached $34 trillion for the first time on Friday, December 29th.
It's I don't know. I'm telling you guys out there, inflation's not coming down. It ain't coming down.
Do you want to stay up to date with the latest
on
the bleeding edge of news?
So I looked at
payrolls? Then sign up today and get our special offer of financial use pro.
I considered solar, like truly considered solar 2 or 3 times. I'm a solar proponent. This is the first year. So remember I was telling you about these conversations with my partners and wife and stuff. I think I'm committed to making all my homes solar in this next roll down. So I think I'm no longer on the fence. I am actively making a decision to go solar at some point. Last where you sign up for membership levels. Would you mind? You can just go to in the top right-hand side, Adrian, if you go to the top right-hand side of the website, if you go to memberships and just click on it, there's a free tier. You just sign up for the free tier right there, and you'll get the report. And if you guys, I'll put a link in here in the chat. You guys will get a link to it in the chat. Hey, Will, man, Happy New Year, brother. Take it easy, my man. And what else? Oh, Sunday Never Ends just said, can confirm I'm hip deep in TLT and want rate cuts. I know Sunday Never Ends. I know. I know the bet. I get you, dog. Oh, no kidding, Jade Pastor. Pigeons are the birds. I was gonna do the I gotta yeah, that's true too, Goat Mother. The 2% year over year is, we're never gonna beat that, are we? Well, we could. We can, but they're not trying for that, are they? They've already admitted they're just trying to get us down to 2% year over year. I really wanted to do the Powerwall, but I'm not gonna. It's not. I would really like to do the. I'd also really like to do the tiles on the roof, but I don't think it's cost effective for me. So I think I'm gonna do the panels on the roof, like panels across the entire roofs, or like one side of the roof or whatever. Stack them. But I'm on solar at this point. I really am. That was the nail in the coffin. This year is the nail in the coffin for me with power companies. I'm fucking done with it. I'm so fucking pissed off these power companies. And I know what's happening. It's a new cycle. We're in this cycle where we're in this new cycle, right, where we're going to get gouged by the government. We're going to get gouged by corporations. And it's like the whole egg thing, right? We had this, remember 2 years ago, we talked about how they're going to raise the price of eggs and not bring them back down because they know they can't raise them again. And for a 10-year cycle, 20-year cycle. So you're going to get, if you're a young person, you're going to get fucked. And only over time will your rate of pay give you that sweet spot where you're kind of like making strides, but that's going to take 10, 20 years. For you to get there, if you're a low-income worker and stuff like that. So if I'm at the start of that cycle right now of getting fucking bent over, this is probably the time to invest in solar, not on the back end of one of those cycles. Yeah, I've heard that too, Goat Mother. I've heard that. I don't have the space. So these houses I own are in the city. If I had some land, I would put them on the ground too. 100%. I don't like the roof placement at all. I agree with you on that too. I agree with you on that. Yeah, I got to struggle. You know what else I struggle with is I'm in Michigan. It has one of the worst. It's like one of the states with one of the worst solar windows in the nation, or like places. We're very gray here. We have lots of cloud cover here. It's one of the worst states, man. It's like Portland. I wish I had these houses in like New Mexico or Arizona, in the South American Southwest, something like that. All right, I'll see you guys tomorrow. Ciao, baby. Ciao, Jack.